forum, Mr. Charles Machira, for him to give us introductory remarks to this conference. Thank you very much. You're welcome on stage, Mr. Chair.
Good morning, colleagues. I'm not Mr. Charles Machira, and I have his apologies. He was not able to make it to this particular conference, the third Africa Pensions Supervisors Forum conference, and in its place we'll have our Vice Chairman, Dr. Farouk, from PENCOM, National Pension Commission, PENCOM of Nigeria. He's going to stand in the shoes of Mr. Charles Machira in this conference. Please allow me to welcome him, and let's clap as he comes.
Okay. I'll start by talking about the people on the service table. We'll call it sometimes in my country, not the high table, because are the people that should be high up there. But they're high up there because they service the people and they service their societies. So top on that high table, service table rather, is Honorable Minister of State in charge of National Treasury in Rwanda, Mr. Richard Tusabe. I hope I pronounced the name right, sir. The Honorable Governor of the National Bank of Rwanda, Mr. John Rangomba. I hope I did that right also, sir. And the Deputy Governor, Honorable Deputy Governor of the National Bank of Rwanda, Ms. Soraya Hakuzemiye. Sorry. And then, good morning, ladies and gentlemen. I stand here to give a welcome address, but perhaps to start from somewhere in 2016, back in Berlin. Some of you might remember that beginning of 2013, I think we had this, what we call the World Pension Summit, organized by the National Pension Commission in Nigeria. It was successful, really, sort of event, but more of a private sector driven than government driven. So we invited the RBA to come. That time it was Dr. Odundo. Dr. Odundo refused to come. So coincidentally, I met Dr. Odundo at an IOS meeting at Berlin in 2016. And I confronted him personally. And he said, well, why don't we come together, African Pension Supervisors, and have sort of forum that will be discussing pension issues in Africa and perhaps see how IOPS can come in to support us. Also, drive some projects that are basically going to help our various jurisdictions in terms of pension supervision and pension regulation. So we agreed that we'll do it. Coincidentally, Dr. Odundo left RBA, but coincidentally, an able gentleman took over, the late Nzuma Mutuko, who died just like 2 weeks ago, and for which I want all of us to please rise for a minute in respect of the soul of Mr. Mutuku. May his soul rest in peace. Thank you. So sometimes in 2019, there was this forum that was organized by the RBA, which took place in Kenya, with the theme of unlocking Africa. Unlocking African pension potentials. During that meeting, this idea still came up. Now, why don't we come together as African pension regulators and supervisors to form a forum that will be discussing some objectives, as was earlier discussed with Dr. Odundo. So, a couple of side meetings took place, and then we agreed that we will do it. And IOS was there. They promised to give us some support, logistic support, especially with establishing a secretariat and so on. And an interim management committee was selected, not elected. So Mr. Mutuku was asked to be the interim chair representing RBA. So the way we did it was the interim committee was made of institutions, not individuals. So RBA was given the chair, and Nigeria was given the vice chair. So that's why I'm here today talking to you, because the acting chair, Mr. Machira, could not make it because of the barrier arrangements for the late Mr. Mutuku. So there was a virtual meeting that took place in 2020 with the theme of Africa pension industry during and after COVID-19. But just a second to say that in 2019, when we had that meeting in Kenya, it was agreed that we will meet in Kigali in 2020. And I can't remember the name of that lady that represented, I think, the National Bank of Rwanda at that time. She almost immediately agrees that we will do it here, either the National Bank or the Ministry for Finance. So here we are not able to do it because of the COVID-19 lockdowns, but we're here today. And I'm happy that we were able to actually see each other physically after that, those 2 years of lockdown. And I believe that we're all here to share our thoughts, our knowledge, our ideas on how to impact African pension landscape, in addition to also promoting the African pensions and African regulation and supervision within ourselves, and indeed how we can tap on what is available out there, what has been developed out there to make what we are doing much better and excellent. So on this, I would like to welcome every one of us here, and I hope we'll enjoy it and we'll benefit from this, and we'll have takeaways that would benefit our various institutions and our countries. Thank you very much. I think I have a role to play to introduce invite the governor of the National Bank of Rwanda to take over from me. Thank you.
Yeah, thank you. Our guest of honor, Honorable Minister Richard Tusave, fellow pension regulators are here present, distinguished participants to this conference, good morning. It is with great pleasure that I welcome you to the third annual Africa Pensions Supervisors Forum. To our sisters and brothers coming from outside Rwanda, we say Murakaza neza, Murisanga. You're welcome, feel at home. A special welcome and appreciation to you, Honorable Richard, for accepting our invitation to be our guest of honor this morning. As just said by Farouk, this forum dates back to 2019, when Kenya hosted the first annual conference that brought together several African pension supervisors. Through discussions in the conference, the supervisors agreed to form the African Pension Supervisors Forum, under whose auspices we are meeting here today. I take this opportunity to unreservedly thank the Retirement Benefits Authority of Kenya for pioneering this worth initiative that has provided a platform for us pension sector regulators to collaborate, exchange notes, share experiences and challenges, and the process contributed to building each other's much-needed capacity to ensure stability and development of the pension sector on our continent. I also thank the countries that have joined the forum as founding members, and I'm looking forward to welcoming all other African colleagues as members of this forum soon. The bigger we are, the richer the pool of ideas becomes as a think tank for the progress and sustainability of the continent's pension industry. I strongly believe that over these 2 days, we will deepen our understanding and spur beneficial conversations on the theme and topics of this conference. At this moment, allow me to humbly recognize and honor our foreign colleague, late Nzomo Mutuku, the former CEO of Kenya's Retirement Benefits Authority, whom we lost recently, as has just been said. As we all know, the late Mutuku was key in pioneering this forum. We would like to extend our heartfelt condolences to his family, to those that worked with him closely in the RBA, and to the Kenyan community at large. May the Lord strengthen you in these trying times. I had planned a moment of silence, but we've just done that, so we continue honoring the memory of our colleague. Ladies and gentlemen, traditionally the closeness and solidarity of the Africa family in the African setup provided an automatic system of taking care of the elderly. This is a powerful legacy that we should cherish, for it gave our elderly a dignified life. However, we should realize that as society constructs change, globalization progresses, immigration made easier each day, and the fact that we are not the guarantors of the lives of those whom we may hope to depend on, it's no longer wise to think that a bigger family equates to a secure future of pension investment. Unfortunately, the majority of the population on the African continent still rely on this traditional pension system. Imagine yourself as a senior citizen who is no longer able to actively earn an income, and you are being tossed around, I'm sorry to use that word, but it's a reality, between your children's homes because none of them is willing or able to take care of you, take care of your future financial, to take care of you. Yet, part of your decision to have a number of them was for your future financial security. Unfortunately, going forward, this may become the reality to many of our elderly if these traditional retirement systems are not challenged and people educated and enabled to save for their retirement through formal pension schemes. Saving or contributing to pension funds is a basic necessity in today's and tomorrow's world. It's a key social protection instrument. It will enable us to age with dignity, while not compromising our living standards, at least not materially. It will also help the immediate family of the pensioner by lifting off the financial burden so their resources can be utilized to develop themselves and saving for their own retirement. Apart from the benefits on the individual level, the pension sector is also instrumental in sustained economic growth and development of a nation as a whole, due to its aspect of mobilizing longer-term savings to finance longer-term development projects. It also increases aggregate demand in the long run as it maintains consumption of the pensioners and their dependents. While the benefits of a developed and inclusive pension industry are undeniably enormous, it's unfortunate to note that the level of pension penetration on our continent is still very low when compared to other parts of the world. For instance, only 6.3% of sub-Saharan Africa's labor force is covered by contributory pension schemes, a trivial level when compared to high-income countries whose coverage ratio for some is close to 100%. For example, North America has 97% coverage. Northern, Southern, and Western Europe has coverage of about 87%. Central and West Asia, 57%. These very low coverage numbers for our region should give us policymakers, regulators, and pension funds themselves sleepless nights. Another factor that is positive on its own, but that makes the need to increase pension penetration even more urgent, is the improved life expectancy on our continent. For instance, life expectancy at birth in Africa was about 7 years in 1950, increased 48 years in 1980, and gradually rose to 64 years in 2020. This means that the retired population ratio will continue to increase in the other head, which is an expected demographic transition as economies and health systems become more developed. We are therefore called upon to do better as a continent, and as it is paramount that most, if not all, of the labor force is covered by formal pension schemes. If we are to grow the pension sector in our part of the world, we need serious legal and regulatory reforms. We need to open up the private pension schemes that would come up with better customization of products and services, especially targeting the informal sector, which makes up about 80% of our labor force in Africa. The biggest challenge to the pension sector is that pension providers in the region are mostly from the public sector. However, as we seek better coverage, we should also seek better preparedness for unforeseen shocks, such as the COVID-19 pandemic, to ensure resilience and sustainability of the sector. Ladies and gentlemen, this takes us to today's theme, which is about the resilience and sustainability of pension sector amidst crisis with reference to COVID-19 pandemic. As we know, the COVID outbreak affected health systems, claimed people's lives, and affected businesses and other economic activities, either because of partial or full lockdowns. The pandemic then instigated supply chain disruptions, which brought even more economic hardships. With these shocks, the financial system resilience, which includes the pension system, was threatened due to general slowdown in the economic activities. To begin with, many members of the pension schemes were not able to make regular contributions as they normally would due to loss of jobs, lowered salaries, sickness, among others. The same challenges applied where employers had to make contributions on behalf of their employees, especially for the sectors that were mostly affected by the pandemic, such as the hospitality sector that always employs many people. With reduced contributions but continued withdrawals, this would reduce the level of the pension institutions' investment in assets, which are the backbone of their stability. This could be a cause for some pension schemes to go bankrupt. The pension industry was also on pressure by members and some policymakers to release pension savings to their contributors that were facing severe financial strains due to the pandemic. These pressures on the pension funds to support their contributing members in times of crisis is an issue that needs serious policy discussions and orientation. ladies and gentlemen, as I conclude, let us be reminded that some of the discussed challenges we have resurfaced or have been compounded by the Russia-Ukraine's war effect on our region, making this conference even more timely. We have the opportunity in this conference as a continent, as continental pension sector regulators and players, to discuss these and other issues at large and in depth, and we still have the opportunity to keep learning about each other's experience in future meetings that APSF will organize. I would like to extend a special word of thanks to our partners in organizing this conference, notably FSD Africa and Access to Finance Rwanda. To the speakers and panelists who have offered or accepted to lead in these discussions, we greatly thank you. Also, big thanks to the local organizing team at the National Bank of Rwanda. The next 2 days should result in an increased spirit of coordination among us as continental players in this field. We appeal to and welcome our fellow pension supervisors that are not yet members of this forum to join and widen the association. As the saying by Ken Blanchard goes, none of us is as smart as all of us. Let me end my remarks by urging our colleagues from outside Rwanda to take some time off the busy schedules of this conference and visit some attractions around Kigali and in the countryside as we enjoy the Rwandan hospitality. I wish you fruitful deliberations, and I thank you for your kind attention. It's now my pleasure to welcome you, Honorable Minister, to give your opening statement. Thank you.
Governor of National Bank of Rwanda, Deputy Governor, National Bank of Rwanda, Managing Directors, CEOs of financial institutions present, distinguished guests, ladies and gentlemen, good morning. It is my great pleasure and honor to be here today to officially open the African Pension Supervisors Forum. And I think it's a great privilege for me, specifically because of my background again, having served as the head of pension fund in Rwanda. So I really relate with the sector and where I sit today, more important with the theme. I want to express my appreciation to the organizers of this forum and say thank you for choosing Kigali Rwanda to be the host for this edition of Africa Pensions Supervisors Forum. Again, the forum is taking place at a point in time when Africa and the entire globe is coming to terms with the impact of COVID-19. I think Honorable Governor has spoken about the impact in a little bit of details, but also the most recent shock of Russia-Ukraine war. Africa is on the receiving end. I think barely 3 weeks when the war started, I don't think there is any economy on the African continent that was not really feeling the pressure. So there is a lot to learn from that, and I think resilience is the way to go, and again, shortening the global supply chains, but I'm not going to dwell much about that, but the pension funds have a lot to play, and we really look forward to see how we can leverage on the pension funds to bridge and build more resilient economies, not only to cater for the ongoing pressures, the COVID-19 and the Russia-Ukraine war, but also, more important, for the upcoming more shocks that might come to hit the globe, but also Africa. Considering the agenda that is very rich, I've really taken time to look at it. I have will prove to be a great platform to discuss the role and place of pension sector in building resilient economies. Distinguished guests, ladies and gentlemen, there are so many statistics that have been published by the World Bank, our respective pension funds, and the number look depressing, if I may use the word. Depressing in the sense that below of working age population participate and contribute to social insurance programs. I think what we keep on boasting about as a continent is demographic dividend. So the demographic dividend that we keep talking about as potential, it is really one that possibly some of us in our lifetime will never see the realization of that potential. If you have only less than 10% of people, working age population covered in pension, what means that with the increasing and improved life expectancy, our people are likely to live as they age. If we are not going to provide quality life to our population, the simple and clear, we are just creating more pressure on social safety net programs. So social protection programs are under pressure, and we've seen what we are going through in terms of capacity to generate revenue, the cost of doing business going up. So the fiscal space that is narrowing is not even allowed to support social protection that we've been handling, but now even getting worse as we get these global shocks. So what the missing middle of our population? I think that's the focus that we should work on, both at supervisor and also policy level. We are constraints that can limit our ability to expand social assistance to all those that need it, but accept and acknowledge that if we can design tailored pension schemes that can speak to our reality as a continent. And the good news is that all of us in our respective capacities at national level, we've tried to design some of those programs. So it's an opportunity to exchange experience and context and see how we can really design and build what works for the continent. So again, after these 2 days, we should be able to come up with and how we can customize and speak to all stakeholders, the pension managers, the regulators here present, the policymakers, and then we can come up with a lot of speak to our realities. So, on behalf of policymakers, I really look forward to the outcome of this 2 days forum to see what we can do together to make sure that we can get better in a timely manner. I'm not going to try to educate you about the impact. If you look at they've gotten worse. Possibly we're at different levels. We haven't assessed where we stand at country level and the continent, but is that We are seeing now the cost of doing business increasing abnormally. We are seeing nationalization of the global supply chains, but more food security. So when you look at things like food security, for example, how much of the three that is assets under management for the pension funds is going to support the food security part of our development agenda? You will be surprised that actually it's a very low number compared to what we should be putting in. I know there are so many risks in some of these sectors. If you speak of agriculture, insurance, commercialization, but again, is our to work to see that actually that speaks and works in our interest. So the reports and the pension funds can play a leading role in building back better through encouraging the pension managers to be more innovative, through encouraging the portfolio management in terms of asset allocation, and also, so how do we get a little bit of a push, upward push to say, this is what we think is going to work for us, and Mr. Policymaker, how do you play your create a very strong and enabling environment? The pension sector in critical role in development and fight against poverty. There is no doubt good job has been done, but I think we can still do better. The pension sector remains a source of funds for long-term investment, and we should use that to catalyze even foreign direct investment that come into the continent, but also allocating the capital where it should be put better to speak to more resilience and inclusive growth for our countries. It is therefore important that the region continuously put in place an environment that facilitates innovation for us to achieve inclusive and sustainable growth pension sector. I think one of the examples, speaking for Rwanda, I think when we came up with Ejo Heza, which is a program that has come to complement the traditional pension fund, in terms of numbers, it has by far surpassed the traditional pension fund, and we think we can still even do more pension on Ejo Heza, but also come up with more innovative ideas. Again, the view of our practice, laws, regulations, in response to the ever-changing environment, and demands of as well ensuring equal gains for all the players. We've seen what is happening in other parts of the world when the citizens are really struggling to come to terms with the shocks. In most cases, they don't have an option other than really trying to hold the governments accountable, but in most cases, it is too late. So as a pension fund, we've seen from experience, from literature, wherever a pension fund goes under in terms of being bankrupt, the consequences are really serious, and we really want to avoid that. So, again, 2 days, we hope that we can come up with strong mitigation measures to ensure that we avoid and protect the pension funds to have a shock, but more importantly, protect the members of those pension funds. The shift in the pension landscape and support new product development and innovate on sense of delivery for new products. Speaking of demographic dividend for the continent, speaking on potential for internet penetration, we still believe that we can come up with more solutions that are easy to access, easy to use, and encourage more people to join the pension funds. Give special attention to employing digital systems, mobile digital services, and serve excluded and make saving more accessible and affordable. So again, speaking about the environment that you need to create to ensure that the missing middle they are given an opportunity they're not given an excuse not really to join the call for pension. Ladies and gentlemen, as my remarks, allow me to condole with the entire Africa Pensions Supervisors fraternity in passing on of Zomo, Mr. Zomo Mutuku, the former chairperson of the Africa Pension Fund Supervisors. A lot has been spoken about him, being one of the initiators of the idea, and I think it's very important that we pass our condolences to the family and the pension fraternity, but again, being proud of what he did, and I think this is an opportunity also all of us to play our role when we are given this opportunity to serve in some of these offices. Again, as of the forum, for organizing such a very important forum, like I mentioned, I look forward to the outcome of the 2 days discussions. What is it that you're asking the policymakers to follow through on? What is it that we want the pension managers to do? And then together we can make sure that we build more resilient pension funds. We capture the missing middle, but also ensure sustainability in whatever we are doing in terms of complementing policy on economic front and also social front to support the government initiatives. I thank you and allow me to wish you all fruitful deliberations in these 2 days forum. Thank you.
One more time, let's appreciate the very insightful and wise opening remarks. Thank you very much, Vice Chairperson Dr. Omar, for delivering a great introductory speech. Honorable Governor, for your welcome remarks. We really appreciate the call for action, and our guests of honor, Honorable Minister, thank you for the great opening remarks. And with this, we are going to start with the first topic of the pension, and our speaker, Mrs. Himanshi Jain, is the social specialist at the World Bank. She's going to share the pension sector amidst COVID-19 and on the continent. This is going to be for discussions that help us to moderate. So thank you very much, Himanshi.
Thank you so much. Hello, everyone, and thanks a lot, Honorable Minister Tusabe and Honorable Governor, for your strategic guidance and a call for action for all of us gathered here together today, both regulators and practitioners. Lots of words there. So over the next 15 minutes, I will be talking about the performance of pension systems during COVID. And I would like to begin with a global history on pensions, because history is always something good to reflect on. Lots of lessons learned from there. And as you can imagine, the history of pensions has spanned over conflicts, crises, and most recently, the pandemic. I'll talk very briefly about the current landscape of Africa's pension systems. And then I'm going to talk about what is different this time around relative to the last big shock to pension systems, which was the 2008 financial crisis. I'll conclude with 5 lessons and associated policy recommendations. So to begin with, I think most of the gentleman on the left-hand side is. But if someone can guess who the gentleman on the right-hand side is, there's going to be coffee on me. So, commonly known as the contributory pension, or Bismarck. It was a German in the 1890s, and from him starts the whole idea of contributory pensions. Since that time, if we look at the history of pensions, it can be broadly split into 4 different eras. So the era 1 saw DB schemes. In Europe and America, this really expanded very rapidly. And this the world. Towards the end of this era, sustainability concerns around these DB schemes in Europe and America started emerging. And in the late 90s, that following independence of multiple countries in Asia and Africa, what started happening is a passover of colonial DB schemes into these countries. So that summarized what we saw in the first eras. The second era started in the background of sustainability concerns now emerging in Europe and America. This was because of life expectancy increases in the 1960s, invention of penicillin. So that's when life expectancy increases and demographics started playing a big role in their sustainability concerns. The era saw a wave of DC schemes coming in as a way to reduce the sustainability concerns. They expanded in LAC, ECA, you had schemes in UK coming up, and more countries started opting for a hybrid setup, so a DB and a DC arrangement. And towards the end of the era, you had multiple schemes strewn across. In the third era, again, the focus moved away from the debate on whether it should be a DB or DC scheme squarely into the issue of coverage for developing economies. For OECD, the challenge was sustainability, and for emerging markets, challenges emerged on the adequacy, especially that of DC scheme. We saw a wave of parametric reforms. We saw reversals in DC schemes, countries going back from DC to DB. And what the 2008 crisis did is simply added fuel to the fire. And it accelerated some of these reforms that were already put in place. And a lot of the reversals that we saw in Eastern Europe can be traced back to the 2008 crisis and the dissatisfaction that followed. So now we are in what I call the fourth or the current era, and coverage has taken center stage. It has taken center stage in developing economies because of the high rates of informality, but we're also seeing this as becoming a concern for the developed world. And that is because flexible work, gig economy, lots of changing jobs, fluid labor markets are becoming increasingly a reality for the developed world as well. So what you can see from the graph here on the right-hand side, what we're showing is pension coverage in the 1990s versus that in 2015. And not a lot of movement, except for some outlier countries. What happened is health insurance relatively has expanded quite a bit. Some countries, and Rwanda is such a great example, has near universal coverage. But that was made possible largely because of massive subsidies given to the bottom 40 to 50% of the population. Now, that has not necessarily happened in pension systems, but what we're seeing is this emergence of voluntary schemes with targeted fiscal incentives, and EJOHES is a great example of that, and we're seeing more innovation happening in this fourth era. What is clear now, however, and especially since COVID-19, is that depending solely on employer-based or payroll-financed mandatory coverage is probably not going to be the answer to the coverage problem. And if that dependence is retained, there is a higher risk now that countries are going to grow old before they grow rich, if that sort of link to formality is assumed in pension coverage. So after this global history overview, I'll now walk you through the state of pension systems in Africa through a few graphs. And I think this picture pretty much sums up what I'm going to show in the next few slides. And this is true not just for private, but also informal sector pensions. So what we see in Africa is a fairly fragmented pension landscapes. There are variations across country, but more or less a fragmented pension landscape. On one side, you have public sector workers that tend to have more generous benefits and a part of more mature schemes. On the others, and moving on, we have like a small formal private sector, less than 10% of the labor force, who are mandated to contribute, but there are lots of issues with the actuarial fairness of the systems, with the adequacy of those schemes. Then you have occupational pension funds that vary in size quite a bit from country to country, and a lot of improvement has been made on regulation and supervision, but more can be done. And lastly, you have these emerging voluntary schemes. In some countries there are one, in some countries there are multiple, and they come with mandatory or behavioral incentives. So broadly speaking, that's the fragmentation we see when we're talking about pension landscape. And this is not necessarily unique to Africa. Many developing economies in Asia and in the Middle Eastern region have a similar pattern. And that is because of the high rates of informality there and because of DB schemes passed over from colonial times. So very quickly, looking through numbers, and like I said, there's a lot of variation within Africa, but contributor coverage in mandatory schemes remains low, less than 10% for almost 80% of the countries that you see on the screen here. Beneficiary coverage, and it's very important to look at these two topics separately. Beneficiary coverage, people who actually receive pensions, that's even lower because the schemes are relatively young, and because of the rules and the high vesting periods, many people who are in pension schemes might not even get an adequate pensions. On the surface, if you were just looking at spending as a percentage of GDP, you might think that African pension systems are in really good shape compared to OECD economies. But the challenge is that coverage in Africa is much, much lower than that in OECD or global contexts. Most people who are pensioners coming out from African continent, out of African countries, are largely from the public sector. And many of them actually get the pensions from the limited tax revenues. So there is a real imbalance here. And with fiscal constraints getting more acute, there is a challenge as to how to pay for these generous pensions. So now I would like to pivot back to the focus of this forum, which is on COVID. But instead of talking about impacts of COVID, I want to talk about how it is different to the 2008 financial crisis. Now, in 2008, the developed world was more acute than developing economies, in large part because those economies had a much higher equity exposure. OECD estimates that there was almost a 23% drop in values of private funds. The impact not necessarily only on DC schemes, but DB schemes were also affected, but they took longer to show up on DB schemes. And it happened to discount rates that increase the actuarial liabilities of DB schemes. With DC schemes, the impact is more immediate and it's more visible right away. Contribution density, so how to continue contributing throughout the year and throughout their life, that increased because of unemployment that was happening around the globe. And the protests that we saw in Chile, Greece, the reversals that we saw in Europe can be traced back to dissatisfaction around the adequacy of pension systems, whose seeds had started in the 2008 crisis. So this time around, first, the current crisis is more global, and it's also human in the sense that it affects the real sector. It affects labor markets a lot more deeply. Global debt levels are at a record high. We have recent data which shows that some countries have debt levels as high as 170% of GDP in Africa, and they've been growing very rapidly between 2010 to 2018. Aging very rapidly, and even in young economies. And pension assets have doubled in size. So there's just a lot more at stake this time around. The good news, how 2008, more of the elderly in the continent are protected, largely because of the expansion of social pensions. DC funds after 2008 moved to life cycle investment strategies, which has once again helped reduce the volatility for those close to retirement. And regulation and supervision has definitely strengthened since 2008. Now, the World Bank tracked what countries were doing during COVID-19, and the waiving of the contributions was the most common global pension policy measure. And you can see there are quite a few others, but waiving of the contributions was more common, and allowing early access to withdrawals was common in a couple of countries in Africa as well. And these kinds of measures they differ based on the kind of scheme you have: DC, DB, hybrid, social pension. I'll not details. I'm sure we can talk more about it in the panel discussion. So to end, I'd like to talk about 5 key lessons that have emerged since COVID-19 and some policy recommendations. The lesson 1 is the really critical need to set up post-crisis compensatory mechanisms. The region does face systemic challenges with regard to pension systems, which I alluded to. Time in hand. There's time in hand to prepare for an aging population. That would require innovation on voluntary schemes, and that innovation has to come from within the region and developing economies, because the labor markets of these places are very different from that of Eastern European economies. There needs to be a policy push to make existing schemes fairer. That means allowing for repayment of past unpaid contributions, the contribution holidays that were given during COVID, making parametric reforms to existing schemes. But a more salient point is that they need to prepare for aging more broadly. Pensions is just one component that an elderly population needs, and it's time to broaden the narrative around preparedness with aging, because systems are unlikely to meet the needs of an elderly population. So they need to focus more broadly. There needs to be, lesson 2 is a shift to electronic payments and a focus on service delivery and improved interoperability across different data systems. The inability to reach informal sector innovation across multiple governments, and we have multiple good case studies of, and Rwanda is again a great example of how changes were made so that e-payments could be made to the elderly to avoid contagiousness because of the disease. And more needs to be done in terms of identifying associations, cooperatives, and aggregators to connect with the informal sector. We should not lose the momentum and the innovation that was sparked during COVID. These have already started creating databases for informal sector workers. India, example, with their eShram portal, and they've already registered multiple individuals by providing minimum incentives on social security. And going forward, security institutions can play one of interoperability. Lesson 3 is not directly related to traditional pension system advice, but is increasingly important because long-term care and rehabilitation services emerged as core during COVID-19. And timely preparation from young families in Africa can allow systems to be put in place in a cost-effective manner. And we need to realize that pension systems might not be able to meet all of these needs, so setting in place these alternate ways to take care of elderly will be important going forward. Lesson 4, we're going to talk about through is to alleviate the impact of the decline in financial markets and to do opportunities. Relative to the 2008 crisis, the impact on financial markets and the rebound was actually quick this time, but lessons from 2008 remain valid even now. As global funds increasingly look at investing opportunities, pension funds in Africa can really seize this moment and make informed choices which are both and environmentally sustainable. Lastly, the tricky balance around meeting today's needs versus tomorrow, which was at the center of policy debates during COVID, on that front, there's really no easy solution. But complacency is not the answer. contributions, allowing for early withdrawals, these might have been absolutely necessary in the aftermath of the crisis when people were really struggling. As countries chart a path to recovery, policymakers should consider counter reforms so that the sustainability of pension systems is not hampered. So with that, I would like to close with a quote that I'm a big fan of in the context of pension systems. Pension systems often pass on their challenges to new regulators, institutions, and so on. But with the right mix of policies, institutions, people, and product, there is hope to make a difference and chart a new way forward. And on that note, I wish all of you an engaging and fruitful 2 days of discussion, both on stage and off stage. Thank you, everyone.
Thank you very much for a great presentation and for sharing with us the realities of the performance of the pension sector. So one more time, I am honored to invite Dr. Omar for moderating the next panel session. You're welcome, Vice Chair.
Well, good morning once again. From the program, I've seen that we're really terribly run out of time. This program has been scheduled to finish at 10:30, including the Q&A. So we just have like 19 minutes. And indeed, for the panel discussion, which is 30 minutes, we have 4 minutes left. So probably I'll ask all the panelists one question each, and that's it will close. So I will invite Himashi to come back to the high table, the discussion area. Olano and Martin, please. Thank you. Martin is the CEO of the Ugandan pension regulator, and Olano heads the South African pension sector. So he's with the Retirement Fund Supervision in the Financial Sector Conduct Authority of South Africa, Mr. Olano. And as I mentioned, Mr. Martin is the CEO of the Uganda Retirement Benefits Regulatory Authority. So you are most welcome. Well done. Just some few questions, I think, to discuss, just to give more flesh to what Himashi just presented. I will start with Himashi. Given what you just showed us on the crisis, both 2008 financial crisis and the pandemic now, what advice would you give to African countries to adopt in terms of coming up with an effective pension system?
Mm-hmm. Thanks a lot, and glad to be here joining this esteemed panelist and sir. So I think, like I said, the impact this time around has been on both financial and labor markets. I think the challenge with limited coverage in Africa has come out very strongly, as the minister also mentioned. And aside from that, a new challenge that is emerging is the inflationary concerns. I would argue that more than the impact that COVID had on financial markets, there's now a risk of the inflationary concerns that are emerging. Real returns in pension funds within Africa were already starting to sort of go down. And now with inflation concerns, there's a risk that those can even turn out to be negative. So really need to focus on the returns, looking for new opportunities, getting on getting on this ESG, looking for impact investing opportunities is going to be very important. I was just talking to someone in the morning and saying, now you go into a room and you never have to say the full form of ESG, because everyone knows it. It is becoming mainstream, and that really needs to be something that African pension funds need to get on. Just to cite some numbers, in 2020, the US issued limited bonds on marked bonds or green bonds on $1 trillion, and out of that, only 0.1% were subscribed by African economies. So there's really a lot of scope here. And third point being on coverage. The solution to coverage expansion in voluntary schemes will need to come from the region. And we're already seeing great examples from Ejoheza, there's examples in Kenya, a lot of in Namibia, Nigeria, a lot of innovation happening, and there's a need for regional cooperation to learn from each other and sort of learn from the innovation that's happening, experimentation, and scale up these programs. That's all from my end.
Yeah, thank you. Olano, any chip on this?
Yes, thank you, Doctor.
Okay.
Good morning, everyone, and thank you so much for having South Africa. So just to give you a perspective from South Africa, so in 2020 we ran a survey directly asking funds how actually they have fared during COVID. And the survey revealed that, nearly 50% of the funds were approached by either the employer or employee or both asking for some contribution relief. And the survey went further to show that most of the pain was felt in the manufacturing and services sector, so the hospitality sector. And it's interesting because I was sitting in the breakfast hall and I see these lovely people serving us, and you realize that a few months ago they wouldn't be here, right, because of COVID. And so it's quite interesting what also Ms. Jane is saying around the impact being real this time. So we saw a decline in membership from 2020 to 2021 of around 1 million members. And remember, when I lose 1 million members, it also has an effect on my levies, right? so you get worried. And at some point, and my industry is here, asked for a levy holiday, and I said, hell no, that's not going to happen, right? Because then it means you're cutting down on my salary too. But the point is that some of us have been lucky. There are people who have lost their jobs out there. There are people who have had to live with lower salaries, and so it has been quite tough. Thank you, Doctor.
Okay. Mr. Martin, I don't know whether you have sensed that there has been some sort of impact of the pandemic on African pension systems. So do you think that there are African countries that have been more affected than others, and perhaps due to the number of cases they recorded?
Thank you. Thank you. Good morning, ladies and gentlemen. First, it's a pleasure and opportunity to me to share with you and to be at this conference, and I want to congratulate the government of Rwanda through the National Bank of Rwanda and, of course, the FSD Africa for supporting this cause. The experiences and the circumstances that have been shared with the colleagues on this side are not any different, but the few things that have happened, apart from the reduction of contributors, what happened on our side, I wouldn't say that contributors significantly reduced, but there was a serious problem of suspending contributions, which was shared. And amongst that were workers from the education sector that was not very active for almost 1.5 years, the manufacturing side and the hospitality side. So there are quite a number of employees there who lost jobs. Fortunately, there's a recovery. They're now back. And what has been lost is the suspended contributions. That one has been lost for sure. And of course, that one is affecting the adequacy levels. And of course, the beauty is that from the investment side, the concentration was in asset classes that were still very attractive. The nature of our market is that there is significant investment in government securities. And in a crisis like this, governments, I think, concentrate more on the domestic market, which is an advantage to the pension side because the rates will be very attractive, but it's a disadvantage on the fiscal sustainability side, on the side of government. But now that is something that has to be run. But by and large, there was a significant impact on that side. But there are positives. I think what came out very clear from our side is that there's the timing of the COVID-19 came at a time when we are amending the act of one of our largest funds, that's the NSSF fund. And because of the need for cash financing or bridging financing, there was pressure for midterm access, which was strongly against, because that was drawing down the funds and, of course, impairing the adequacy focus. But we took it from the positive side, because at least it's very clear now that there's a clear distinction between saving for retirement and saving for any other eventualities. So what is the policy discussion now? As we begin to save, can you clearly separate from the onset? Because if you continue to accumulate those funds and then allow leakages of this kind, then the entire long-term objective is going to be lost. The second opportunity we learned is that while we were discouraging people to get these funds, there was uncertainty whether members' funds was actually there. So that disbelief that actually this money is not there, it is being wasted or used by government, and these funds don't have this money. So it's a test that has been made, and some payments have been made. And again, the beauty is that those who have tested for the money, some have accessed it through this door, and the next door, they are depositing it back. So there's that trust that has been built. But of course, the other fundamental thing that is coming out is that the use of funds, those who accessed it, some who decided to use it, wasted it. It's also a lesson. Probably it's something that we can learn from. But by and large, I would say that the experiences that we've got, which are probably not very different, just inform us on how do we expand coverage, because the covered population is still very small, but then we needed to look into that population that is not covered. But also the timing is very critical, is that given this transformation or appetite for, when people have now understood the rationale for saving for retirement, I think it's the best opportunity to strike and spread the gospel more, popularize the message of saving for retirement, but also clearly separate that saving for retirement is for long term, and it has to be left intact. But if there's any other product that can come into play, can serve a short-term purpose. The discussion, of course, which I want to leave to the audience before us, I don't know whether it is very prudent for the pension funds to also administer short-term products for short-term eventualities. I think it's something that could be controversial or create some distortion, but that is something that we can talk about and think and elaborate more. Thank you.
Okay, actually, I'm very much worried about the timing, so I'll do something. Just cut the timing, so we just come around very short answers on how do you think in Africa we can build sustainable pension systems that would have enough shock absorbers for future crisis. So maybe this, your thoughts on that, and then we'll go to the floor for Q&A.
So maybe I can start. I think a big part of it is also interoperability across systems, and I'm going to talk about this in just a second. So the one thing that we saw since COVID, and this has actually been happening for the last few years, is a more fluid and diverse labor market. So systems were created thinking that, once you join an employer, you're going to stay with the employer, deductions are taken out from that employer, and so on. So not just informal economy, but even for formal labor markets, that assumption has been challenged. So say people who lost jobs during COVID-19, if after a gap of 2 or 3 months, they changed employers, or there was a lot of frequent transitions, our service delivery systems and the way to sort of collect contributions in social security institutions needs to be adaptable and agile enough to make it easy for people to start contributing even if they've just moved within months. And we need to be ready for this future world of work, because this is here to stay. So that I would say, in a nutshell, is something to really focus on, learning lessons from COVID, but then anticipating this going forward.
Okay. Sure, thanks, Dr. Farouk. So I'll do my best to be brief, because this is a passionate area of mine. So there are 2 important and probably positive lessons for me out of COVID. One, most of us never thought we would live through a pandemic. right? And related to that is the positive realization that we are all going to face a rainy day at some point in our lives. And so the need to save for emergency and for that rainy day has become important. In South Africa, had you asked society pre-COVID how would they perceive saving for a rainy day, the response would have been negative. And by the way, we have one of the lowest household saving rate in the world. If you run the same survey and question post-COVID, you will see that most people now appreciate the need to save for a rainy day. And my sense is that our pension system is going to change. And if you look at the youth and the fact that Africa has got a youthful society, I think we are going to need to design our pension system in such a way that it caters for both long-term saving and actually short-term saving. And this is the point which also the Minister of Pensions in the UK was making, that with your youth, it's very difficult for them to think about retirement, right? Because you are young. What's on your mind is, getting your deposit for a house, for a car, etc. And so how do you get them to be interested in retirement savings? And so I think if you find a clever way to bring the two together using a retirement fund, you'd probably end up with a better outcome. Thank you, Doctor.
Sustainability, I would say, I think the focus has been more on the fundamentals where we're using the mandatory contributions, where the voluntary window has not significantly grown. I think largely, apart from a case here in Rwanda, which has been successful because of the enhancement or supplement of one in one or another. But I think the youth that my colleague has talked about, can we leverage on how they behave in society? I think we may need to think of other methods of tapping into their lifestyle and making contribution into them. There could be some work that is available that can be done, but I strongly think that the population have spent money. How can we have mechanisms to tap into that behavioral characteristics? Can we have a mechanism where if I spend money, I can be indirectly helped to save some money for my retirement, not directly? If you have such mechanisms, there's so many around which I think can be used, and we can create that buffer of some sort. The second one is we have schemes in our market which allow access from one, if you move from one employer to another. Can we also have ways of preserving that or stopping that? It's a very difficult challenge. You'll face a lot of resistance, but that's one way of preserving the funds and to ensure that we create a pool that can help that person in the retirement time. And of course, the third one, the costs, scheme operational costs. I think that's still a challenge which we need to look into. But how do we enforce it as regulators? Well, being mindful of not crowding out the service providers, because you can be so tight and at the end of it, you lose out on the professional input to sustain the growth of that. I believe that we could be able to sustain that in the long run. I'm not very passionate about the short-term initiatives because I strongly don't believe that if you begin to combine a pension fund to deal with both short and long-term, you may have a few challenges. That's my belief, but it's something we can talk about. Thank you.
Okay. So thank you very much, all of you. But I would want you to please still remain there because I expect some maybe 3 questions only. Okay, we'll take one there. Okay, apparently only 3 hands. So, so the first hand. Yeah. Okay. Okay.
Yes, good morning, everybody. My name is Trisha Delu from the Financial Services Commission of Mauritius. Thank you very much for this interesting discussion. And with regards to a specific matter, I would like to have the views, the opinion of each of the panelists right now regarding our experience with the COVID-19, and now we have the Ukraine war and the inflationary concerns, and also ahead of us maybe a huge food crisis ahead. So I would like to get your views with regards to policies and laws currently regulating pensions. Would you personally right now encourage amendments to laws and pension rules in order to have people have closer access, as in, have direct access to their pots in situations of crisis, because we can foresee that it's not the end of crisis right now, and we are about to expect more ahead. So would you, as regulators, encourage changes to the laws to make it more accessible for members to have fast access to the pension pot, maybe with a certain limit, or just reserve it strictly for retirement purposes? Thank you.
Okay, so we start from Olano this way.
Can I take that one, Dr.? So an excellent question. So in South Africa, we are thinking of what we call a two-pot system. So you will be required to contribute into what we would call your retirement pot, which will be preserved. So it starts addressing Mr. Martin's concern around preservation, which means you'll only be able to access that money at retirement. And a third you can access before retirement. We haven't allowed early access at this stage, and because South Africa has a system on the extreme, which is that if you change jobs, you can literally take your entire benefit, and that's the preservation point, Mr. Martin. So we're sitting with very low replacement ratios. And the other extreme is having a retirement system where you can't access a cent until retirement. The challenge with extremes, they always buckle under pressure, right? And you have seen it with Chile, where they've had this, extreme and had to end up allowing some access. And there's a reality. When people are suffering and are losing their jobs, it's very hard for government to turn their eyes away, right? And so that's why we think if you use the existing vehicle, which is a retirement fund, and just redesign it to enable some kind of saving for the short term, while ensuring that there's still a pot for retirement, then you might actually end up with a better outcome. And in fact, the research in South Africa from our actuaries has indicated that if we do that, we will end up with a much better system and outcomes for individuals.
Okay, Mr. Martin?
First and foremost, I don't think it's a very good idea. However, COVID has taught us that it is a challenge before us. But we've taken it as a learning lesson. Can we think of separating this? If you want to access some money out of it, can it be limited to that, probably the employee contribution, if there's any form of employee contribution, and then preserve the employer contribution? But of course, the most critical one is, it is also an opportunity to tell the person out there who is agitating for accessing this money. You only save, in our country, the employee saves only 5% out of your monthly salary. So you retain quite a big amount, 95%. So can we begin the discussion of probably creating another pot for you to address such future demands? Because the moment you allow this access, this COVID, we don't know what will happen next. We may be turning these pension funds into banks, and there's a big risk there. Thank you.
So I'd like to make 2 points here. First, this early access, first of all, tends to apply with DC schemes where you have individual accounts. I probably know of only one country case, Vietnam, where they allow early access in a DB scheme. They allowed it temporarily, and they've since always tried to cut it down, but it's a political no-no. So it's really hard once you put something in a law to turn back. I don't want to repeat what my colleagues have already said, but it's important that if early withdrawals are allowed, they need to be time-bound, and there needs to be policy clarity on what after, so that it's not just something which continues and then becomes entrenched in the system, and then it becomes part of a history lesson that this happened and this is why because we see this in global pension landscapes. Something happened back in the day, and then there was no policy reversal. Second thing, oftentimes when early withdrawals happen, they happen because there does not exist other systems in place. So people are withdrawing because there's no unemployment protection that's in place. People are withdrawing because there's no childcare benefit and they need that money instantly. And so as policymakers, there's a need to figure out what is it that is missing and why is it that pension systems are being compromised. The answer is not make pension systems address unemployment, childcare, and all this. So that policy clarity is very important.
Well, I think perhaps before the question, just to add, we have a peculiar system in Nigeria, in the sense that right from the conception of the reforms, we allowed voluntary contributions. So we call them additional voluntary contribution, which you can access anytime you wish to. So this is a mandatory contribution rate, which you contribute, and you don't touch that unless for pension. If you want, you can make this additional contribution. However, if you touch the amount before 5 years of making the contribution, it will be taxed up to 10%. And if you allow it for 5 years and you access it after 5 years, no tax. You can take the whole of that. And if you are accessing for pension and the contribution is less than 5 years, still no tax, since you are keeping everything in the fund and you are programming it, or you are buying a life annuity with it as pension. So no tax. So that's what we have done on our system, and I think perhaps it's working. Thank you. So the second question.
Thank you so much. I'm Erna Modula from Namibia, Namfisa. So I wanted to just latch on to what Tricia said. I told her she must not ask 20 questions because I told Tricia to ask 20 questions only. So my question really is on preservation. And in Namibia last year, we have passed a new law. And as part of subordinate legislation, we have sort of drafted a regulation around compulsory preservations. And we were very brave and we put it at 75 versus 25. And lo and behold, there's a complete standstill from policymakers, political space, and it was a very dangerous time for us as regulators. My question really is, so what is the sort of balance that one must look at? I hear you on the two-pot system, but what is the sort of balance that one must look at? What is allowable? And in terms of the other things, for example, the Nigeria example, why is it that we want to make provision under a pension fund space for additional savings? I mean, there's so many vehicles out in the market. Why is it that employees and populace can't make use of what the financial sector is offering? So my question really is around the balance. What is the thing that we can live with? Thank you.
Thank you very much. Before the panelists answer to that, I would like to remind everyone that Slido is still available for questions and suggestions. Just to better manage your time, if you have a question and the mic doesn't get to you, please do share your question on Slido. We'll read it and find some time to answer it. Thank you.
Okay, we'll start with Martin.
Yeah, thank you. My understanding of the question is the balance between what you would want to save for the voluntary side, sorry, for the retirement side, and then the addition of it. How do you strike the balance? And my response is it's simple. For the retirement is known by law, and of course your aspiration, how you want to live in retirement. So you define it by enhancing it. The additional you make you know how you want to, I mean, you anticipate what kind of challenges you are likely to face. If you think it's another COVID, I pray it's not. I mean, any other or whatever health challenge that is likely to happen before then. So it is you to enhance that. You define how much percentage you want to contribute. The only way it can be limited if there are any tax incentives or not. If there are tax incentives that constrain you on that side, then you can go ahead with it. But if there's a standard contribution that has been set and then you go ahead and start to break it down, use this for this particular purpose and also use this for another purpose, I think it can be a bit, in my opinion, you are supposed to determine your appetite and how much you are supposed to sacrifice. But the message I normally send people out there is that the one for mandatory contribution is very little, because the principle of saving for retirement, it is small amounts, consistent and long term. So if it's small amounts, the balance you're remaining with is quite a substantial amount. Determine how much you can add more on that. But the cap could be defined from the tax incentive like Nigeria has done, but we can learn from other experiences.
Yeah,
Okay.
So my dear, your question, why aren't people using the private sector? It's behavior, right? So it's behavioral economics. People suffer from inertia. And so how do you deal with that? You need to find mechanisms, whether you use what they call defaults, and defaults can be quite effective. I mean, the irony with this is that the very same savings people want to access, they have them because they've been compelled to have them, right? I mean, that's the irony of it. And so my philosophy is that use the same vehicle to still subtly nudge them to save for an emergency, right? Because you've got the vehicle, see how you can design it to also help them to do the right thing. Quickly, on your first issue around preservation, so pensions can be political, right? So in South Africa and the industries here, we have spent literally 15 years trying to put in place a national social security fund. So we don't have Pillar 2 in South Africa. We rely on the quasi-voluntary system. We had to bargain hard with the unions because they were not comfortable with mandatory preservation. And so we said, here is a good crisis we are not going to waste. Because the unions wanted some early access to relieve the pressure on workers, we said we will give some of that to you on the understanding that you will agree to preservation. Because the major shortcoming in our system is the lack of preservation. So there are politics in some of these issues, but as I said, the numbers show that we will be better off and individuals will be better off with a two-part system.
So maybe quickly, see, on the preservation question, so if I was to ask everyone in this room what's a good ratio, I'm sure I'm going to get different answers from everyone, and probably two answers from the same person as well could be possible. Yes. So it's a difficult question. Oftentimes, if policymakers are asking us for guidance, the one best option for us is look at comparator countries and share what has been provided. But if you do want to provide flexibility in choice, maybe something that can be done is say 60%, you decide how much has to go in the long term. So if it's a pension scheme and you're comfortable with 60%, which I believe is the UK Nest scheme, and for the rest, you leave the choice to the individual. You can take up to 40% in a short-term account, or you can do 10%, so you give them that range. But that really just also depends on the social contract in the country. In countries where people are used to that sort of flexibility, this kind of an approach could work. On the question of what people invest, a lot of it also depends on what else exists and what people trust. In a lot of African economies, pension funds, the government logo sometimes with schemes, that evokes trust. And so contexts differ quite a bit. And maybe there are schemes out there, but they don't have the same level of trust, and that's why people prefer the pension funds.
Yeah. Okay, the last question. I don't think I need to bother you with what we do in Nigeria on this.
My question, or shall I call it, shall I say comment, is on very similar lines to the previous two, and I think this is a conversation that we probably need to have over the next 2 days, because I feel we need to ask the question, how well are our existing pension systems resonating with our people? And do they really, is there a disconnect between what we are looking to provide and what they need? Now, we have done a lot of research in Kenya, and I believe the findings will be no different if this were done in the rest of Africa. And the overwhelming message that we are getting is, yes, saving for retirement is important for us, but it is not our most important priority. We have other more competing, more pressing priorities, such as educating our children, features very, very highly. The emergency savings, especially post-COVID, has become extremely important. And I think we should actually seriously ask the question, can we expand our existing pension systems to accommodate wider savings priorities? Because I believe we will then make our voluntary pension systems more attractive, more appealing. And the fact that pension systems are governed, if we can, and hopefully well governed in most countries, we can then use that to expand the savings priorities, but importantly get people into the habit of saving. And let's recognize that our fiscal space is very limited to have, other than in South Africa and maybe Mauritius, to have these unemployment benefits, other benefits like for child care and the like. If we can get our people to take self-charge, I believe this will happen. Because the other message is that people are saving, but they are not necessarily prioritizing themselves. Because we've got huge cooperatives and SACCOs, saving systems in many parts of Africa. I believe that we need to think outside the box. And I feel that the regulators, policymakers need to come in and provide that flexibility to pension providers to widen the savings. And I think the South African two-pot system is really a step in the right direction.
So I don't think this is a question, unless if someone has any comments to make on this.
It's a positive comment.
Okay, so yeah, so I think this session comes to an end, and I thank you all for listening. Thank you very much for sharing your thoughts on these issues.
Thank you very much, our dear panelists. Another round of applause as they make their way back to their seats. Before we take the first break of the day, we're going to have two more, I would say, brief activities. The first one is a great one to witness. We are going to witness the sign-off of an MOU between FSD Africa and the Africa Pensions Supervisors Forum. And before we go for our break, we're going to have a group photo. So for FSD Africa, allow me to welcome Dr. Evans Osano for the sign-off of this MOU. Thank you very much. And on the side of the Africa Pension Supervisors Forum, please welcome Dr. Shem Aume. You're welcome on stage, Dr. Shem. And as Dr. Shem makes his way to the stage, I will also call on the witnesses of this sign-off. Mr. Nelson from FSD Africa, please, you're welcome on stage to witness the sign-off of this MOU. Again, to witness the sign-off of this MOU, I would like to welcome Dr. Farouk, the Vice Chair of the APSF, as a witness. You're welcome, Dr. Farouk. Thank you very much. A big round of applause to Dr. Shem as he makes his way on stage. Sign-off of this MOU covers key areas of partnership between FSD Africa and the APSF. The areas of collaboration go on research, collaboration, knowledge exchange, and capacity building. So a big round of applause to Dr. Shem and Dr. Evans as the sign-off this MOU. Thank you very much. The photographer's team is going to help us take memories of this great event. As it happens, again, I will remind everyone that this MOU covers areas of collaboration between FSD Africa and APSF around research, capacity building, and developing a legal framework for the forum. Please, let's rise for a picture. Please, let's give a big round of applause. Thank you very much. Thank you. So let's hear from the FSD Africa. He wants to make a few remarks before we take our break.
Yeah, so I think this is a very exciting journey for us, and I just also want to use this opportunity in remembrance of our late friend and brother, Dr. Nzomo Mutuku, but Mr. Nzomo Mutuku. We had this conversation with him a couple of years ago, I think in 2019, and he challenged me and said, you have a program supporting capital markets regulators, securities markets regulators. We need something for the pension supervisors. You cannot have a market without investors, isn't it? And so I challenged him and I said, okay, we are happy to partner in this journey, but can you assure me that we can get the buy-in of the other regulators across the continent? And he said, yes, I'll be able to do that. And so today, I think if Mr. Mutuku was here, he could have been very proud of this moment. And I look forward, as FSD Africa and my colleagues, to have had this privilege to work with him and also to have this opportunity to work with the other pension regulators or supervisors across the continent. So the MOU we have signed today is going to cover a few items, as it has been indicated. But I think for me, the most important thing is that we've been able to start this journey together. So the first part of the support we'll provide through this MOU is around sustainable investments. You know, in the year 2050, we heard that there will be about 2.5 billion Africans. About one quarter of everybody on the planet will be African. We've heard about the young age. The median age in Africa is about 19 years, even not 19.7 years. It's going to remain like that for some time. We've heard about a crisis, the COVID crisis. We came from the financial crisis, COVID crisis. I think now many of us are tired about COVID, but we are now facing inflationary crisis. We heard about food crisis, energy crisis, the war in Ukraine, inflationary pressures. We're in an environment where today, if you look at the Eurobond yields, they are higher than local currency yields. What does that mean for African sovereigns that are looking to raise money? Will there be crowding out effect or not? And then, of course, there are two major crises that we have not talked about, and I think it's quite tiring. So we talk about the climate crisis. I'm sure many of you are watching the news today. You'll probably have seen the heat waves. In the UK, in France, temperatures rising up to 40 degrees. There is a heat wave in China. There have been several heat waves in the US. We are truly living in a very uncharted territory. So alongside the climate crisis, we also have what we call the biodiversity crisis as well. And Africa is in the middle of all that. So as we talk about preserving pensions, as we talk about increasing coverage, you know, we have to take into account that kind of context, and therefore, what will be the role of, pension funds? And I liked a lot, the challenge we got from Sandeep Rechura about thinking a bit broadly. And maybe one word I could leave around that for at least on the investment side of the assets that we are mobilizing, hopefully at a larger scale as we increase the coverage, is the issue of transitioning. Many of us are used to the traditional approach to investment, which is basically, I want to get the highest risk-adjusted return. How can we transition towards something like responsible investment, where I think a lot of pension funds are progressing that way, where we say, we don't want to do any harm. We don't want to add the harm that is existing, but we also want to mitigate ESG risks. That is responsible investment. So I want to hopefully to see that transition, happening, but not just stopping there, but moving also to sustainable investment, where we also say we want to contribute. We want to contribute to providing or benefiting the societies in which we live, and hopefully over time also towards an impact, a kind of investment where we'll say we also want to create solutions for the society. So that's the journey that we hope to work alongside the Africa Pensions Supervisors Forum, and we're also hoping to work very closely with the forum to support the creation of a secretariat that will support the galvanizing of all these great ideas that we have across the continent, and ensure that those learnings that we've been told about, that we should share information and knowledge, happens. So thank you very much. That's really what I have to say for now. Thank you very much.
I hope the MC is going to allow me to just make 2 comments after Evans. And this is on behalf of the chair and through our vice chairman, Dr. Farouk, just to thank FSD Africa for this particular support. It's a 4-year program. They are supporting APSF directly, and they are also supporting members of APSF, individual countries, and for which those particular MOUs will be individually signed by those countries. What they are doing for us, they are sponsoring this particular conference of ours on an annual basis, I think for the next 4 years. I don't know how many years are remaining, but we started in 2019. and they have whetted our appetite, and we want to urge them to remain our strong partners and work with us the journey on pensions. We have just begun discussing some of those challenges, and we want to urge them not to run away. Please hold our hands as we work on this one together, and thank you very much. And secondly, we are very thankful for condoling with us, and we shall take these messages home to Mr. Nzomo's family and to the family of RBA and to the family of stakeholders that we have back home. All of us are greatly touched. Some of our stakeholders are here with us, and they are receiving those condolences directly. Thank you very much.
Thank you very much, APSF and FSD Africa, for this great event and for this great collaboration that we just witnessed. Before we take the first break of the day, I kindly request you that we take a group photo. We're going to leverage on these stairs to be very well arranged. The photographer's team is going to help us with arrangements. Please, let's stand in for a group photo. Thank you. We're going to have a 15 minutes break before we resume today's program. Start our session. Thank you very much. And I would remind Here, please give and so there's a so far Slido, please keep them coming in, such as the conference cannot be at a better time, and another says that African pension schemes need to be more adaptive to the shocks than they are. We also through the question from Nancy Akaliza that goes, that is there a return to cover for pension contribution that help cover for inflation and any factors that devalue the real return having saved for the 5 years, given the example of Nigeria? I think to sort of call on this question, especially on the next presentation, we'll still have Dr. Umar come. So and sections. Another dinner with is scheduled this evening, not tomorrow. It's this evening, and we'll keep details of this dinner, but please keep that is planned for this evening. Now, presentations and the theme of this second session is the future of in Africa. In Africa. You're welcome, Omar.
Okay. Can I please have the slide? Okay, next slide, please. Okay, so, the issues that were put together for me to talk about were really so much. I felt each one of them should be an independent topic because I'm looking at the pension landscape in Africa, shift from defined benefits to defined contribution. That's one issue. The role of private pension to complement public pension in Africa. That's another issue to address, which I believe is a topic of its own. Efficient mobilization of long-term savings to finance development projects is another issue to address under this topic, and then give an outlook for the pension sector. So, some couple of slides. I may not go into detail, largely because when you look at the African continent, one of the most important issues that is missing is data on the way we run things. And the pension industry is not really an exception in this effect. So you see me driving most of my case studies from Nigeria because that's what I know best and that's what is more available to me. But I hope what I'm going to say on these issues regarding Nigeria are going to ginger some thoughts in us, and then we address them when we have the panel later after my presentation. So as a background, when you look at the issue of pension in Africa, I believe it cannot come at a better time because of the evolution of pension schemes in all over Africa. We mostly, as discussed, as we all know, try to cover, people that are working in the formal sector. But people working in the formal sector in Africa, when you compare them with the general working population, it's just really, although significant, but significant negligible percentage. Consider a country like Nigeria, for example, with a working population of almost 100 million people, and only about 8 million work in the public sector, in the formal sector, both public and private. So just about 8% of the working population. So issue of coverage is such an important issue that, to talk about future pension, you have to come up with mechanisms and ways in which you address, how you cover the informal sector, particularly, and those that have no pension at all. Most of the pensions, as we have seen, are public in the sense that the public sector started pensions, and then the private sector come along. In most of African countries, it's still that public sector pension. The private sector really coverage is very, very low. And I don't have the figures on top of my head, but for Nigeria, really, when we started our reforms in 2004, coverage was just 1.3%. That means in every 1,000, we only have 13 people that have pension in the private sector. So I think one of the most important issues is that, yes, we have these pension systems, and these pension systems are not good enough to provide old age, a sustainable finance for the citizens of African countries. So our only option is to introduce schemes that will provide opportunities for people that are not under the schemes to also participate and save towards having, a sustainable old age income. And then we try to address three fundamental issues: the issue of sustainability, the issue of affordability, and the issue of adequacy. And I believe any pension system that does not have these three fundamentals in place, this is so much work to do. In Nigeria, for example, we introduced the macro pension, and it was launched by Mr. President and Commander-in-Chief of the Armed Forces of the Federal Republic in March of that year. And so far we have accumulated about 275 million naira, which is just about less than $1 million. Unfortunately, that's one of the fundamental problems that we need to resolve in Africa about currency exchanges. Most of us do not have stable currencies when we compare with, dollars and other strong foreign currencies. So, but indeed, to address these issues, as I said, countries are adopting the funded schemes. Funded schemes, largely the contributory pension scheme. The DC schemes give opportunity for actually, countries to expand coverage on voluntary basis. What we have done in Nigeria and what is done elsewhere is the same. People participate in the informal sector voluntarily because you can't force them. You can only incentivize. And so you can't do that with the DC scheme, because the DC scheme, that means somebody has to fund it. Sorry, with the DB scheme. With the DB scheme, somebody has to fund. And I don't think governments in Africa generally have the financial strength to shoulder such, pension schemes where, everything is shouldered by the government, the so-called Pillar Zero, So it's a bit difficult, but indeed when you look at what we are doing all over Africa, you could see that the pension assets are growing. And I think when you compare as a percentage with GDP, Namibia has like the highest, then followed by South Africa. And Nigeria owns a very large fund, about 34 billion, probably second to South Africa. But when you compare with the GDP of the biggest economy in Africa, is still too low, about just 9%. So, but every one of us is doing something, and I believe that is the best way for us to go towards achieving two things. Achieving this old age, or securing old age, income for everybody in our countries, and then whatever we accumulate, we use that to support economic development in our various countries. In terms of the second issue that I mentioned, you could see the asset allocations in some 4 countries, particularly Uganda, largely more fixed income, Nigeria also, and I mean, wherever you go apart from South Africa, that's why you have more listed equities than fixed income. But why do we go into the fixed equities if the equity markets are not fully developed to support the amount of money that is being accumulated in the pension system? So that is one other issue that, that needs our concern and our focus as pension regulators. Do we sit back and wait for the capital markets to develop themselves, then we invest? Or is there any way we could collaborate with other, financial sector players, like the central banks, the stock exchanges, and so on, to develop the necessary products that will support the development of our various economies with the little money that we are contributing under the pension systems? So, for us to move forward, indeed, it is imperative for African countries to rethink coverage, how we invest, and then the pension structure of the pension arrangements in order to address the issue of inclusion of the private and informal sectors, prompt payment of retirement benefits, and then using these pension funds for social economic development, in the continent. So largely, as I mentioned, the landscape of the pension sector is defined benefit and provided by governments. And this excludes the private sector generally, and particularly the informal sector. However, the defined benefits are no longer sustainable. If you look at what people are doing, the need for money is increasing. And pension alone cannot in any way provide solutions to all the financial needs of citizens in our countries. Now, if we can ensure that when people retire, they can feed, they can have access to quality health care, and their children can have quality education, then most of the problems, other problems are secondary. And so the defined benefit scheme cannot really provide this. Most of the governments are really living hand to mouth, not enough finances for the governments to provide all the social infrastructure that is needed to support this comfortable living by citizens. So the best way is for us to, all be part of being responsible. If you look at, say, the big countries, they have effective tax systems, but because these tax systems can collect enough money to support provision of all this social infrastructure. In Africa, it's different. Governments are struggling to even build roads, to build schools and quality hospitals. So, the requirement for infrastructure spending is huge. And when you look at the responsibilities that are associated with old age, finances, then we cannot just do it. However, if we can introduce some element of contribution where people contribute no matter how little, then we see how we design the systems to support providing this social infrastructure that will guarantee good living for everybody. I remember when we started in Nigeria in 2004, the pension reforms, we started from scratch. But the little we have collected from the 9 out of the 100 million working population is, as at the end of April, valued at $34 billion US. So you could see that actually with little effort, so much can be done. And we took a decision that this money should not go outside, no offshore investments. We have to keep it in Nigeria and invest in developing our local infrastructure, develop the local economy. So we have seen, as we have shown earlier, almost about 70% of the monies are in fixed income securities. Why fixed income? Because that's the only thing that could guarantee, number one, the safety of the pension assets, and then provide the government with the opportunity to come up with some developmental instruments in terms of bonds and sukuk that will help in building some basic infrastructure for the country. So we'll continue to do that until we feel we are comfortable enough to start moving outside, then we'll go. Indeed, we are working on so much on that, which perhaps we'll talk on later. We'll look at the outlook. So definitely, as I mentioned, we have to start to think of funded schemes, not just unfunded schemes. And so when you look at what many African countries have been doing, we have been moving, gravitating towards these defined contribution schemes, as I mentioned, and so far so good. With those countries that adopted, things are moving, we are building the asset, but gradual, but surely. And I believe with organizations like the Africa Supervisors Pension Forum, will start to think of ways of coming with some Pan-African projects that would assist in building African economies in general. Perhaps come up with some Pan-African projects that will link our general economies and then move the continent forward. I think I have virtually said most of these things. Okay, so what is the role of the private pension to complement the public pension? If we look at the private pensions, they cover workplace pensions, which are arranged by an employer, or personal pensions, which individuals set up for themselves. Now, when we design our schemes in Nigeria, we did it with this basic idea in our heads that individuals should be allowed and given the opportunity to actually open pension accounts. So we have the regulator, the National Pension Commission, we have the regulated entities, the pension fund administrators and the custodians. The administrators, everybody can walk in, they are open. You open a pension account like you open a bank account. And so you can actually contribute on voluntary basis to have a pension for yourself. For those that are mandatorily covered, as we discussed during the first panel this morning, you have the opportunity to design your pension, the so-called design ambition. How much do you want to be earning as pension when you retire? I want to have $1 million. Now, the scheme has given you the opportunity, if you have the capacity, to contribute enough assets to build a pension that is going to give you as much as $1 million, if that's your ambition. And so the additional voluntary contributions that I mentioned earlier is just doing that. People want to have additional pension. That was a concept. And so when you contribute, you are not allowed to take that money out, because if you take that as a penalty, which is a tax, you have to keep that money into the system for 5 years at least before the tax is removed. Or perhaps if you want, you program it so that you have a bigger pension, because that's the whole idea at the very beginning. Now, we have seen a lot of people doing this, building pension, because at the end of the day, we'll notice that those who do the additional contribution, have bigger pensions, and so bigger opportunities to resolve their social problems when they retire. However, in case there is any need for you to fall back to that money, you can actually take from the voluntary portion of your contribution. But everything goes into one account, only that for accounting purposes, the pension fund administrator separates the two, that this is mandatory and this is voluntary. With issues like COVID and other crises, when they come, people want to have access to monies, they can fall back to the voluntary contributions and address those personal challenges that they may have immediate need for cash for. Now, as I mentioned, about 9% of the, pension assets in Nigeria account for 9% of our GDP. About 58% of these monies are actually contributed by the private sector. Only 42% is accumulated by the public sector, so which is good news. Largely because when you look at countries and the demographics, as I mentioned earlier, mostly people in the informal sector are more in number than those in the formal sector. When you look at a population of 200 million, out of this 100 million, working population, and only 8 million work in formal sector, 92 million are out there in the informal sector. So the opportunities are big, but the responsibilities, if government is going to provide a scheme for everybody, is prohibitive. It's not really going to be easy for government to provide for all of this. So we're happy that most of these assets come from the private sector, and we believe that with more coverage, probably we'll have almost 90% or more of the assets being accumulated by the private sector. When you look at the pre-funded nature of the pension schemes, they serve as cushion to scheme members in area of economic downturn or job losses. In Nigeria, we allowed people to access 25% of the total balance in the retirement savings account if they lose jobs, and they are not able to get jobs 4 months after losing the former job. So you are out of job for 4 months, you cannot get another job, you can access up to 25% of the balance in the retirement savings account to start a business or solve some issues. So we have seen that in such downtimes, people were able to solve a lot of problems regarding using the pension assets. Indeed, people will argue this is for pension, but indeed it is for pension, but people should be able to use the monies in the account to resolve issues. What is the use of the money if I cannot use it today and then I die tomorrow? Who do I leave the money for? Why can't I use some portion of it to solve an immediate problem that could be life-threatening? Indeed, when you look at the access to 25%, we have about 21 billion Nigerian naira, irrespective about 38,000, just to address issues due to COVID-19 pandemic, due to temporary losses of jobs occasioned by the COVID-19 pandemic. So which shows that these people that have lost jobs, they didn't get new jobs 9 months after losing the original jobs. And indeed, there are a lot of issues, every place is locked down and they need cash to solve some immediate problems. If you look at private pensions in general, they complement public pension in virtually every country. For example, when you look at Ghana, the pension assets actually accounted for almost 95% of the variation in the GDP in 2019. When you look at the IFC report that South Africa's pension constitute approximately 40% of the assets on the Johannesburg Stock Exchange. So this is just to show that the pension is for real, is sort of amalgamating all the financial sector together. But that's why we need to come and work together, not just as pension regulators, but the financial services in general. we have done something, I don't know whether it's clever in Nigeria. All the financial regulators, we come together under an MOU. We call ourselves Financial Services Regulation Coordinating Committee. The central bank governor is chairing, and all our CEOs are members of the steering committee. But under these, there are various programs and committees that are going on. Financial inclusion is one. The financial sector strategy 2020, trying to develop Nigeria into, one of the top 20, economies of the world by the year 2020. Unfortunately, we haven't been able to achieve that. But that's another story. It's not for this lecture. But just to show that we are working together, the National Pension Commission is there, the Securities and Exchange Commission is there, the National Insurance Commission is there. We have recently incorporated the Nigeria Communications Commission. They are there because of digital finance and so on. So we're working together to come up with these products, and we have a lot of working committees that are, working on various identified sectors to achieve the financial sector strategy. So I believe that in every African country, there is need for such collaborations, if it is not happening at all. In some countries, you find the central bank actually handling both pension, insurance, and so on, just departments in the central bank, and even the capital markets. But where such is not, there is need for collaboration like what is happening in Nigeria to address some of these problems. We are uptakers of the products that are issued by the banking sector, the insurance sector, the capital markets, and so on. So unless they they develop and issue these products, we cannot go anywhere. But if we work with them perhaps in the design, in making them understand what we need, in terms of risks and so on, then they come up with instruments that will be able to help us achieve the objectives of having a pension system that is not just providing old age income, but also helping to develop the economies of our various jurisdictions. I think I've said so much of all of this. So when you look at the infrastructure gap, in Africa, the gap is about 170 billion, and we need to spend by the year 2025, with an estimated gap of around 100 billion a year. So, which shows that the pension should not just be seen, and indeed is manifesting that it's not just a way of addressing old age income, but a way of also providing some input into infrastructure development and economic development in general. In my country, the government has started issuing developmental instruments in terms of sukuk. Now, the sukuk perhaps is a bond, a government bond, but that is under the Islamic finance. Nigeria has started, Islamic finance, and people that are interested can participate. Even in the pension industry, we introduce a fund, Fund 6, that is just for those who are interested in having their assets, invested in this sort of instrument. They said interest-free, but it's not interest-free in general. You don't define an interest, but you define a profit. So it's the same thing. But the beauty of this is asset-backed in most cases. So a government issues a bond that they will build a road, or they will build any infrastructure, hospital or school or something. And then the proceeds from running such roads and hospitals and schools are going to be used to pay back. And where there is gap, government will come in and guarantee the difference. So it's interesting because we have been able to build hundreds of kilometers of roads using these instruments in Nigeria. Whenever it is issued now, it's oversubscribed. The name Islamic is just to give it its characteristic, nothing to do with religion, really. It's just an investment vehicle, and you find both Muslims and Christians and non-religious people really investing in such instruments, largely because of the reward. The profit is normally, you find, outweighs the coupon rates on conventional bonds issued by government. So we're seeing this targeted issuances that will develop some infrastructure. Can we take the story to more sectors of the economy, of our various economies? That's why I say there is need for collaboration between central banks and ministries of finance and other, planning ministries and so on how to utilize the amounts that we are collecting under the pension industry to give us, what we need. The win-win situation cannot be quantified because, okay, I contribute my money, a road is built, I use the road. While using the road, although I'm paying to use it, but it's giving me some money back and ensuring, my future pension. So, what else can we have? But then when we work together within our countries, we will then start to broaden the scope. Can we come together as African Pensions Supervisors are doing today? Economic, financial regulators and supervisors and managers in our various countries, maybe we'll start to talk together. There are institutions that are already available, like the African Development Bank and so on, that may champion these initiatives. And then we try to see how we can address a lot of our economic challenges in Africa. Okay, so we've said so much about Nigeria, we don't need to say this. So indeed, as I mentioned, there is an efficiency in mobilizing long-term savings to finance development projects in Nigeria, in Africa in general. Now, you can imagine if we can segregate the funds to say, okay, you have a fund that is for beginners, individuals who are starting today who will not think of retirement until after 30 years or 40 years. And then those that are retiring in the next couple of years, maybe 2-3 years, and then in between. And can you segregate the assets so that if there is a development project, the fund that you use to actually finance such projects when the right and necessary instruments are issued by the respective issuers. I would want to say that back in 2019, there was what we call the Nigeria Economic Council, which is chaired by the Vice President and with all the state governors as members, including the Central Bank Governor and the Minister for Finance. They are members as well. So they came up with this idea, use the pension funds to develop infrastructure in the country. So a committee was set up, chaired by a governor of one of the states, and then membership, Central Bank Governor, Minister of Finance, my own DG, and we have the Sovereign Investment Authority in Nigeria that will serve as member secretary, the CEO. Coincidentally, I had the privilege of representing my Director General on that committee and on the technical committee as well. We came up with a bright idea. Select some roads in the country, select rail tracks in the country, and some power projects. Come up with a fund that you domesticate all these selected infrastructure in. Although they are public, but because we want to use private money to develop them, put them in a fund, move them to the management of the Sovereign Investment Authority, and then do transparent bidding, and then issue bonds that will be guaranteed by the government. So government, you have a choice. Either you cough up the money to develop this infrastructure, or you provide guarantee and ensure that everybody that is playing within this space, is disciplined. Because if they will be indisciplined, then there will be need to invoke that guarantee and you have to pay off the money. So really it worked, the structure worked perfect. Unfortunately, we are yet to implement that, although some stories again about sustainability of issues and policies in Africa, which is a major issue that is affecting so much that we do, unfortunately. But this is a very good way that you can actually use local finances to support local developmental projects. And indeed, are there ways that I want to emphasize this and emphasize ways that will come together as a continent to drive this, So these are the, this is the basic story. And if I can tell this and get it across, I'll jump all these slides and go to the outlook, and we'll conclude this. This discussion. To be honest, that's what we need to do, all of us. And one interesting thing is, we also started looking at green bonds, and some green bonds were issued by the federal government to finance some sort of ESG projects, some green projects. And the pension funds are always looked upon to buy these bonds because that's the largest pool of investable funds in Nigeria. Everybody now wants the pension funds because, you can grow it and you can make that impact, in your jurisdiction in terms of development. So to be honest with you, that's the best way for us to go. And I believe now that we are just beginning, Africa is still raw. We haven't had so much disruptions of our environment. Perhaps this is the best time we start incorporating some of these principles. Well, there is a discussion that is coming on that. But just to say that pension funds will have a significant role to play even in that, because in Nigeria, the green bonds that were issued, virtually 90% or more of it were purchased by the pension funds. So really there is so much that can be done, and African pension funds indeed, have a key role to play in this, in mobilizing long-term finances for developmental projects. So the future outlook, I believe, the continent will continue to experience shift from DB to DC in a dynamic manner. Dynamic in the sense that we have different peculiarities, but then different interests, and these things keep changing with developments. We've just mentioned COVID-19. We also talked about the Russian war in Ukraine. There are so many things that are happening and that are changing things, and we have to, adapt to the various consequences of these actions of men, in the way we design our systems, so we create the value that they are designed for, or that are meant for. I still believe that countries may continue to experience some hybrid of the DB and the DC. I don't think really DC is going to replace the DB, or DB is going to replace the DC completely in Africa. No. In terms of sustainability, people will tend to go towards the DC. But indeed, the DC may not be able to address all the three issues that I mentioned earlier, particularly on adequacy. My experience in Nigeria shows that although it is sustainable, although it is affordable, but indeed it is not adequate. And there must be something that should be done to create that adequacy, on the way pension systems provide value, at the end of the tunnel when people have the cost to start accessing their retirement benefits. Indeed, when you look at the pension funds that are pulled from contributory and other private schemes, they will continue to proliferate in the continent. They will play pivotal roles in advancing socio-economic development. As I mentioned, the little that is happening in Nigeria regarding building infrastructure, and is coming at one of the highest decision-making body, because that's the second highest decision-making body, from the Federal Executive Council, where you have the president sitting and chairing, the vice president, a member, and all the ministers, to the National Economic Council that is speaking of economy, but indeed economic, policy issues are being addressed there with the Vice President chairing. So that's the second most important decision-making body in my country, talking about using pension funds to develop infrastructure. So really, the attention is important, but the attention that we are driving to ourselves perhaps is beyond what we could imagine. But indeed, it is only when we decide and take appropriate regulatory and supervisory decisions that will come up with supporting policies that will drive these initiatives of our various governments. Then only, I think, we'll be able to make the impact that we should be making in the development of our various economies. So, if you look at the investment landscape of pension funds, it will continue to evolve. Indeed, we need more asset classes that are going to assist in addressing our basic challenges in Africa, not only in infrastructure, but even human capital development. Are there clever ways of coming up with some instruments that would help us develop human capital? Because I believe without adequate and resourceful human capital, no matter how much money you generate, you cannot use it in an optimum way to achieve your objectives. So human capital development is key, and in all sectors. Developed countries are what they are because of education, because of what they have in the head. If you don't have a similar thing, you cannot compete. And if you cannot compete in this country, in this world, you are always, at the receiving end, because nobody is going to help you. You have to help yourself. So we need to move towards really coming up with asset classes. I don't mind really if these asset classes are going to give value to the pension contributor. If pension funds really support and invest in these asset classes. Indeed, infrastructure funds and bonds are key, and we need to come together and see how we can develop those, particularly, as I said, some Pan-African projects that are going to open our countries, open our economies to each other. Perhaps that will attract some more developed economies to come in. We need to strengthen our investment regulations on financial markets to foster professionalism, due diligence, and ethical conduct in business dealings. And indeed, perhaps the judiciary is critical, because if there are issues and you don't have strong judiciary to address some of these disputes, then a lot of people will not come. They will not invest in Africa. So our judicial systems must really be strong enough to support investors and ensure that their assets are actually safe and they can get their assets back whenever they would want. So that, there shouldn't be any crazy presence that will come and say, I nationalize everything or something like that, So, indeed, African Pensions Supervisors have to intensify consultations, working together in a way that we share information. We, as I said, doing this report, it's difficult to get information about Africa in general, but just a few countries. Can we make this data available on what we are doing, how we are doing it on our various websites, so that it's available for researchers and investors? Because really that's what is going to give people some confidence, some basic information about what we are and what we do in terms of driving some more investments into Africa. And when I mean investments, you see that if there is ample information, there will be interested parties that would want to participate even in administering the pension business. We have seen that severally in Nigeria, a lot of interest. For example, AXA Mansard came and took over one of the PFAs. AXA Mansard, I learned, is the largest non-banking financial institution in the globe. They came and they bought over a pension fund administrator in Nigeria. So the issue is we need their capacity, we need their knowledge, we need their expertise. So taking over the pension business does not mean it will be all white men that will go and run the place. Indeed, it was run by some, by black people, Nigerian people. So we get knowledge transfer. Sometimes, but I like to tell stories. I have a cousin who had this heart problem, holes in the heart. And so, we took him to the National Hospital in Nigeria. And there was this American team that give support through an NGO. So they came and they operated on some heart, patients at the National Hospital. Coincidentally, I had the opportunity, after they worked on my cousin, to discuss with one of the doctors from America. I said, no, we are doing this so that we build capacity in Nigeria. So it's a team not only of American doctors, but we get the Nigerian doctors also participate so that we transfer knowledge. And that's what I'm saying exactly. How can we all move towards getting this? So an AXA mindset coming to take over the pension business in Nigeria is, again, a way to learn, a basic way of knowledge transfer. So I believe perhaps there is need for such collaborations. Whenever we have such opportunities, we should be able to, to take them and not let them slip our hands. I think I have said so much. I thank you very much for listening.
Thank you very much for candidly discussing with us the future outlook of the pension sector in Africa, especially that you've taken us through. I would just quickly the transition between DBs and DCs and the role of private pension funds to complement public pensions, as well as efficient mobilization of long-term savings to finance development projects, with several examples from Nigeria. So candid so that people can just be straightforward. Slido is available for pushing in your questions before time, so that we can have we can just reserve the time to answer to those questions. With that, Dr. Shem Omar. Dr. Shem is the Chief Manager of Research and Strategy at Africa Kenya, and he's going to help us moderate this next panel session. Thank you very much, Dr. Shem.
Thank you very much, MC. This session is due to end at 12:20. We may expand it a bit, so I'll have very few questions for the panelists that I'm inviting in order to create space for more plenary interventions. So let me call the Vice Chair of the forum back on stage, Dr. Farouk, the presenter. And let me call Mr. Eric Kwatei, the Chief Executive Officer of Axis Pensions Limited in Rwanda, and call Mr. Rogers Bukuni, Manager Insurance and Pension Supervision of the Department of the National Bank of Rwanda. Thank you very much, Vice Chair. May I start with you? I think this presentation you've given us has got some relationship to the first presentation that we listened to that went into the history of the pension sector. If you look at that history presented by Himanshi, at the beginning there was predominance of defined benefit pension schemes. Then defined contribution pension schemes emerged. Then there occurred a reversal. Currently, in your presentation, you have stated that defined benefit schemes predominate on the continent. And she quoted a quote, and I wanted to quote it also, that countries must grow old before they become rich. Our population now is young. They will work and grow old, and then we hope our countries will get rich. Are we likely to see that history repeat itself? Are we likely to see a reversal? That now predominantly we have defined benefit schemes, we are seeing the emergence of defined contribution schemes, and then a reversal will occur. But none of them, as you mentioned, will be wiped out completely. Just a quick one. Thank you.
It's a very interesting issue. I don't know. I mean, issues of reversals could come in some countries. It may be a possibility, but when you look at the African population, number one is to even address the financial health of the people. People need to be able to eat well. People need to have access to other finance programs to even develop. So unless we're able to address these poverty challenges in Africa, it's going to be tough to design any meaningful pension scheme that is going to address all the social ills of the old. So yes, I feel that defined contribution schemes are gaining momentum in Africa at the moment. But indeed, when you look at the way they are designed and the way they are done, if they could actually place themselves in providing the necessary economic impetus in developing African economies, then it may be difficult to just say, okay, we reverse back to the defined benefit scheme. After all, do African countries have enough resources to provide a defined benefit scheme that is going to provide all the financial needs of its old people? Now, how many countries today in Africa are doing these old age schemes? I don't know. I don't know, to be honest, if there is any African country that is doing Pillar Zero at the moment. I don't know. There may be, but I really have no idea. So to think of we are going to go into defined contribution schemes, then if they are matured enough and they are providing all the necessary support to develop the state, I don't think the country would want to disrupt that.
Thank you very much. I'm not sure that Eric has any comments on this. Do you?
No, I think I'm perfectly aligned on this because, gradually everybody's trying to move away from non-contributory schemes anyway, and those are very expensive to run. That's why this whole conversation of the gradual shifts from DB to defined contribution schemes are coming up. In as much as even defined contribution schemes are even contributory, the sponsor of the scheme is government. And government would want to move away from the risk of schemes being underfunded, So that's what I'm saying. I'm perfectly aligned with what he's saying on this one.
Okay, thank you. Let me come to Rogers and put this question. Discussing the future of pensions in Africa cannot happen without considering the informal sector workers, where we observed in the morning has 80% of our workers. There are a lot of efforts being undertaken in the continent to grow that. The governor mentioned in the morning that the private pension in Rwanda is 6.3% in comparison to public pension funds. What do you think we need to do? What strategies do we need to have in order to grow these private pensions? You can use the example of Rwanda or anywhere on the continent. Thank you.
Okay. Thank you, moderator. I think that is a question of, again, looking at the structure of the population and the structure of the economies. We are looking at Africa in large, and you find most of the schemes, they are mandatory and public schemes which do not cover a large part of the population. So if you are to make sure that the pension sector itself is growing, again, we need to put in place strategies to tap into the informal sector. Because you have seen the informal sector has a big population which is left out of the pension system. So if we are to make sure the pension sector is growing, and we have to put in place, governments have to put in place policies that would facilitate more informal sector population joining the pension system. In this case, for example, if we talk about Rwanda, the case of Ejo Heza, the government has put in place a legal framework that is facilitating the informal sector to join the scheme, that is Ejo Heza, where we are putting incentives that would attract more people join the Ejo Heza scheme. So I think what we have to do is to create a neighboring environment that would facilitate informal sector join the pension system so as to get the sector growing big. Yeah, for the moment, that's what I can say. Thank you.
Thank you. I think Nigeria has also tried to mobilize the informal sector workers into various pension arrangements. Yeah. What do you think you have done differently from Rwanda that is also very encouraging and you could learn from?
Well, I think the most important thing is creating that enabling environment. We already have a provision in the law that allows for voluntary contribution. So we just picked that provision of the law and we issued a guideline. Okay, since people can contribute voluntarily, and this informal sector participation is voluntary, so this is what we call the informal sector pension, and we call it macro pension plan. And the way it is designed is to allow individual contributors to contribute as they wish or as they can. So if I can contribute 1,000 naira every day, I can do that. If I can contribute that 1,000 naira in a week, or in a month, or in a year, it's up to me. Okay, to do that, so you can do that. Part of the incentives that we have done is to say, okay, let's split the contribution into two. There is the pension aspect, which is 60%, and a contingency portion, which is 40%. Now, with the informal sector, our understanding is that a lot of them may request to come back to us and say, okay, we need some money to maybe buy a new sewing machine. If I'm a tailor and my machine is broken, perhaps I need to go to hospital and I don't have money. So there are several other things that would push the informal sector participant to have to say, well, I want to take something from the retirement savings account. So we allow them to take 40%. Now, what we did was to say, well, you cannot take the 40% initially until the money sits in the account for at least 3 months. That is after the initial contribution. Thereafter, you can take it whenever you want. But the initial contribution has to remain in the account for at least 3 months. Now, we tried to see now how we can bundle other things. I'm happy we had a very good discussion with Mr. Gautam, who comes in as in tomorrow. He's here with us on these issues. And some of the ideas that came from Mr. Gautam we tried to incorporate, looking at the local peculiarities of Nigeria. For example, can we bundle insurance into the pension? So instead of taking money, that 40% to treat yourself or treat your wife or treat your children on some health issues, can we bundle health insurance, a micro health insurance into the scheme, so that some percentage of our contribution would just go to procure that insurance, that micro insurance for you, health insurance for you. So there are some of these issues that we try to address, but the most important thing, I think, is to make entry, quite easy, accessing benefits quite easy, and what happened in between in terms of complaints handling, customer relationships should also be easy. So can we have a system that can help us do this? And at the moment, we're talking to do that through digitalization, and we believe that will help us resolve a lot of these problems and provide the customers the information they need as they need it.
Thank you very much, Dr. Farouk. I think useful comments there, that if you bundle a product, you develop a bundled product, then you are sort of giving protection to the pensions component. Because when you are able to deal with the other financial needs of the savers, they'll forget about pensions and be able to address their issues. And again, then we put it on a digital platform. It helps to cut down on transaction costs, and that might be of help. Let me go to the last question, and I want to put this question to Eric. It is obvious that in the continent, we are short of savings, long-term savings for investments. I know that pension schemes and pension funds are rapidly growing in the continent, but as at now, we have a serious shortage of it. What do you think policymakers and government need to do in order to grow long-term savings on the continent?
Okay, great. That's a good one. Because I work in the Rwandan market, I'll start from here, then move to the continent as a whole. I think from a policy standpoint, one thing we can do is try as much as possible in the Rwandan scenario to try and pull the private pension sector under the umbrella of the DB sector. I'm just trying to be, the point I'm trying to make is that, the defined contribution sector in Rwanda is mandatory. And currently, our contributions to RSSB is just around 8%. It's a good policy to consider extending it to probably, let's say, 10%. Because currently, when you go on retirement to Rwanda, from RSSB, you're just getting your monthly pensions payment. There's no lump sum component. Extending it to 10%, what can be done is that the structure could be that 8% goes to defined benefit scheme, which is the National Rwanda Social Security Board, and then you have about 2% component going to private pension players. Now, what that does is that automatically you realize that you have a lot more pool of funds, and that sector also picks up. People now get lump sum payments when they go on retirement. So your lump sum basically will come from the 2% that is going to the private pension players. And that's one thing. So that's basically from the policy point of view. And I know quite a number of countries in Africa are following the Nigeria routes where they are having different tiers. So from Ghana, where I come from, there's a 3-tier pension scheme system where there's a mixture of defined benefits and defined contributions. Now, I wouldn't want to belabor the point on micropensions and the importance of growing micropensions because so much has been said about it. But one other thing I would also want to say from the much bigger approach is for our governments to watch their fiscals really well. So when you have governments that are very fiscally responsible, you realize that your microeconomic indicators are good and people are happy to invest in your country. I'm gravitating towards our diaspora. It's one thing we've not really looked at. I've been on a few committees that work around products around diaspora and pensions. Now, the World Bank says that remittances to Africa economies is around $49 billion, estimating it to grow by another 7% to $55 billion in somewhere in 2023. Now, this forms just about, let's say, 5% of assets African diasporans have. Now, the moment we're able to clean up our pension space and give them confidence that, listen, besides remitting money to your family members to help them do a few other things to expend and stuff like that, there's also an opportunity for you to also invest back in your home countries so that whenever you decide to relocate, you have that. you know. So these are important things we also need to look like, because if we are looking at generating funds to develop our capital markets, to develop our countries for the long term, yes, it's very important to look within, but we shouldn't also leave our diasporans outside.
Thank you very much, Eric. Let me leave the discussion amongst the panelists there and open it up to plenary. And I basically wanted to pick up two questions or two comments from this side of the plenary and from the other side. So if you have a burning question or a comment you want to make, please put up your hand.
Dr. Shen, if you allow, we can go through the questions that were submitted on Slido, take two of those also, and then we receive the public. Please put up the questions that we have received on Slido.
They were here there.
All right.
They are not shown here.
Can you please put them, but in the meantime, I can also read it out. We received a question from Cosma Senyonga. It goes that the rising inflation, life expectancies poses sustainability risks to DB. Can establishment of pension protection fund be part of the solution to protect members? Can I go with the next one also, or we first answer that one?
Okay, I can take that.
Let us respond to that one first.
Thank you.
Okay. You need pension protection fund to address systemic issues. Probably inflation may be one of them. But if there is, say, an adverse effect on the value of the pension fund itself, not necessarily due to inflation, you can recourse to use the pension protection fund to address that. We set up one in Nigeria. And the way the funding for the pension protection fund works is federal government will give 1% of its monthly wage bill into the pension protection fund. And the pension funds and the National Pension Commission will contribute 3%, if I remember, of our gross earnings each. So now that fund is domiciled with the Central Bank of Nigeria. And the fund is being invested on behalf of all of us by the Central Bank of Nigeria. We address two issues. Issue number one is when we have this adverse effect. So we use the pension protection fund to cushion the effect of, say, the global financial crisis, for example, that we experienced in 2008. So we look at how much it affected the pension assets, and so how much can we complement. But the complementation of this is only on the assets of the retirees. So we have a fund 4, which is just retiree fund. So we look at the effect on the retiree fund because they are already out of the system and they're receiving contributions. So we try to address their issues. We believe this crisis is cyclical. They come and they go. So for those that are still active contributors, we believe when the crisis is gone, they will recover. So there is no need to give them, any support because of the cost of that. And then we have the minimum pension guarantee. The minimum pension guarantee is a guaranteed minimum pension. Some people's pension, that's why I was talking about adequacy. Some people's pension may be too low, okay? And there may be times when, due to some issues, the pension account can be exhausted, okay? So then we put people on minimum pension that is funded from the pension protection fund. So there are a lot of ways that you can use it. There is no one fixed solution, one fixed way of using the minimum the pension protection fund, but it's important that we have it in place for when it is needed.
All right, I'll pick one more question from the slide and then allow questions from the room. A question from Nimuona Akkad goes, do you think that it is time for Africa to organize a universal pension scheme? Just a quick answer and then we move to the room.
Okay.
I think that will be a challenging one because, I mean, you know, they've been, even within the various blocks we have in Africa, there's been conversation about having one type of currency and things like that. Even that hasn't even come into fruition. So, I mean, it's a great idea, but I think it's really going to take a lot of work and a lot of time to get to that point.
Yeah, I agree with you.
Thank you very much. Let's then give the floor to the room. I think the moderator said 2 questions here and then 2 questions over there. Let's start.
It's more of a comment that I want to put to the panel with regards to the future of the pension sector in Africa. From my point of view, my personal point of view, I would think more about the design of the retirement landscape at the country level, right? And in this respect, we may go into a discussion of debating on multi-pillar systems and compared to a single pillar or 2-pillar system. Back in Mauritius, we have a multi-pillar system that has worked very well over the past 40 years. And with regards to that, I am of the view that we as African countries, we can learn from each other, right? And also from developing countries and developed countries to get the best out of each lesson, right? And with regards to, let's say, we are looking at that question about universal pension. We've seen the experience of Chile itself, how it moved completely to a DC system, and then over the years, to the current years, they have implemented a universal system to top up their private DC system, etc. So I think that if we tend not to put all our eggs in one basket, right, and diversify across pillars, and get the right lessons from each of us for best, I won't say best because we keep evolving with regards to pension, but at least those pillars that have worked very well, right, and get it on and put it on at a country level, jurisdiction level. And basically, we are helping our citizens to get a pot of money from each different baskets. So I would tend to think about a multi-pillar system and strengthening existing system as well. Thank you.
Thank you very much. Any other comment or question from Leonard?
Can I say a word on this?
All right.
Yes, I think a multi-pillar system is important. For countries that can afford some of the pillars. You know, if you can afford like a zero pillar, for example, I mean, by all means, go ahead and do it. Because, to be honest, I am more concerned about adequacy of all the systems that we have, whether funded or unfunded. So something that is going to support a sort of social net that is going to assist, you know, individual citizens in Africa is important and key. So really, I support the idea, but we need to be mindful of the cost implications.
And just a little comment on this. So I think you are spot on this. A multi-pillar system is definitely the way to go for most of the countries in Africa. Even though I'm very bullish on the DC schemes, because that's basically where I work. I believe that defined benefit schemes are very, very important, given the social security nature it is and the social protection it gives, especially for people who earn really, really low salaries and things. So it's very important to have that you know, balance well, so that you have at least about 2 or 3 pillars where you have a bit of defined benefit protecting low-earning people, and then also a defined contributory scheme, which would contribute, I mean, balance the benefits that you derive from your defined benefit scheme. So I think it's a way to go. As for the zero pillar, it's also good if once you can afford it, that's fine. But I know a lot of countries are definitely running away from it because of how the economic situations in most countries are looking now. Yeah.
Yes.
Yeah. just a point of emphasis on zero pillar. Yes, multi-pillar system is good, but of course, the zero pillar where we don't contribute, I think that one is the model which might be too expensive for governments to manage. So yes, multi-pillar is a good system, but the system where there are no contributions, zero contribution, which is commonly known as pay-as-you-go, I think this one is to some extent expensive to manage. So yes, we can go multi-pillar, but again, we have to take care of caution on the zero pillar or non-contributory schemes. Thank you.
Thank you very much. I don't see any hand up, but I want...
There is a question here.
The name is Israel Jav. I'm here with my Director General and some senior colleagues from Sierra Leone. Dr. Farouk, in his presentation during the deliberations, made mention about the informal sector and that they have a law already in existence which provided for the establishment of informal sector, and that they did make regulations concerning the informal sector. And that, I think, has always been my view as well, that in our country we do have our own legal framework that establishes our pension scheme, the National Social Security and Insurance Scheme. And the scheme has some provision, the law has some provision dealing with what we call self-employed. So in my view, self-employed are basically people who work on their own, and you can literally term them as people from the informal sector or people in an informal work. So my major concern, Doctor, however, is how do we engender compliance in the informal sector? And I also want to throw my weight beyond those who are arguing that there should be multi-tier pension systems where perhaps you may not have the informal sector merging with the main pension scheme. But importantly, Doctor, how do we engender compliance in the informal sector?
Okay, it's really tough, largely because the informal sector, number one, if you want to identify an informal sector person, where do you go and meet that person? Well, let's say if maybe that you have a mechanic by the roadside and you know where that mechanic is, then you go and meet him there. But there are several that work from homes or work from the bushes and so on. So it's difficult. So in Africa, the issue of identity and addressing system is really not there. So that's one issue. The second issue is registration. If you have, say, an agency that is registering all these informal sector participants based on perhaps the type of jobs they do, that will also help you in just doing advocacy. Now, I'll give you an example. In Nigeria, we have what we call SMEDAN, the Small and Medium Enterprises Agency, Development Agency of Nigeria, SMEDAN. In SMEDAN, they register all these informal sector, small-scale industries. From the database, probably you find about 37 million of those small-scale industries registered by SMEDAN. Why? Because they get some support from government. If there is, say, some support from government or from some donor agencies in particular area, that is to develop small-scale industries, it goes through the SMEDAN. So if you have something like that, then actually you can do something. Although participation is voluntary, but if I'm going to give you this support, okay, you have to go and register a pension account and show me that you have registered a pension account. At least one person, the proprietor of that SME, should at least open a pension account. This will be a guarantee for me to give you this, this money. You can do that. But apart from that, it's going to be challenging because you need something. That's why I said it has to be that they are going to benefit from something, and then you are saying, okay, you need to show me that you are responsible. So go and open a pension account. It doesn't matter. Just drop 1 naira in it. 1 naira is nothing now when you compare to dollar. You have to divide dollar by, to make a dollar, you take about 609 naira to make $1. So you just contribute 1 naira. Show me that you are responsible. You can do that. But the long and short of it is informal sector participation is always voluntary, and the only way you get them is through incentives. Incentives such as, okay, I'm giving you this to support your development, then do this. Or perhaps, as I mentioned earlier, entry, exit, what happened in between should be so easy that it's easier for me to participate. Remember, we have these traditional ways of savings in Africa, and I think it's across all African countries. So we are competing against them. People are used to them. They have developed these things, they matured over centuries, and you are now bringing macro pension, informal sector schemes to compete. So it's a behavioral issue that you are trying to change. And so the only way you change these things is, to be honest with you, through incentivizing, but not through forcing compliance.
Thank you for that question. It's really a difficult question, and there's no correct answer for it. I think if that works for them and you can demonstrate that they're benefiting out of it, I think they'll just comply. If they don't see any benefit coming out of it, however much regulations, laws you formulate, I think they will still not be able to comply. I think the demonstration effect is really critical under the circumstances.
Actually, you just mentioned an issue which is important, or perhaps do matching contributions. If you contribute, government will give you some matching, some support, some percentage. So when you do that, a lot of people will come.
Thank you very much. We have eaten into the time of the next presentation. We still have one before lunch, the next panel discussion. I think we can bring an end to this here, but the discussion continues off stage. Let me congratulate the panelists for very valuable comments they have made. Please get in touch with them for more insights. Thank you very much.
Thank you very much. Thank you, dear panelists.
Thank you.
All right. I can see some faces already closing up, but we are going through our last session before we take our second break of the day. So let's give it some attention. It's a hot and interesting one. We are going to discuss green and sustainable finance. And for this one, let me welcome Dorothy Maseke, the Group Head of Risk and Compliance, ICE Lion Group. She's going to introduce the topic, and then later on, we are going to dive into a panel discussion to gain more understanding. You're welcome, Dorothy.
Thank you very much. Being given an opportunity to speak when you stand in between people and lunch is very difficult. So I'll try and unpack this in very few minutes, even as we delve deeper when we go into the panel discussion. So I just want to mention that we are going to be speaking about green and sustainable finance. And I think for me, one of the things that, speaks to me, even as I stand before you, honorable delegates, is the question of why. We can talk about all these things that we need to do, but if we don't understand the why, then there'll be a big challenge. So I won't have slides, but I'll quickly speak through in a few minutes. So maybe the first thing I'd want to unpack is just to clarify our understanding of sustainability. So what does sustainability mean? The Brundtland Commission, and I think for me it's one of the definitions that really speaks to me even as a person. Meeting the needs of the present without compromising the ability of the future to meet their own needs. the thought that whatever decisions that we make now, whatever investments we make, whatever financing instruments we develop, whatever you as you as regulators, the policies that you come up with, whatever you do has the ability to actually influence the future generations in being able to meet their own needs. And one of the things that I also want to mention is on the topic of sustainable finance. So when you speak about sustainable finance itself, now here we are looking at the ESG element, environmental issues, social issues, governance issues, and how you're able, or how we are able as a financial sector, as financial market players, how we are able to incorporate ESG into investments, into decisions that we make, into the investments that institutional investors make. So that's key. So if you're able to understand sustainable finance and then link it to the needs of the future generations. Now there's a gentleman I follow, and many of you who may who follow sustainability as a topic, you've heard of David Attenborough, and speaks so one of the speeches he made at the last COP26 meeting, climate change issues are not necessarily affecting some future imagined generation. It is actually here with us. Even tried to some of these aspects, and mention some of this. Ladies and gentlemen, if you look at the carbon emissions, or what we are emitting, from context, you contribute less than 3%. If you look at the global emissions, you have putting about 19%. China, of course, 3%. There, contributor of these carbon emissions, as agriculture and many aspects that we are looking at. I just want to mention that now be the biggest source of greenhouse emissions. Now, greenhouse gas emissions, because this include carbon, we percent nitrous oxide, the perfume that we spray, we go to work and just get we've been talking. To do everything that we can to limit our degrees from pre-industrial levels. So whether sector player, whether you are a farmer in the village, whatever you do, whatever play, we all play to this temperature rise, but to less than 1.5 degrees below pre-industrial levels. So it is a big component of look at health and well-being, mortality. We talked about the heat waves today. Now, is a big one. It's a disease. What is zoonotic disease? A disease that, from the animals to us, to human beings. One say how temperature rise, how into eating, accessing of food. is climate change. So do in this subject. And in the past, ESG, if you look at external markets, which of course are more developed than we are, and ESG has been, even now, more, are we able to, and the kind of questions that we get, we have Sharia compliant, etc. So that's the ethical side of it. And more side of it, that are having. So, for example, and we, what this portfolio investing in having, because at the conditions to meet their needs. Is on mostly the cost of adaptation. Industry comes into adaptation. Why? This includes the financing instruments, the adaptation within the African context. The report highlights that are most vulnerable to climate change were actually in Africa. And I looked at that report the other day, 2022 report, there in the past, and speaks to the why. And this morning is what we do as regulators, as supervisors, in limiting our temperature rise to 1.5 degrees centigrade. So with that, I'd like to welcome the moderator so that we could, move on to the next session. Thank you very much.
Hello, good afternoon. My name is Karine. I'm the CEO of BK Capital. I'm going to moderate this session. Thank you so much, Dorothy, for breaking it so clearly for us. Increasingly, we are hearing that economies need green and sustainable finance. It feels that green and sustainable finance is on the roll. We keep hearing high-popping statistics of the amount of funds and transactions that go into green and sustainable finance. I'm just going to give you a bit of statistic from Refinitiv that says that in 2021, sustainable bonds reached $1 trillion, and this is 20-fold, it's a 20-fold rise from 2015, and it accounts for 10% of the global debt market. This is really huge. If you look at sustainability-linked loans, it surged 300% to more than 700 billion in 2021. So how do we make sustainability at the core of pension investment, and how does it benefit retirees? So I'm going to call the amazing panelist, Mrs. Dorothy Maseke. Could you kindly come back on stage? She's the group head of risk and compliance at ICA Lion Group, one of the biggest, largest financial services in the region. Dr. Evans Osano, kindly come back to the panel. Dr. Evans Osano is a FSDA Director, Capital Market. Dr. Umar Farouk, I think we've seen him many times, and welcome, Dr. Umar. we're going to have 2 questions and then open the floor to the panel, to the audience. So my first question will go to Dr. Evans. FSDA Africa plays a catalytic role and has many initiatives that support sustainable financing. We've seen FSDA supporting issuances in green bonds in the region. So what is your advice to pension fund managers on making ESG investments and transitioning to responsible and sustainable investment?
Hello? You can hear me? Okay, it's on now. Yeah, thank you very much for the question. So I just want to take a brief moment to step back and provide a bit of context to what the excellent job that Dorothy has also done. Now, we talk about climate change, and of course, the biodiversity loss from our perspective are actually very connected. It's the other side of the coin. And then you also provided data that Africa is one of the 2 continents globally that face the biggest risk from climate change. Now, when we talk about climate change and the risks, and I think we've been talking about risk and risk and risk, there are 2 main ones. We look at it from 2 perspectives generally. One is around physical risks. So, for example, if you're a farmer and the rains fail, or they come within short periods of time and you're not able to produce your crop, that's obviously a physical risk that is coming from climate change. Now, if you have built a very tall structure, it's a bridge, or it's a building, a house, an office block, or your own home, and it's next to the sea, and the sea level rises, and consumes your building, that is a physical risk from sea level rise, isn't it? That basically destroys your investment. Those kind of risks are very many. They have been very much documented across the continent and globally. But there's one type of risk that is even more important, I believe, in my own perspective, from an African perspective. That is transitional risk. As we transition to low carbon emissions, we race towards net zero. It basically means some existing technologies that we're using today are going to become obsolete, sort of. And it also means that certain policies will bar access to certain markets. For example, if we are an African producer, we are connected to global value chains, and those entities where we sell our produce for further production or sell, say you have to meet these kind of standards and we're not able to meet, then it means you're going to be out of the market and out of the pocket. We can't run away from that, so we can't quite ignore that. Now, as an investor, a pension fund or any other investor, if you go to the market, you are exposed to those 2 risks. Physical risks we can try and mitigate, obviously, hopefully. Transition risk, I think we have to think a little bit deeper and to understand how do we position ourselves to future-proof our investments. I think that's the message. How do we future-proof our investments, both from a transitional risk and also from a physical risk perspective? Now we talk about risk, but I also want to turn the coin a little bit and say, what kind of opportunities can we also create? It's not all about risk. With risk comes opportunities. And the opportunities also come from how we manage our transitions. And I think the continent is relatively privileged in a sense because we don't have a lot of legacy infrastructure. We can build better, we can future-proof those investments that we make today. We don't have to go back to the same mistakes that have been made in the past. I think Dorothy was mentioning to me some times back that retrofitting existing infrastructure or buildings to be climate smart is very expensive. But if you can build that from the beginning, that obviously improves. I believe there are also opportunities in the manufacturing space, green manufacturing, and I don't know why we as a continent are not doing enough to encourage opportunities in green manufacturing, especially given that our energy generation, a lot of it is much more renewable than some continents, like in the Asia, for example, where a lot of the manufacturing has moved to today. So there are opportunities there as well that we can look at. The green economy, and there have been studies that have been shown to indicate that if we went into a green economy sort of space, we are likely to generate greater growth rates as a continent, generally speaking, relative to business as usual. So there are opportunities. Let's not look at it in terms of just risk and how we manage that. So as investors, then how do we position ourselves to play a meaningful role? In my earlier statement, I mentioned that traditionally, a lot of investors think about risk and return. They may be aware of ESG risks, but they don't really care about it. They have no vote about it. They don't care about that. So they are interested in risk and return. But we are seeing now a greater movement towards what we call a responsible investment. In responsible investment is generally saying, I am aware of the ESG risks, so I want to do no harm. Yeah, so you have negative screening. So you say, I don't want to invest in industries that pollute or that cause harm in any way, drugs or something like that. And I want to mitigate the ESG risks. A lot of funds are moving into that second phase. But I do hope that as we progress as a continent, we'll also move to the third phase, which is sustainable investments, where you are saying actively, I also want to benefit. As I make money, I also want to benefit the society in which I operate. And I could encourage a lot of us to, there's a very beautiful book that was written last year by Mark Carney, who is a former governor of the Central Bank of England. It's called Values. 2021 book. It's a nice book. I could encourage a lot of us to go through that. Because essentially what we should be moving towards is how do we make investments resonate with the values that we hold very dear as societies and all that. And then, of course, the spectrum continues, and I don't want to go into impact investing or philanthropy and all that. So I stop at those three levels. Now, at FSD Africa, we've been very keen to support the development of sustainable investments across the continent not because of the risks that I've highlighted, but also the big opportunities that we see as well. So we have programs in about 20 countries supporting this. Green bond market development. We've also started getting involved in gender bond market development. And we've had 2 gender bonds being issued in Morocco and in Tanzania with the support that we have provided. And I hope that a lot of those investments are going to be patronized by a domestic institutional investor base and then contribute positively to the development of the continent. Local currency financing has become ever more critical, as I highlighted. Today, Eurobond yields, I was just checking yesterday, Kenya 2024, 2 years from now, the yield is about close to 20%. In local currency, is probably, you can correct me, is about 10%, I think, 9 to 10%. So you can see, that's the risk that we've been exposed to, and that's why we have consciously actually to try and deepen our own local currency bond markets and capital markets to also make a positive contribution to the societies. And so we have to work very hard to increase the supply of those instruments, because the fund managers, pension funds will say, okay, yeah, we are interested, but where is the supply? So that's the other side of the coin. So we have to work very closely around that. We've seen about $300 million of assets of green bonds, about 12 green bonds that we have supported so far as FSD Africa, but that's a drop in the ocean. It's a very small percentage of what you call the global bond markets, or even the bond market within the continent. So we have to do much more increasing supply, but I also want to encourage our members to be part of the solution, not just wait and see the product coming through, to be a bit more active in terms of seeking out those kind of opportunities where we can be able to do some good and also do some good for the society and do well for ourselves and our funds. So probably I will stop there, and then maybe I'll take the next. Yeah, thank you.
Thank you, Dr. Evans. Thank you for highlighting the why and also flagging that there are opportunities indeed. It's not only about risk. My next question goes to Dorothy. From where you sit as one of the largest financial service provider in the region, what is that pension fund manager look for in green issuances that give them the comfort to invest in? But more importantly, are ESG investment already a consideration as part of the investment policy statement for pension funds and trustees?
You know, when answering that question is very painful to me because I must say no. From where I sit, I have not seen an IPS statement that has ESG considerations. And that is the irony that we are actually living with right now. We are most vulnerable. We want to ensure that, you know, we are able to survive and the next generation can survive. But there's really little that we are doing from an ESG perspective in terms of investments. And yet pension funds and pension schemes are the largest institutional, some of the largest institutional investors. So the challenge that I see, and I'm very sad to say this, but the challenge that I see is the conflict or the inability to fully understand what the public good means. When we talk about do no harm to who? Is it do no harm to the pension scheme members? Is it do no harm to the environment? Is it do no harm to the economy? And I think as trustees, they have a really big challenge in terms of balancing their fiduciary duties. The challenge in terms of, as a trustee, what is my fiduciary duty? Is it to ensure the best interests of our scheme members? And best interest means highest return, to ensure that they have the highest return in the market? Or does my fiduciary duty also include ESG? Does it also include ensuring that our economies are resilient? Economies resilience, again, climate change, biodiversity, all these things have a major effect towards the resilience of economies. So when I look at that, that's, for me, one of the hardest things that a trustee has to understand or work on. And the Principles for Responsible Investments actually came up with a project in 2020, 2021. And the whole idea of this project was to explain the meaning of fiduciary duties in the context of investments. And of course, they put in money and they got in, you know, thought leaders, and they actually came to the conclusion that fiduciary duties also include ensuring that trustees take into consideration the ESG element. But again, that has been challenged by some lawyers in the US. So you can see there is no consensus. But what I want to say is that when you look at external markets, and from that's where I guess we may need to learn from. And possibly we may be at a better advantage point in terms of leapfrogging. External markets, there are 24 rating agencies that actually incorporate ESG criteria. 60% from the latest Bloomberg report, 60% of, you know, those who are surveyed, there was a survey that they carried out. They actually said 60% of you know, trustees are looking for fund managers who look at ESG or are clear and are aware about ESG and are advising them on ESG. By 2030, they say 90% of assets will take ESG into consideration. So what does that mean for us? We may be many, many years behind, but the truth, as Evans has said, transition risks are real. When you look at the counters that we're investing in, when you talk about transition, does that mean that you go to, you know, as a fund manager, as you're advising our clients, and we tell them, look, we need to start, you know, reducing our exposure. Now we even call it exposure on oil and gas. That's an interesting conversation. Can you imagine having that conversation in West Africa? You know, it's a difficult conversation to have. But is transition going to happen? Yes. It will have to happen. But I guess what we need to work on is how to make it happen in a just manner, a just transition. And for us as financial market players, how to make sure that regulated entities are well aware of the risk of stranded assets. BP, for example, had a major write-down of a couple of billions of dollars because of stranded assets. That's BP out there. But what about us in Africa? Is it coming? Yes, it is. How many years? In 20 years. And some of us will still be alive, some of us will be working, a number of us will be pensioners by then. So what does that mean? If nothing is done, and like I said, sadly, that conversation is not yet taking place, we actually risk our pensions in future. Thank you.
Thank you, Dorothy. And this takes us to the next question, because I think what you've emphasized is that fund managers need the support of regulators, or policymakers. So my next question will go to Dr. Farouk. From where you're sitting as a regulator, how can the regulators incentivize the pension sector to invest in ESG-related asset class through needed policies or other ways? Should regulators consider setting minimum asset allocation for the new asset class? Is there any other way? Thank you, Doctor.
Well, interesting, thought-provoking. The issue with regulation, you're just trying to make sure that the regulated entities are doing their jobs according to the rules of the game. Now, but then, whatever regulation, whatever policy you set, that regulation must serve a purpose. And if it does not address the concerns and yearnings of the regulated entities and the people that the industry is serving, then it's useless. So that is, I think, the most important thing that we need to put at the back of our minds. You can come up with policies written in gold, but if those policies are not in sync with reality, providing the expected values by the people that those policies are expected to serve, then there is a big problem. So, number one, I would say, you come up with policy, no matter how you call it, either an act of parliament or a regulation or a guideline or a framework or a combination of all of these things, in order to ensure that you save the society from itself. But two key issues need to be addressed. Issue number one, people need to understand that this is for them. They need to appreciate and accept that this is for them. Now, if I do a law that is rejected, unfortunately, I cannot implement it. So one of the issues that I mentioned earlier in my earlier presentation is that people need to appreciate, need to be educated, need to understand that this is for them. Then only what you put in the regulation, whatever policy document, is going to be accepted and is going to be useful. So I can guide the industry. This is what I want you to do. But unfortunately, the industry may not be able to actually implement that. So I cannot be able to actually hold them responsible for not actually following the rules and regulations. So number one, and most important issues that we need to address in Africa generally is education. People to understand that this is for them to appreciate and to accept. When this is achieved, then I think any policies that we're going to do then will be really useful and accepted. So if you look at this, as I know there are a lot of efforts by various African countries to address this issue, coming up with sustainable finance. For example, in Nigeria, sustainable banking, then sustainable capital markets, the Securities and Exchange Commission, the Stock Exchange, now Nigeria Exchange, they came up with this sustainable capital market policy. Now, in National Pension Commission, we have reached an advanced stage of developing sustainable pension principles, which we are, once that is done, we are going to issue them to the pension fund operators and we'll ask them, okay, this is what we want you to do. But as I said, this is going to be useful only if, number one, as a pension regulator and pension operator, we have the right products that are issued there that can support the successful implementation of of these policies. If we cannot have the right banking products, the right capital market products, the funds and bonds and whatever that are not really, going to support us to be successful in implementing this policy, we have to still keep on doing what we are doing. Number two, and very important, on a monthly basis, people's contributions are deducted from their salaries and sent to their retirement savings accounts, where, in countries that operate the DC scheme. Now, if I see on a monthly basis that this money has been contributed, but it has been invested in an asset class that is not giving me the right returns, I will scream. And we receive a lot of these challenges that, okay, my contribution was like my RSA balance, retirement savings account balance, was 10 million. Why is it 9,995,000 this month? So we need to have that support. And so we cannot be successful as a pension industry without the support of banking, so the central banks, the capital market regulators, insurance regulators, everybody else. And then indeed, institutions like Dr. Evans and Dorothy's and so on that will issue these products out, for the pension funds to actually invest in. So that's why it's, to me, there must be this support, this sort of conglomeration of all our powers and a push to be able to achieve this, indeed, with necessary government policies. On the issue of putting a minimum is quite challenging. For DB schemes, that's okay, it's possible. But for DC schemes that are purely DC, where the risk of investments sit on the pockets of people contributing their pension monies, then this is going to be quite challenging because it has to be rewarding enough for people to accept them. So putting a minimum would mean, okay, today is 5%, we're keeping 5%, but then it's underperforming, we still keep 5%, so we keep on pumping money to maintain the 5%. So I don't know whether that will make some economic sense that is going to be acceptable to people. So that's why I said there's need for this concerted, joint effort between all of us.
Thank you, Dr. Farouk. And I think what you're saying is that this requires the entire ecosystem to work together and achieve this and get the buy-in of everyone. Before we give before we request the audience to ask questions, just a last question to all the panelists is really what's your view on what do you foresee the pension sector in Africa in the next 5 years in the ESG front? Just and any comment that you want to leave with the audience. I'll start with Dr. Evans, please.
I hope and trust that that future is going to be very bright. Today we have assets under management of about $1 trillion. I think that's across different pockets, CISs, pensions, insurance, and all that. And the pension segment is actually much larger in a lot of the countries in sub-Saharan Africa. I hope that continues to grow and coverage continues to increase. I hope we are able to crack this problem of the informal pension funds and all that. On the investment side, I do hope actually that we'll move and progress towards more responsible investments, if not sustainable investments. It's going to be inevitable. It's going to happen because Africa is connected to the global economy. And the best practices that we are seeing across many markets are also going to come to Africa. And so that transition is going to happen. I think the level of awareness I'm seeing is improving a lot. The missing link probably will be around supply. How do we get adequate supply of eligible assets that pension funds can invest into? And I think that's the challenge now to the financial sector as a community to create that supply. And the needs exist. As I said, there are a lot of opportunities on green manufacturing, on smart buildings, on transportation. It cuts across so many different sectors. In agriculture, it cuts across so many sectors where Africa has an abundance of endowments and all that. But there's a link that is missing, which is connecting the need and to the sources of capital that are looking to invest in that. I'm sure many of you are familiar with the G funds. They have about $130 trillion of assets under management, and they're looking for investments. And they're looking for investments in Africa. And the challenge has always been our ticket size. I remember I was having conversations with BlackRock, and they said they really want to invest in Africa. And so I asked, what's your average ticket size? And they say it's about $100 million, but we can take 50 if we can get it. Yeah, we can go down to 50 and all that. So then Africa, we have a challenge of generating relatively small ticket sizes of opportunities. So there is an opportunity there I see of aggregating as well, these opportunities as well. And this is a challenge, I think, to the financial sector. If you can be able to aggregate different opportunities, I don't know whether it's via securitizations or it's via pooled kind of vehicles that we might be able to create. There's a lot of capital that is looking to invest in a responsible manner in the continent, not just domestically in Africa, but internationally. Internationally, there's a wall of capital looking to invest into the continent, but in a responsible manner. And I do hope that the African capital, institutional capital that sits here, does not get left out, because then it will be left with the holding stranded assets when the world has already moved on. So hopefully if we can create also opportunities for co-investment, that will be quite good for the continent as well. Yeah, so thank you very much.
Thank you very much. Ms. Dorothy?
Yes, as Evans has mentioned, the opportunities abound, and something that just comes to mind, the vulnerable, they're called the vulnerable group of 20 ministers have committed quite a huge sum for the African market in terms of supporting investments, supporting ESG from the financial services sector. And quite a big chunk of that fund actually also goes into the social protection and the pension for the lower or vulnerable, income groups. And what we're just trying to say is the opportunities abound, and it is up to us as a financial sector within this market to prepare, because again, these opportunities are very specific. They're very specific on what they're looking for. Now, I'm not saying that we sit and open our hands and ask for help, but the point is, those markets are guilty of all the emissions they've put out there in the environment and the global warming that we are facing. We are very vulnerable. We don't have adequate adaptation mechanisms, and because of that, they're bringing the funds to Africa. But are we ready for this? Are we ready for this are we ready for these opportunities? Yet there are opportunities on innovative products. There are opportunities on being able to access those who don't have, the ability to protect their, protect themselves in their old age, including many other aspects, the life insurance aspect, the health aspect, etc. But then I want to also challenge the regulators in this room. The banking regulator, including ours in Kenya, has gone into climate risk assessment and scenario testing. And what they have recommended is that going forward, banks actually need to report on TCFD. So TCFD is the climate-related financial disclosures, a mouthful. But all it's saying is banks need to report on the risks and opportunities that they hold within their books from a climate perspective. What does that do? It helps banks understand the risks they face, including the transition risks. There are some service lines that in 10, 15, 20 years may actually, no longer be in the market, no longer be in their books, and they need to start accounting for that. So that's the banking industry. So in Kenya, by 2023, banks are actually supposed to submit their first TCFD reports, which is great progress for us as a country. The insurance sector also is in talks, and the regulator within the insurance market in Kenya has actually called CEOs, and they've had forums on ESG, looking at the risk side, and more importantly, the opportunity side. And my request to you as regulators is to look at that aspect from the pension side. And again, pension funds, compared possibly even to banking, are quite vulnerable. Because if you have invested in certain asset classes, can you guarantee a return in 30 years? Possibly not. Or what return will you give to the pension members in 20, 30 years? Actually, even 15 years, because you're already in 2022. So the question is, what policies, not policies just in terms of, incentives or regulation, but things to do with even training, capacity building, awareness, such that when you start talking of TCFD reports, and then there's the nature-related financial disclosures which are now being worked on. When you start talking about TNFD reports, the pension sector is not left behind because, again, in my opinion, you're possibly the most vulnerable of the financial market players. Thank you. Yeah.
Thank you, Dorothy. And I think your request has fallen on the right ears.
Yeah.
Dr. Evans?
Thank you so much. I just wanted to add one or two quick points, and I'll talk about opportunities as well. So, because climate change, biodiversity loss is a global problem, the public sector is also very interested. As I said, the private sector seems to be leading the way in terms of financing, but there is also an opportunity for blended finance. There are a lot of blended finance structures that are being developed, which hopefully will de-risk investment by pension funds. So I think the pension funds do need to come to the table as well and co-create some of those opportunities, taking advantage of any risk mitigation instruments that might be provided to support those investments. And then as a continent, I believe we have a very strong opportunity to monetize natural capital. We are very much endowed, as I said, in natural capital, but we have not found ways of monetizing too well. But I have also seen a lot of innovation in that space. So part of it may be through carbon markets, and carbon markets sometimes tend to be very siloed, but we found ways in which we can combine or basically connect carbon markets and capital markets, and therefore creating opportunities for investors in a very de-risked kind of manner, but in a way that supports not just the return aspirations of those funds, which is actually attractive, but also contributes so positively to society. There are also other schemes we may call ecological services and all that, means of, again, monetizing natural capital and all that. But again, by creating opportunities, good investment opportunities, I must say, that also do good, not just avoid harm. We want to move away from avoiding harm to the next spectrum where we want to do good as well. Yeah, thank you so much.
Thank you. Dr. Farouk?
Okay, well, so much has been said. I see, yes, indeed, some bright future for sustainable finance in Africa. And indeed, the regulators, whether sitting in this hall or outside there, in pension and in other sectors of the financial services in Africa, should be ready to actually support the development of this sector, because it's important as a future. We are spending money today to actually invest so that we earn more in the future by reducing costs of, so much healthcare, education, and so on in the future through these rightful and responsible investments. I think really it's important if we look at how do we collaborate. Collaboration in terms of coming up with some probably transition timetables, when to do what and how, and by who. I think it's important, and then we need some standardization in the availability of data and quality of that data, so that it will to help some uniform assessment of this investment and risks. And indeed, it will also help us uniformly assess performance of the pension fund investments. Indeed, we cannot escape digitization, but that involves a lot of investments. But it's important that we look towards coming up with policies that would really also support development of digitizations, within adoption of digitization within the pension space, because that will help really, particularly if you want to much issuers with investors, for example. It's easy through these sort of platforms and so on. There are several other things that we can achieve if we go that way. Thank you.
Thank you. I will ask the timekeeper whether we have time to take 2 questions or comments.
Yes, maximum 10 minutes. 2 questions would be good.
Okay. I think we have.
My thanks to all the panelists for a very candid discussion. Since the morning, I think 2 themes are emerging very strongly. First, the need for coverage expansion to informal sector. Now the ESG-related investment, the push required to that. And my question is at the intersection of the 2. When it comes to investing of these innovative informal sector schemes that are coming up, there is generally a slightly different approach that is recommended at this point. It's very new as a space, but the fact that these informal sector workers have smaller savings, they have more flexibility rules, they're not necessarily treated the way we would treat formal sector, private sector pension schemes. Now add to that this layer of ESG impact investing. I'm curious if you would suggest using the same message of more needs to be done and then the path ahead for formal sector pension funds as you would for these informal sector schemes that are coming up. Because communicating volatility in returns is probably going to be much harder to someone who already has low financial literacy. So just your thoughts on this.
Yeah, thank you so much. I think that's a great question. And so there's need, obviously, to balance and, of course, protect capital. I think capital preservation, I think, will be very important for those kind of, schemes. But, of course, when you're managing a fund, you look at it from a portfolio perspective as well. So within the flexibility of your portfolio construction, you may be able to do something more while preserving the capital of the investment that you are doing. And also depends on the phase at which you are starting. So maybe you can start with a much more conservative, allocation, and then over time you can graduate to something that is a little bit more diversified. So that's basically what I could recommend. But what else do I say? So I think, I think that's probably what I might say. If you're looking at it from a portfolio, process as well. But diversification, I think, in any case, is very important. The last point I just wanted to mention is that a lot of these new innovative investment instruments that we are talking about are not today available in the public markets. So we have to shift kind of our mindset in terms of what kind of markets, where can we get these opportunities? And I think a lot of those opportunities will be created in the private markets. So even as regulators encourage certain policies, investment guidelines and all that, we have to have a slightly bigger, slightly different mindset in terms of how do we create these opportunities. Most of the investment guidelines we have today are very much, public markets focused. And we know the future is not there, unfortunately. I wish I could not say that. So we have to think slightly differently. Yeah, thank you.
Yeah, you asked a very interesting question that we grapple with quite a bit, because when you talk about ESG and you look at the E aspect of ESG, it means basically there are some sectors that in future, because they are risky, may actually need to be shut down. You talk about oil and gas. In Africa, we know some coal mines are being shut down. I work quite in the insurance space, and one of the things that we are getting challenged on is we have the East Africa oil pipeline that is cutting across. And that oil pipeline does not have reinsurance support. Why? The reinsurers from global markets, Munich Re, Swiss Re, they have declined. And so what does that mean? It's taken longer for that oil pipeline to be laid down. There were thousands of jobs to be created, or some which are going to be lost, like the coal mines that are being shut down. When these jobs are lost, contributions, of course, cease, especially from the lower income, workers who work maybe on a daily basis or a weekly basis in these sectors. So that's the E side of it that can present a challenge when you look at the social side. And that's why, you know, the nexus between the E side, the S, and the governance side is very important, because the social side now looks at, for this sector, what needs to be done to ensure that they can even give contributions, maybe not on a monthly basis, possibly on a quarterly basis, or for the gig economy that, you know, you spoke about this morning. How can we ensure that these are also brought into the pensions basket? So it can be a bit of a paradox of some sorts, but the most important aspect is how to link these three to ensure that economies are actually resilient.
Thank you. Do we have any, we have a raised hand? Right, on the left, second table.
Thanks. I'm conscious that we are now late for lunch, but just a quick question. Basically, firstly, fascinating session, really. And I think what Evans is saying, clearly, I mean, there is a supply and demand question here. You know, what comes first? Should we have the supply in place? Then, you know, regulators like Dr. Farooq can then perhaps step forward and help to create demand. But I also, so the question that I really have is that there may also be a conflict where, let's say, if I'm sitting in a particular country and that country needs long-term, you know, assets for building infrastructure, which need not always be ESG compliant. So one is going to be a conflict saying, should I be investing locally? But then the second is, if I look at ESG, and if, let's say, the supply is not locally available, could there be a role for thinking about regional pools for creating the supply? And if so, how would countries respond to, let's say, precious long-term savings going out of the country from an ESG compliance point of view, but at the cost of, let's say, domestic infrastructure development?
Before that question is answered, I would like to bundle it with the only question we received on Slido, so that we wrap it up all at once. So the question is about the dilemma of the fact that the biggest funders of basically sustainable projects are also the biggest emitters of, yes, the question, let's read it as it's written. Yes. So the question starts, I like the definition of sustainability. I equally adopted going forward. How are you dealing with the dilemma of big polluters being the largest, she wrote ECG funders, but I think she meant ESG funders. So let's couple these two and then wrap up the panel session.
Okay, maybe I take the issue of Gautam, and then you take the other issue. So, I mean, yes, perhaps I've been talking about this Pan-African sort of plan where maybe we can be looking at what we need to finance in Africa. So countries have different policies on foreign investments. Some allow, some do not allow. As I mentioned earlier, in Nigeria, we don't allow at the moment investments, any offshore investment. But we're working on guidelines to do that. Do we consider perhaps making provisions within these offshore investments, some sort of lines or two that will encourage these offshore sustainable investments? Perhaps maybe that's what we all need to do. Now, what I think works for regulation is if you anticipate some development in the future, you can actually make provision for it today. You don't have to wait until it happens, then you make provision. So it creates the demand today, so that when the supply comes, the demand is there to just pick it. We have done this severally, under our jurisdiction, and really it works perfectly well. Now, my main concern always is then this sort of collaboration, because any foreign investment that you are going to do needs the collaboration of central bank or perhaps even the Ministry for Finance. because these issues have to do with foreign exchange, and you're going to be diving into maybe your country's external reserve. So you have bigger policy issues to address. So, but it's good you create the demand, and then you see how you can sort out this back-end, issues with governments and with central banks in terms of, supply of foreign exchange. Indeed, you can even be more clever. Can I source this foreign exchange independently in such a way, though, that it's going to be more expensive than getting from government and the central bank, but I will still make profit? So are there ways that I can do it? So we can start to think about these things, at the moment. I think all regulators need to start, cracking their brains on these issues now. Thank you.
Yeah, maybe just a quick one. So I'm a big fan of diversification, of course, within acceptable limits. And for many of us who are in Africa, we know that we have parallel markets developing on the exchange rate side as well. So the only way we can be able to preserve the capital of some of our contributors is also by diversifying as well. And also diversifying regionally to take into account, the question that you raised in terms of seeking the opportunities that you want to get as well. So I know in East Africa, we do have this policy where investments within East Africa is considered as domestic, which is great. The West African Monetary Union, 8 countries, they have one single currency and money is fungible within the community. That is the West African Monetary Union. Those kind of approaches, I think, are good because it encourages a little bit of competition as well among providers of capital and also those who are seeking the capital, and enables investors to generate better returns and all that. So that's what I could say. Now, on the second question, I hope I can be very brief on that as well, which is the conflict between those who seem to be polluting the most are the ones who are also promoting ESG investments and all that. It's a big topic. This goes into what we call the realm of international political economy of decarbonization. Yeah. It's a complex topic. Very, very complex, I must say. But I could say from an African perspective, and I've had this horse being beaten a lot to death and even beyond death, that we as a continent should be focusing much more on adaptation. Yeah. Because we have not caused the problems, but we are going to be the ones suffering the most. And mitigation is a foreign kind of construct, but I do not necessarily share that kind of view. In my mind, I know adaptation and mitigation, they are two sides of the coin. And I'll just give one quick example, if you allow me. If I'm a farmer and I plant an avocado tree, that avocado tree is good for the environment because it captures carbon and stores it from the environment, isn't it? So I've contributed to mitigation, yeah? But I can sell the fruit. And if I sell the fruit, I'm going to generate an income. And therefore, I'm much more resilient from that perspective as well. So there are two sides of the coin, I think, if I look at it from that perspective. And because we don't have a legacy of bad infrastructure, bad housing, and bad everything, why should we go through the learning curve that the ones who have caused the biggest losses have generated? Why don't we the future proof our investments? So if I'm building a house today, why can't I build it in a way that makes it cheaper to manage in the future by reducing my energy consumption or by reducing the amount of water and how I use it? A circular economy, green manufacturing. So I think if we focus our minds on so much on the negative side, we need reparations because we didn't cause the problem, but we are going to face the biggest challenges out of it. We are going to miss the big boat and the big opportunity, especially around Africa as a continent that benefits from the transition. Yeah, thank you so much.
I believe one will allow Dorothy for
1 minute, I promise.
Minute.
The cost of adaptation in Africa from an agriculture perspective estimated to be between 13 billion USD to 30 billion USD. the cost of inaction is over 200 billion USD, which is way higher. So adaptation is key. And we have COP27 coming up in November of this year. It's going to be in Egypt. It's going to be in Africa. And my plea to us all, if we can follow those conversations. In fact, I wish we could come out of this forum with something that we can take to COP27, because this voice needs to be heard in COP27. Thank you.
Thank you very much. A round of applause to our amazing panelists and to you all. We look forward to a sustainable world. So thank you and enjoy your lunch.
Thank you.
Thank you very much. Lunch is going to be served at the Milima restaurant. We are going to have protocol assure us, and we'll be back in exactly 1 hour. Thank you very much for your patience. If you could kindly help the conference so far, how you're enjoying it, how topics and the sessions have been interesting to you. Would appreciate your feedback on how you're enjoying the conference so far. Now, allow me to welcome Dr. Regis Hitimana, the Deputy Director General in charge of Rwanda Social Security Board, for him to present the case study of Rwanda. Can you please avail the slides? Thank you.
Thank you. I'm happy to be here. As they said, I'm Regis Hitimana. I joined RSSB 2 years ago. And I work in the capacity of the Deputy Director General in charge of benefits. I have my colleague with the similar title in charge of investment. So I think I need to clear that out so that investment-related questions, fortunately, we have people in the room who can help me to respond to them. But so I'm going to, on behalf of RSSB, to present to you the long-term savings scheme, Ejo Heza, a Kinyarwanda name that literally translates brighter future. Hopefully I didn't kill it, but that's what it means. And in the room, there are people who have been there before me, who would probably have more to share with you, who were there before Ejo Heza was born. And I think they can compliment me anytime in answering questions or adding to what we are presenting here. And I'm also with Augustin, who works with the scheme every day. So to RSSB, Ejo Heza, many families, if I give that example, many families that had the chance to have children, there is always that youngest in the family who is always very exciting. Everyone is excited about taking care of that baby, looking how fast the baby grows, spending more time. That's how Ejo Heza is in RSSB, because we are a family of 6. Ejo Heza is not the last born. We don't have any family planning. So we might have more schemes to come. We have in mind more schemes like unemployment and others. So, but Ejo Heza is enjoying that benefit of being the last born so far. Next, please. So we see it growing. Oh, I have, okay. Good. So I didn't go a lot of background about the challenges we have in terms of covering the informal sector. And then in Africa, Asia, Latin America. I think that is known to everyone, but I just wanted to start straight to the Rwandan context. When only working age population was covered by a pension. That is the formal sector. So, and the census that was done 10 years ago counted around 500,000 of people aged 60 years and above. And it was estimated that in 20 years' time, which is now in 10 years' time, that population would double. And when there is no cover in terms of pension, when there is a loss of income, you can only rely, probably if you had an asset that can keep generating revenue, but that is a chance that not everyone has. Then you will rely on your children and sometimes on the government, which is also a costly scheme. Probably we have time to talk about it because now we have the social protection scheme that covers the elderly, those who didn't have a chance to, don't have today a chance to have a revenue to take care of them. So since the last 2-3 decades, we have a forward-looking government with always very ambitious targets. So we have a 30-year plan that is very ambitious and a 7-year transformation plan. And in that, the level of saving is one of the areas we need to develop further. And that's what we created in 2017, but was initiated in 2018. So the scheme is voluntary. The contribution is voluntary. I think this is to reflect the realities of the informal sector with unstable incomes. You are a farmer, maybe you harvest twice a year. So that's the time probably you feel capable of saving. So the scheme doesn't push you to save every day because there are some months of the year where you can't do it. So it's voluntary. The contribution, there is no limitation or there is no regulation about how often and how much you contribute. It is linked to the ID. I think we are benefiting from this infrastructure that was put up since, I think, more than 10 years ago. So majority, if almost everyone above 16 years has an ID, and those children below 16 who don't have ID can also create an account in Ejoheza with the extension of their parents' or guardians' ID. So at the time they turn 16, that saving shifts to their own ID, which is also a facility that we have seen being used. So any Rwandan, any foreigner residing in Rwanda, and with that ID facility, there is no age limitation. So I can create the account in Ejoheza for my daughter who's 6 years today. So as I said, there is no limitation to how much you pay. This is the governance structure. We have the line ministry, the Ministry of Finance and Economic Planning, and we are happy to have representatives here. I think they are also the ones, they are the brains of Ejoheza, where Ejoheza came from. So we, the RSSB family, sometimes there are children that come from us, but there are children that we adopt at different ages. So we were happy to adopt Ejoheza when Ejoheza was still very young. So we are the administrator appointed by the government, and our board of directors looks after all the schemes, including Ejoheza. And on competitive basis, we have appointed a custodian bank and a fund manager who is investing Ejoheza contribution. It was created with incentives in the beginning, which I think today we are thinking of reviewing these incentives, but so far we have seen them working. We are also fortunate to have what people can call household registry or social registry, that is a stratification where every household is identified, how many people in the household, and given a category from 1 to 4, now under revision, but so far we had those 4 categories depending on income, asset, and things like that. And government incentives were created around that structure. So category 1 and 2, when an individual member saves up to $15,000, which is around $15 per member, government tops up with the exact amount. When they save above that, the government keeps increasing up to $18,000, which is the maximum matching contribution. They also get to have a life insurance cover in the next year. We have a provider aside who is providing that particular product. And category 3, those are the numbers, 18,000, then you get 50% of a contribution that is added to your savings, and together it will be also, as return on investment, also come back to your account to see it growing, either by your own contribution, by government incentives, and by return on investment. Category 4, they have a target which is not linked to that matching contribution, but gives you a chance to have a life insurance cover. So we are reviewing this. There is a process ongoing to align the incentives to where they can be more effective. But also as the scheme is growing, this is one of the things that is becoming more and more expensive to the government. So we want to focus to those who need it the most, where it can make much of impact, but also avoid some speculations, age limitation on life insurance, for example. That is one of the gray area we want to close. The scheme has other benefits. You can get 25% of partial withdrawal as lump sum when you retire at age 55. 55 is also something that we use in our mobilization because the formal sector pension scheme minimum retirement age is 60. And there are a lot of people who come to us sometimes when they lose jobs towards that age and start saying, why don't you make it the retirement age at a lower age? So I think this is what EJOHESA members have that will be enjoying in the future. So 40% of anything above 4 million, which is that can be withdrawn for housing and education, and 40% that can be used as a loan guarantee when you want a loan in the bank. And return on investment, we don't talk about percentages because it changes, but so far we can confidently report about the past, which has been bright, always above the inflation. So in the next few slides, I'll take you through the achievements so far. These are 4 years of achievement, and the 2 graphs you see one is for the savings, and the other is on enrollment, and these are annual increments, so it's not accumulation. So in the first year, we were only able to mobilize up less than 100,000. So in the next year, close to 4 billion, and then in the last 2 years, we were 9 to 11 billion a year, which is 11 million US dollars if you want to put in US dollars. So far, that's how on an annual basis we have been able to mobilize in savings, and I will come to another number because on top of savings we have also return on investment and government incentives that adds to this scheme and create what we call asset under management. So this is lower than asset under management. In terms of people we are able to mobilize as new enrollees in the scheme, in the last 2 years we've been able to mobilize around 1 million people, close to 1 million people, but between 2021 and 2022, there is not much progress. I think you can understand in the beginning it's always the curve like that, but we believe given the limit, which is the population, the active population, we think we can still mobilize more people in going forward. I think partly this is due to, in the beginning, we always start with the low-hanging fruits, and becomes more tough when you go to look for those individual people. So you probably, the coverage in people who are in the informal savings schemes, in cooperatives, you see the coverage higher, but when you go to individual households that live outside that social structure, you realize that the coverage is so low. So we are trying to develop more solutions that can help those people to save on individual initiatives. These are the total numbers, and we are breaking down by informal sector and formal sector. 90% is the informal sector of all the subscribers, and the gender is the most impressive indicator. So we have exactly 50-50. So one was 49 point something, another one 50 point something, but it is 50-50. And we know that when you look at the employment survey, you realize that we usually, the gap is higher in the employment. So I think Ejoeza is doing a great job. I think it was 46.5, the latest survey, women participation in employment. So I think it's great to see these numbers. And when we talk about asset under management, 75% come from savings. That's what I was referring to. And we have 10% that come from the return on investment, and 10% that comes from the government incentives. And we, at the time of reporting, we had some cash on the bank that was accounted aside. And when we go into the savings, when we look at the distribution of that 75%, the saving part of it, as I've talked about, the gender looks like that. And although the formal sector is 10%, but they are able to contribute up to 30% into the total savings. So they are few, but how much they can afford to contribute and how regular, because the formal sector, most of them, they do it through salary. And so their savings are more regular and sometimes higher than the informal sector. But we're happy that 70% comes from the informal sector, which is our target population, which doesn't have any other alternative. So as the previous session was, one of the panelists was talking about, we started with a very cautious asset allocation, and we have so far invested in treasury bonds and in fixed deposit. And most of it goes into the treasury bonds, 90%. So when you ask a question, why did we grow that fast in terms of mobilizing people and mobilizing their savings? I think the first thing that sometimes is underrated is the trust between government and citizens. I would imagine if Ejoeza was to be created by a private company, even if whatever how renowned it is, I don't think we would have these numbers. Probably have their innovative ways of mobilizing people, but I think so far in Rwanda we have seen citizen mobilization by the government becoming more and more easier, because if I don't know you and ask me to follow you, I will ask questions. I will be hesitant. But if the last time you asked me to follow you, I have seen good things, then probably I will follow you. So I think that is something that is an asset that sometimes we underrate. We are talking about Ejoeza, while on the same reporting date we were talking about, 30th of June, on a similar scheme, community-based health insurance which is voluntary with a fixed contribution, we're able to mobilize up to 87% of the targeted population. We're talking about 10.5 million out of 13 million Rwandans. After years of engagement in the population. So Ejoeza is just in addition to that trust, in addition to that bond between citizens and the government. And when you don't hear scandals of money being stolen, being, misplaced, I think that was also built keeps building on that trust. I think also incentives have played a role. We mainly matching contribution. When we see people, when you talk to them, some of them tend to set their target according to where they can get the government incentive, which is a challenge because it's a narrative we need to change, because you should be saving according to where you want to be. You have your age, you can predict how much you will earn when you retire. I think that should be the target. So, but we see people saving up to where government can give them incentives, but it's a message to us that incentive work. So if there was no incentive, we would be probably not or having something smaller or lower than that. Also, the return on investment, I think, is also people keep tracking the growth of their accounts, both from their own savings, the return on investment, and the incentives from the government. Also, Ejoheza, as a young scheme, children that are born today, they are born in an environment that is different from the previous children. So you can't start the way pension started 60 years ago on paper basis and people recording on paper, going to the district to get registered. Ejoheza today, in this room, you can create your account, start saving with your mobile money. I think that is also a facility that those young children keep enjoying. The system is friendly. How you pay, having no limitation about how often and how much you pay is also a facility that makes it easier. We also appreciate the collaboration between government institutions, mainly central government and local government, and the culture of working on performance. So every mayor, every year, we sign a contract with the head of the government, including indicators, and one of them is Ejoheza. So there is a target, and we don't dictate how they do mobilization. They come with innovative ideas, and some of them we borrow from one place to other places because they were genuine, they were innovative. Even the change of leadership in the district, you see the difference. So we have had a transition last year, and we are seeing shifts in district that used to become first. So I think it's our role as RSSB to spread those innovations and make sure that we maximize on those. I think there are social structures in rural areas, which I think we don't see much in cities, that also facilitate. Saving is not an easy decision process. So you give up your consumption today for the future, especially when it is long term, it becomes much complex. But when you are in a group of people that are saving for different purposes, then Ejoheza is enjoying that facility. Cooperatives, of course, when you have your time, when you divide your profit, then you can decide collaboratively or in a group to say, let's save this for us, because we know we not have this capability to work when we retire. I think that is also facilitating. That's where we see, as I said, higher coverages. But we still have challenges. There are many, there are numerous. We have selected a few. So, of course, we are operating in an environment or in a country where saving culture is very low, but this is a challenge for us to work on because culture is not created in a day. So I think schemes like this are contributing to creating that culture. So challenges related to the nature of the scheme and the nature of the informal sector, which are also expected. So you can't match the contribution that comes from the formal sector just because their incomes are unstable, most of the time low. Sometimes you can drop out just because you didn't have a good harvesting season last year, and coming back will ask more efforts. I think those are the challenges that we see on the field. Urban areas have been very challenging to us. As I was talking about social structures in rural areas, I think in urban areas we are trying to figure out what are the facilities we can create that enable people to save when they make those individual decisions as an individual worker or a household as an entity, because you are unlikely to invite an evening gathering for an association in the city. Probably it can happen at the workplace. So that's where we are trying to engage with the MNOs, mobile network operators, to see how we can facilitate that instant saving. So you take the decision once, and for every transaction or every at the frequency that we decide, you get something deducted and going instantly, because you don't have your neighbor reminding you about saving. So we have people who create accounts and don't start saving. So it is also expected. It's a challenge before us, and we need to work on it. So we need to know them, who they are, and convince them that when you talk about Israel in a gathering like this in a rural place, you have a number of accounts created, but that is enough, because the target is to go up to the saving. We also see the youth, which should be the number one target for this scheme. Yeah, they are joining, but the numbers are not matching the people in. I didn't show the graph of breakdown by age, but I think that the youth, that's where our next focus will be, because for them, if you show them projections, it doesn't matter. So how much you pay can be lower, but since you have a lot of years in front of you, the target is easy to reach. And the return on investment, because that interest is on the compound basis. So the 1,000 you save today and the 1,000 you save in 10 years is not the same 1,000. So we want to invest more in the IT solutions, create more collaborations, make savings more convenient and intuitive. We are revising some laws and ministerial orders to adjust incentives, to attract youth, to give more incentives that are responsive to, that create really that incentive into saving. We are creating a specific campaign for the youth, and we want to create the saving culture from the schools. So there are also two other ideas that are disruptive in nature that probably I thought of. They are not formal. Probably this gathering can help us brainstorm and come to a conclusion. So probably would it make a difference having that dual account where what you save you can get a percentage of pension and a smaller percentage that you can use as a current account? It's not trying to enter into competition with other institutions that do this, but probably if we find it working, why can't we try it? Making it mandatory is also an idea that we, with different stakeholders that we meet, have always repeatedly talked about. So we are in the process of reflecting on these ideas, and your contribution will be welcome. Thank you very much.
Thank you very much, Dr. I think we need to appreciate a little bit more the development of the scheme and its achievements, and also to achieve a gender parity. To me, I think it's such a huge thing to celebrate. So please, another big round of applause to and we are going to have an opportunity to talk more about this topic. And for that, allow me to welcome Jean Bosco Iyachu, CEO of Access to Finance Rwanda, who's going to introduce the next set of panelists. Thank you very much, Iyachu.
Good afternoon. Thank you very much, Dr. Regis. Indeed, very brilliant kind of achievements. And this adds to the story we have about Rwanda, where most of the initiatives that are started, you always see a good momentum over time. And so thank you very much for sharing that story. So I'll invite you to come first to join me here on panel. As you said on your last slide, that you want to encourage questions and comments. Obviously, we need to give to the audience an opportunity to ask those questions. So welcome on stage as my first panelist. Thank you very much. Good. So I think we've been talking about the gap that is there in the pension sector. How many people are included, excluded, and that really shouldn't be overemphasized. And even the many years to come with a youth population that is growing, clearly that gap will widen. And this is really a threat that everyone is thinking about, and we need to make sure that we do something about it. Now, Rwanda, as you have seen, didn't want to really do nothing. Rather, they chose to do something and test and see what would work and indeed not work, so that those learnings can be shared by the rest to the rest of the world. And I'm so proud to have been part of this journey as Access to Finance Rwanda, working with the policymakers, regulators, and other service providers within the financial ecosystem. Now, I'm so privileged and honored to moderate this panel, a panel that I would say is more practical, sharing work on the ground, not really theory. And I have three great panelists who indeed have walked the talk. And in addition to Dr. Regis, I want to invite my other panelist, Seth Kana, from she's co-founder and director of Box Solutions, and she has been working on pension inclusion across so many continents. So welcome, Parul. It's a pleasure having you here. Indeed, I was chatting with her as she comes. I recall those meetings, early meetings, when we were looking at the feasibility of Ejoheza. And I liked her optimism that was there. Obviously, some people were thinking it might not work, especially when you are talking about informal sector saving for old age. But her motivation and passion behind this was live, and that gave us energy. Last but not least is Mr. Eric Duigamba, whom I invite to join me here on stage. He is the Director General of Financial Sector Development at the Ministry of Finance and Economic Planning, and also my board member. So I'm so privileged to host you, DJ Eric. Thank you very much. So, as Ray said, really these are the back in 2017, when Ejoheza idea was being tabled and discussed. So please, I make sure that I spare some minutes so that you can ask any questions, especially those that want to explore how they can experiment this in their market. So I'll start with you, DJ Eric, from a policy perspective. When you draw from Ejoheza a journey up to now, what is the role, what do you think was the critical role of government and development partners like AFR and others in increasing access and usage of pension across the continent? So I know there are so many initiatives across East Africa, across Sub-Saharan Africa, but would you share your story and what you think the government should do and development partners should do to support this pension inclusion? Thank you.
Right. Thank you so much, Yach. Good afternoon, everyone. My name is Eric, as Yabosco said. I'm very excited to be with you this afternoon, looking at so many people that have been working in this space for some years. Welcome to Rwanda. Let me add my voice. To the question, I think the role of the government, especially in our case, probably was more being a champion. I think for me, it starts from there. What the government, or the role the government played very well, and I strongly believe that all governments should be able to, should be reflecting on this, is to first sit back and recognize the fact that there's a gap. And you own the gap, you put into context, you put at the center of all the programs and the aspirations the government wants to, the country wants to achieve, and then you ask yourself, what should we do? And so for the government of Rwanda, that was very critical to own it and to be at the center of the discussion. The second aspect, which I think was critical, and I would encourage everyone that is thinking about it, is to exercise all the government's convening power. So as a government, we were able to bring all the brains on the table, the development partners. We explained the obvious, how savings are important in terms of investment and everything that everyone knows in this room. And so with all your beautiful hearts of giving in terms of aid and grants, we think this is a good platform to equip the nation. So we brought development partners on the table. We brought experts that would technically be able to think through this. All what Dr. Rogers described came from so many collaborations and consultations that took place in the country, but also outside the country. And we worked with the people like Pinibox, you heard of Pinibox, to come and bring the Asian experience into the discussion, and these were very helpful to be able to get something. Private sector, as Dr. Roger said, clearly the scheme is not in any way delivered through the government. It is us who has to coordinate and then design a scheme that is human-centered, and then we ask, the final question was, what should be the role of everyone? So there should be a role for everyone. The MNOs, the banks, the administrators, the regulators, everyone came on the table. And so this is not a government of Rwanda scheme. Our role was to ensure that everyone is talking to the other. And we're open to criticism. Let people speak what they think. And until this point, I'm sure we were happy to say, you know what, why not change this? That's why you saw Regis putting up even points for reflection. We are still open to it. The other aspect I think that was very important is to ensure that the scheme is developed, designed, and implemented on very strong grounds in terms of the legal framework and the regulatory framework. We believe to create confidence and protect the savers' funds, we should have a very robust legal and regulatory framework. And the list is long. Let me just mention the last two. The other one is mobilizing people. I think until now, and for a number of 3 decades, the government has earned trust. So we mobilize and work with everyone, or the ministries, or the citizen. And finally, we invested in money. So the government invested money into this, working with the development partners like Access to Finance, but also money from the treasury. It can't be donor-driven. So the donors put money on the table, and we put money in the table, on the table, in the scheme. In terms of paying salaries, operation costs, including incentives, in terms of life insurance, funeral insurance, in terms of matching contribution, and they're paid on time and in a very transparent system where people see money hitting the account. And so that has also been very helpful to create confidence. Oh, if the government is putting their own money, probably the thing is not a scam. It's actually something that is very promising and important. So let me pause there, probably for now. Thank you.
Thank you very much, Eric. That's really comprehensive. I'll move to Parul. I know, Parul, you've been involved in so many initiatives on pension inclusion. Although I know that really one size doesn't fit all, what do you see as key considerations when designing inclusive pension schemes?
Thank you, Yachu, DG Eric, and Dr. Reed. It's a pleasure to be in the same panel as you. Thank you so much for everyone for being here. I think you're absolutely right. There isn't one size fits all. However, there are, I think, two sides of the same coin, and I'm probably in a second sort of conflict what I just said myself. While we're trying to understand the informal sector workforce, I think across developing countries, their needs, their challenges, their access issue, their literacy issues probably remain the same if you look at Asia or Africa or Latin America. But I think what changes is regulations and laws and cultural differences that make the implementation of pension inclusion products for informal sector workforce. So having said that, I think even the informal, I think one of the key factors that we must know is what does the informal sector workforce of each country look like. And I think somewhere down the line, and I have probably made this mistake as well years ago, is that you kind of put them in a bucket and say this is what they think or this is what they should think. But that is not true. Even the informal lower income individual, there are categories of very low income people or poor people who will always be dissavers in their lives. However, there is this emerging middle class and upper lower class in the same income group that then needs to be addressed according to their needs. And I think that is where the design structure and the government intent comes to the foray. And one of the things that EJOHESA did very well, and that came right on top from the design structure when we met DG Eric for the first time in 2014, was the intent to first do a very strong supply side survey. And why that is important is because you want to understand what do the people want. What is the income, the age group, the occupation, what is their cash flow, what is their intent, what are their aspirations. And I think one of the things that came out apart from designing the pension scheme was the funeral insurance that came out was out of that. And the second thing that came out of this very robust supply side survey was that they decided to extend it to children. So I think in my knowledge, please in the room if there's someone else, I don't think there's any other scheme in the world that allows even infants, newborn children to be associated with the pension scheme. And I think Rwanda has made that inclusive because of a very robust supply side system. And this is what allowed for a better design, better implementation, better communication. And why I say communication is because India also has had, now they've discontinued the scheme, which had co-contribution pretty much like EJOHESA, but, and that they gave 1,000 rupee co-contribution. But I think one of the reasons why it fell short is because of the kind of communication and education that didn't reach the right kind of people, and India sort of designed another program. One of the second things that I think EJOHESA did very well was on the demand side as well. Sorry, I said the demand side first before I said the supply side. Forgive me, I will now come to the supply side. The supply side, I think it is important to understand what the financial inclusion ecosystem exists. What are the kind of commercial incentives? What are the business models? Do they have the ability in terms of technology and intention to come together as a marketplace, as a result of which we were able to do simulations and see what are the private players in the market actually want. Can this design structure of EJOHESA make delivery very, very accessible? And one of the other things that we did was this enabled a quick launch, right? Because you've created a bucket, you've spoken to the stakeholders who are actually going to deliver the product in terms of incentives, in terms of fees and charges and things like that. And then you're able to go back and design a product. Like DG Eric said, I think regulatory environment and legal framework is very important. Not only for the existing legal framework that works, but because there was a very good building block in Rwanda with the existing laws, I think creating new ones which associated with those laws were very good. And finally, going to the government with the incentive structure which they were able to study because of the supply and the demand side and the regulatory framework allowed for a success of a program the way it has. Categorizing through income groups, through Ubudehe categories, incentives through limited period incentives, like even Dr. Regis brought out, that it could be a burden on the government, but the initial impetus that is required for a behavioral change is what was actually seen through the scheme. And somewhere I kind of agree with Dr. Regis when it says that there is a burden and it is difficult, and probably people should be looking at their own personal goals instead of meeting only those that the government is able to provide. But I think what the scheme has also done for those who save regularly is get them into a habit of savings. And that behavioral change over a period of time till the incentive structure is there for 3 to 5 years is something that I think would be a paradigm shift. And then going to schools and youth who would be included through their parents to be able to open a pension account is important. And I could actually drive from a personal experience. When my daughter turned 18, I opened a national pension system, a government scheme in India for her, which allows third-party contributions. And of course, she was up in arms and she said, this is not her 18th birthday present, right? Today, she is 22. And I think she's already a happy girl seeing the amount of savings and returns that she has. And she certainly will be a happy girl at the age of 60 when she marches to her bank account through her own contributions and the initial input that may have been provided by her mother. So I'm hoping that she's a happy girl. I'll stop here.
That's great, Parul, really walking the talk and doing it even at home and educating. I think something that I picked from your contribution is really around client centricity, and I think Eric also highlighted it. I recall when this scheme was being designed, as part of focus group discussions, one motorbike rider, we asked whether one of the days when he has money, he thinks about old age and when he is not able to ride on the streets. And he said, well, whenever he thinks about that, he doesn't actually sleep. He spends like 2 hours thinking about that age when he can't ride anymore. And then we said, so what are you doing about it? He said, really, I don't know. Well, I have low income, but I feel like I should be doing something. And then we said, well, what do you think should be done if we are to support you? And one brilliant idea that came from that conversation was that he said whenever he's fueling his tank at the petrol station, if the government would see how to bundle, the pension contribution with that price of the liter at the petrol station, it was like bundling is a concept to us that we know from the books, but really, for him, he didn't know, but he came up with a brilliant idea, and he said, well, with that, I won't know that you are deducting and saving for me, for old age, but it will be beneficial to me. So it's very important to put the client at the center as we design such kind of solutions. So that's very
I think we
brilliant.
termed it pension miles. So please, anybody steal the idea in the room and create pension miles.
Great. Good. So that takes me to Dr. Regis. I think the presentation was loud enough to share what RSSB has done. But I still believe that a strong saving culture is crucial to ensure adequacy in voluntary pension schemes like EJOHESA that we are talking about. So I wanted to know, Dr. Regis, what is your strategy to build a saving culture among current and potential subscribers of EJOHESA? Thank you.
Thank you. Thank you. It's also an honor to sit on this on the panel with this. I think to be it would be interesting to spend more time with them to learn about the history of that baby that we are growing together with them. But I think what Eric and Paru have talked about, that prior work that was established in the legal framework in setting the incentives right is some of the benefits we are enjoying today, and I think we need to keep reflecting on what more needs to be done. And to answer to your question about saving culture, I think for many people who have managed pension schemes for the formal sector, when you talk about the informal, I think in the first instant they will tell you it's not possible. Because even for those mandated by the law to contribute, we fight with employers, we fight with everyone. How can you deal with someone who you ask to contribute on a voluntary basis? But I think pension is a concern to everyone, and the introduction you have done to that motor rider is a good illustration. So I think what people are lacking to create the culture is to show them that there is a vehicle through which you save, and there is a purpose. Already the purpose, they have the purpose. They understand that at 55, I will not be able to ride this motorbike. And before EJOHESA is created, they were reflecting on other things. Probably they're trying to buy an asset, a house that will be rented. It's so uncertain and sometimes so expensive. I think having these structures created, these schemes created, itself is an incentive to saving. But I think for us as the scheme manager, we also see, maybe I can say 3 types of clients to which we need to develop strategies, different strategies. One is people with my age who adult population, men and women who either have a job or want to create one or work in their own farms. Time has passed, they have experienced another life without saving. How do we create a saving culture in them? Second, there is the youth. That is seeking for a job, starting a job, or in early career, who have not seen their parents saving, whom I think the behavior has to change today, but who have opportunities for many years to save for their pension. And then the third category is those very young in schools, those who have not even started thinking about working and earning money. How do we show that culture is part of the saving culture is part of? I think the first group will partly solve the problem of the third group, because if you see, we always do what we have seen our parents doing, at least if we can see it. So I think creating that discussion in the family, first change the behavior of the parents. I think it can contribute to changing the behavior of the children. So we are developing strategies using media, using social media. I think social media, particularly for the young group, the second group that I'll talk about, that's where you can find them. Out of that, don't expect to have them on TV or radio, apart from few shows on football and entertainment. That's where, those who listen to radio today, sometimes we interrupt that interesting discussion with the EJOHESA message. That's where we can find. But I think they are on social media, and I think that's where we can find the youth. Parents, we find them in their at workplace, in their cooperatives, in their saving, in their saving schemes, those informal saving schemes. And I think with Eric and the partnership with other organizations, we have been able to even support creation of more of those informal saving schemes in rural areas. I think that's project we have seen more saving coming from those structures. Because when it is an individual decision, it's very tough, but when it is a group decision, that regularity and that peer pressure, if I may say, also helps. I think there are many strategies. We also work with the local government. Every time they meet the people for many purposes, they meet them in a typical village. At least there is one gathering with the local leaders. So if Ejoheza is mainstreamed into what they talk about, already they have incentives because it's our shared performance indicator. Then we have reasons to talk about Ejoheza. I think the purpose is, if I am an adult, if I am a young person, wherever I go, if I am home, I want to listen to news bulletin, there is Ejoheza. If I go to work, there is a message on Ejoheza. If I am in a taxi, there is a message on Ejoheza. Going home, if I am a student, I go to school, I will find a message on Ejoheza. I think Ejoheza, that saving culture will come if we really target everyone where they are and with the message that shows how important it is to save, but also to start saving very early. Thank you.
Yes, thank you very much, Dr. Regis. Indeed, I mean, there are those statements that are made that probably the saving culture is low in Africa. I really tend to disagree. So they save, but probably they are not saving in the right instruments for the right purpose. But saving culture is there. So how do we tap into that and ensure that they channel those savings to the right instruments and purpose? So I will pose my questions here so that really I give the floor to our esteemed participants here and just to have some few questions and comments or suggestions or additions to the panel discussion.
Thank you very much, Yachu. I'll help with the questions. If you have a suggestion or a comment, please feel free to leave it on Slido. And if you have a question currently in the room, please raise your hand. There's no hand up yet. So I think
okay, good. So thank you very much. I hope the message was clear enough. So just one message, probably, or one question I'll ask the panelists is just to share with us one or two lessons you have learned through this journey of pension inclusion, and then we stop there. Let me start with the policymaker, who is next to me. No. No.
Thank you. A question I have is around government trust. I understand that from the conversations, it seems that there's a lot of trust in the delivery of the Rwandan government. How would one work around that in environments where there may be less trust or a trust deficit as a driver for these kinds of initiatives? Thank you.
Well, I think I will answer that question and spare the government organizations on my left and right. It is possible, and I think, well, Kenya is one example. My dear colleague and very dear friend, Sandeep Raichura, is one example of driving informal sector pensions in Kenya, and Zamara is doing a fantastic job of it. I think the trust factor really comes in on who is the front-ending person, right, who is actually explaining the scheme. So whether it is, and I have to say this in the room, and even with Ejoheza, if you're going to SACCOs, or what in India what we call is fintech touch, right? So even if you're going to SACCOs, they may not, or some of the women in those may not be savvy enough to maneuver through a USSD, which Rwanda uses USSD, they use web. Sandeep uses web, USSD, smartphone, WhatsApp. He's doing all of that. But it may need an assisted transaction, right? And the person who's standing in front and explaining the scheme looks exactly like the customer. So I think the trust factor first comes there. The secondly, it comes in how robust and trustworthy your system and your promise is. So I think one of the reasons why EduHeza, even though a government scheme, is delivered because they promised that they will give you a co-contribution. They promised that you will be able to press 5 and get last 5 transactions. They promised that if something happened, you would get a life insurance. In a very sad case of eventuality, you would get a last rights insurance. They delivered on it. There was somebody who was doing that as a reminder. Another example would be, again, coming to what Sandeep is doing as well, is even as a private player, he has a helpline that works for people. He has his very few feet on street. So in case there is an organization with, say, a milk union or a cooperative which has thousands of people in it, he has 2 people in his team who are there all the time to answer questions. So you're not flavor of the season. You can't be that. And that's when the trust comes in. So I think, and the third example I can give you is of India, where you have a government-regulated scheme, one for the formal sector workforce, which also allows informal sector workforce people. That's the scheme I opened for my daughter, and that is also for the formal sector. There is an exclusive scheme for the informal sector workforce that the Prime Minister introduced called Untitled Pension Yojana. That is a DB scheme. That's a DC scheme, sorry. But there are also private players who are doing products in the market which allow for some sort of liquidity as well. So I think at one part the governments have a role to play, the other part there is room for private players to work as well. In India both work perfectly well. But I think at the end of the day it is really a public-private partnership, because if the governments are going to allow you a regulatory framework, it's going to allow for the private players to then deliver what they need to, which will then lead to access for the informal sector workforce. And I think we can never, ever overlook the servicing part. So there's a lot of focus put on financial literacy, getting to the youth, a lot on the regulatory framework, but it's also important, which is the driving force to get to that hockey curve that we talk about, is servicing the existing customers so that they can be your goodwill ambassadors to get more. And it's not going to happen overnight. So you need to get gray hair or, bald patches, and then it starts working. I hope I answered your question.
Good. I see more questions. Great. Yes.
Yes, so I've got the mic. Good. So thank you so much for your insight. Just a comment and a question on matching contributions. So I agree with you, and particularly Dr. Farouk, that tax incentives are quite important for incentivizing the right behavior, and particularly for that low income, because if you don't have a matching contribution, they won't feel the tax deduction, right? The tax deduction work well for your middle income people. The challenge is where government finances are stretched or challenged. And so I'm wondering, can you still roll out something as good as this without the government matching contribution? Thank you.
Maybe I can couple this with another question that came in online while the panelists deliberate on both questions. What is the utilization rate for the different scheme benefit categories? Example, 40% housing and education, 40% for loans, and so on. So what is the utilization rate of the different scheme benefit categories?
We probably start with Eric on the question around government co-contributions, and then Dr. Regis will respond to that.
Right. Probably, let me just add something small on what the first question Paru answered about trust. I think you earn it over time by persistently and consistently living your promises or to your promises. So over time, people will be watching you, and I think there's no magic around. It's not an overnight thing, but over time, people will trust. I think it's the same the way we trust our friends and colleagues. To the question, can you roll out this without the government matching contribution and the other fiscal incentives that cost money? I think for me, the most important thing is what Parul said. Diving into the market and do the assessment to understand the ecosystem, what works in that market, what doesn't work. So I'll give an example. Some markets, if the government rolled out this scheme, they will not get anyone. Okay, you'll get some few. And in other markets, like Rwanda, the government, if the government was not part of this, it would have been a bit slated harder. So it will depend, right? So let me touch on the question then of incentive. Again, for me, it's not a matching contribution, but you must spend something. You must put some carrots somewhere. I like what I think Omar from Nigeria said during the break. He touched on something to do with they have identified development something, I think a network of development SME something, and they use it. If you want to benefit from the incentive for that, let's say SME development something, you need to be part of this Asia equivalent, right? I guess some countries, you can decide to pick on, let's say, if you want to be benefiting in, I'll give an example of what we were thinking about, and it's about to be passed. You realize we don't have direct, we are thinking about a rebate, a tax rebate on a VAT. And we are saying, so we want to drive digital kind of payments. We also want to drive some saving of some sort. And we're saying on VAT, on VAT, in our case is 18%. We are thinking that probably if you say, if you buy whatever you buy, and the word is whatever you buy, and you are paying digitally or electronically, in a way, you'll be paying VAT. So the tax for VAT will increase. And whenever you do that, for argument case, 2% will be deducted and they're remitted on your savings account, on your Asia Health account. Still, it's a fiscal cost to the government, but when you increase the tax base, so that more people who are, that means if you have a shop and you have been dodging VAT, and he has a shop selling the same product and he is being religiously complying, this time it's the client to walk away from your shop to go to his shop because there's a direct benefit. I mean, these are some of the things that you could do. So they are quite, others have, we are thinking of introducing draws, I call it what, a rotary, that digital payment receipt that you have also makes you eligible to win yourself a bicycle, a TV, a phone, or something. All these are things that he would probably, in a way, could work in one market and doesn't work in the other market. But I think the key point to underline here, can you roll it out for informal sector without any incentive? I think it's tough, because these people are worried about fees, rent, milk, sick, everything. So I think, especially the young that we want to target, I think it could be very tough. You need to be very, and finally, I think bundling. You might not give a direct incentive, but you could bundle, and you can bundle anything. And let me not go into that, but I think there's power in bundling. Some people, in our case, they don't like the matching contribution because it's small. $18 or $15 is quite small per year for them, but they like the life insurance. So bundling with whatever works in your market. It could be KFC, chicken, and if you buy it, you get it. I don't know. Test your market, test the waters. Whatever moves them, move with them. Thank you.
Thank you very much, Eric. Yes. Once more, client. What the client? The client is king. So whatever he wants, let's design in that line. Regis, I think there was another question around.
Yes, it was about utilization rate in those other incentives. So the scheme is very young, and those incentives are conditioned by a target. So they are given to people who have reached a target where they can be eligible to monthly payment when they retire. So far we have had very few, I think less than 10, who have reached that level, who can claim, but none of them have come so far. So far the benefits we are paying are those who retire, and most of them are below threshold. So most of them, they take all the money that they have saved and go away. And others are almost similar. So if you are next of kin to someone who was saving and who dies before retirement, then you are eligible to get that saving on either on your account or in cash when you want it. So we are working towards reducing that threshold because it is a proposal that we have put to the Ministry of Finance, because so it's a balance. What is appropriate in the future as monthly income when you retire? Then when you secure it, then you can benefit from other benefits that you receive before retirement. So I think that's why majority of so far in the last 3.5 years have not been able to reach that threshold and start enjoying the benefits of the scheme. But if it is lowered, we are proposing to halve it. Still, it will make something small, but more people get access to those schemes, to those benefits that have been put forward by the scheme. Thank you.
Thank you very much. I just wanted to seek permission whether we can take the last two. I saw one there. Here, no? Yes. So we have two. Can I go, Ingrid? Yes, we'll be brief. So we start there. I think it was first, then Sandeep, you come last, and we close. Thank you.
Thank you. I'm also going to be a bit brief. Cosmas Senyong is my name. I just want to find out how you've leveraged on technology, especially how you've worked with the telecom company to enable, to provide a platform for these members to make contributions, and if there is a cost which is embedded there, which is borne by the member. Then the next is regarding these two products, the life insurance and the funeral. Is it limited to the contributor or the member, or it can be extended, or it is extended to maybe the family members and so on? Thank you.
So do we probably get also the last one, then we answer once for all? Yes.
Okay, I just have a number of comments rather than a question. First of all, just to say that in our experience in Kenya, the informal sector can be remarkably well organized. So yes, they can be if you look at it in isolation, they can be very disparate, but you'll be surprised. Just as much as the corporate sector is organized, I find that the informal sector is also exceptionally well organized. It's how to get to that organization structure, how to speak the language that they can understand and resonate with, and also how to get the leadership of those sectors to take ownership of what you're trying to do. I think that makes a lot of difference, and it also helps to address the trust issue that was brought out, I think, by the gentleman from IIF. In terms of savings culture, I absolutely agree with you. Yes, there is, disposable income is low in Africa, but if I look at, for example, the 17 million Kenyans in the informal sector in Kenya, our research shows that 7 to 8 million of them have some ability to save. They are already doing so through savings through contributions to their own informal SACCOs. For example, in Kenya, even the housemaids, domestic help, have their own SACCOs, savings and credits. So there's already savings happening. Sports betting in Kenya, for example, it's a phenomenal industry, and it's my security guard sports bets every month. Right? I mean, it's amazing. So people have got money, they don't know where to put it. And if you can offer a transparent, simple, easy system and connect with them, I believe that the ingredients for success can be there. And hopefully we will demonstrate that in the next few years. I just have a last question to DG Eric. In terms of the fiscal incentive, as a government, you must have had so many priorities for spending. How are you able to prioritize this, given everything else? Like, if you talk to most governments in Africa, right? There's, the education, health are very significant, eat up a significant chunk of the budget, and the fiscal space is so limited. How are you able to motivate a fiscal incentive for a benefit that is probably some distant in the future?
Right, I will start with that because it's the hardest. To be honest, I was surprised by my government to accept it. I'll be honest, and it's on record. I thought it was going to be very impossible, right? But I think the business case was very strong. Our population, just like many African countries, more than 50% is young. And so what I did was to flip it, assuming you are Canada today, where now the majority are going to be old, and you remain a responsible government. Are you ready to pay the bill then, to take care of them, or you want to equip them today so that they can contribute to their old age? And to my surprise, everyone, including His Excellency, was like, you took long to come up with this. So I think for me, the issue is not their business case. The issue is saying there is an elephant in the room. You can agree, you can say to postpone it, but it will come to bite you. So that's what you just use the numbers from census to say, you know what, this is the population, this is how many people are saving. They were about 8% at the time. But these people, you are lucky today the population that you are supporting through social protection fund is very small, and these people are working. Can you equip them? Can we get something to equip them? And it was an easier sell, to be honest, in terms of when we packaged it very well, when you communicated it, everyone understood it. Conflicting needs. One thing I've learned through my experience to engaging with the government, all governments are rich. They have the money. There's no government, there's no president's office that doesn't have the budget. Why is it to be for other things? So the money is always there, but it is actually putting it into the right context. And the last one is really technical. You want a certain level of investment for the country, which comes from who? So it is either from domestic saving or from someone else who is saving, and the issue of Eurobonds, not African bonds, Eurobonds. Where do people invest the money in your Eurobond? People who lend us, where do they get the money? Part of it is the saving they made. So I think the narrative is very simple, especially for people in this room. We can put up a very good narrative for every country, including those that seem to be in trouble, right? But I think it's to have the right leadership. I'll summarize it that way. It's not the narrative is hard, but having the right leadership that is forward-looking is what we are lacking in Africa. And I would speak about that with confidence, because when you look at, I'm lucky that I'm close to the treasury and the budgeting process, always where the leadership points a finger, the money will surface from somewhere.
If I can just compliment DG Eric, I think he's being very modest as well. When we were designing the scheme, he was still on the board, and we were talking about the incentive structure. The first thing he said was that everybody in the room, even in this room, get tax incentives. that means that the government is letting go of some money to incentivize certain behavior and delivery from people like us in the room. So why do we not extend the same courtesy to people who will save their hard-earned money as voluntary savings, which may be too expensive to sustain if we don't do something like this for them now? So a big shout out to DG Eric.
Yeah, sorry, there were some other questions. One, I think, on insurance. The insurance is extended to the member. So and it's one of the unique feature in terms of the design. Pension long term, people are like, no, I'm 20. Me dying, I'm not, I can't. Let me think about the issues tomorrow. So bundling solution future that caters for long-term needs, but you bundle it with short-term, was something that I think very important. So we're like, okay, if you think you will not live long enough to benefit in the pension, let's give you a sweetener and give you life insurance for 1 year. So it is targeting the member, not the extended family or the members of the family. On technology register,
yes. Yeah. MNOs, last one.
Yes, MNOs, MNOs are contracted by us. There is what we pay, like the cost of SMS, but there is also that cost of transaction. So we pay for the notification, but the saving part is paid by the member. But we understand that we have not exhausted the collaboration that we can have with MNOs. As I was saying, we are already in discussions with all of them in terms of, and by the way, this is the concept that they buy very quickly, because also it helps them to get that wide access in rural areas. Because saving, you use your Momo, and your Momo, you first save on the Momo, which is their product. I think we are trying to see how, per transaction, people can commit something, even if it is very small, but you transact a lot, then something fixed that can go to Ejoheza, then we'll also figure out the cost issues. But so there is a part we pay, like the SMS when you pay, but the money to transact, to send money to Ejoheza account, you get SMS instantly that we pay, but you also pay the transaction fee transferring to your account. Yeah.
Thank you, Dr. Regis. I want to close. And as I close, I really want us to reflect on this question as we go. And I want you, fellows, to bring a solution when we meet next year. So can Africa afford to stand and do nothing about pension inclusion? I don't think so. We should do something, all of us. If you don't do it, there's a risk. You will either share your small pension, if you can afford it, at old age with a multitude. If not, the government will have to use your tax and take care of those people. So we can't afford. We need to do something. So next year when we meet, I would be happy to see another Ejoheza somewhere in another country, sharing lessons and also exchanging how we can expand that. So thank you very much for listening. And I want you to join me to thank my esteemed panel and thank them for the insights. Thank you.
Thank you very much, dear panelists. Obviously, this was an interesting topic to discuss. I know that we've cut short a question on digitization, but just to reassure you, tomorrow we have a whole session about digitizing the pension sector, so please stay tuned for that one. So we are entering the very last session of today's discussions. I'm going to really ask for your, I know we are over time, but let's try to also have this one and finish it in the most reasonable, shortest time. So the next speaker, he's going to talk to us about effective governance, transparency, and disclosure frameworks in enhancing the viability of the pension sector. Help me welcome Dilme, Director, Insurance and Supervisor at the National Bank of Rwanda.
Yeah, good afternoon once again. Yeah, I think I'm going to speak in a very critical because we are running out of time, and I'm going to try to see how we can go faster. So, as Ingrid said, my name is Nyonize Dilme, Director in charge of Insurance and Pension Supervision at the Central Bank of Rwanda. I'm going just to present a topic that is very much interesting with regard to corporate governance. As you know, whatever we do, our effort, whatever energy we are putting in making sure that we establish the sound and sustainable pension sector going forward, if we don't have an effective governance system of these pension schemes and the service providers, then we'll be doing like a vain work. So that takes me to have this interest and present this topic. It is called the role of effective governance, transparency, and disclosure framework in enhancing the viability of pension sector. Of course, as you may know, we have different settings of pension schemes. In some countries, we have DBs, which are dominant. In other countries, we have DCs, which are dominant. But to try to have a harmonized view on the effective governance on these pension schemes, and I would some more just a key item. So the first thing we are going to look at what is the corporate governance, especially with regard to pension schemes, the pension governance structure and the mechanism. We look at also at the transparency and disclosure of pension schemes. Then we will also examine the relationship between corporate governance and viability of pension schemes before we end up with some more conclusion. Maybe if I go back to the concept, everybody in this room can ask, what is corporate governance? So we have so many scholars in this area, but corporate governance is nothing but leadership and direction. So these are two main terms that we can associate with corporate governance. It's about leadership, it's about direction. So it is the way the governing body directs and controls the operations of a pension scheme or any company. So what is about leadership? And how can we attribute good leadership and the direction? So if I can go to the leadership, maybe I can attribute leadership in three concepts. One is we need to have competence, we need to have connection, we need also to be able to have some kind of buy-ins with how we interact with different stakeholders. So now, in terms of pension schemes, how we apply this leadership to make sure that we have an effective governance in those schemes. How do we apply competence? How do we apply this connection? How do we apply these buy-ins when we are interacting with different stakeholders. This is what we are going to look at, and looking at this topic, maybe someone can ask himself, what is the pension scheme governance? So I've tried to look at the OECD principles to try to see and examine this effective governance in terms of pension schemes, and I've correlated the 5 elements that are very, very essential for the effective governance of a pension scheme. And one is we need to have a governing body. And if I'm talking about a governing body of a pension scheme, in some pension schemes, it can be board of trustees. In other scheme, you could be having a board of directors, depending on whether you are a company or you are a PPS, a COPS, or a DB. So then you need also to have accountability. What is now accountability? And is this accountability essential for the effective governance? This is what we are going to look at in detail in the following slides. We also touch on the suitability of the people in the governing body. Then we look at also the delegation and the expertise of the people in the governing body, as well as the service providers for our pension scheme. Looking at, so I have tried to see the structure. The structure that you are looking at here, it is touching on the board of trustees and the directors, but also you have to be reminded that we have also other service providers that are working hand in hand with this board of directors and the board of trustees, mainly the auditors, the actuaries, the legal people, the administrators, and the custodian and the investment managers work hand in hand to ensure effective governance. So this is something that everybody should ask himself: should we continue working in silence, or should we having a kind of collaboration and mutual cooperation between these the board of trustees and the service providers to ensure that we are having an effective governance going forward? This is what we need to look at. So if everybody, for instance, the board of trustees, directors, and the service providers are doing their job properly, then of course there is no doubt that we will reach to an effective corporate governance in the pension scheme. I am trying to learn so faster. These are suitability, I have explained. Delegation, I have touched on it. Looking at the governance mechanism, what are the appropriate governance mechanisms that should be put in place if we need to have effective governance for pension scheme? I have tried to examine and cross-check and subdivide this mechanism into 2 parts mainly. One is the internal mechanism that we should be put in place, or the pension scheme should be put in place. Also there is external mechanism. And those internal mechanisms are 3/4. One is the risk-based framework. And the risk-based framework, of course, it has to be correlated with the risk nature and scale of each pension scheme. If you have one size fits all, then you will not be having a proper risk management framework for any particular pension scheme. This is the first item to go. And again, on the second internal mechanism of control should be put in place is to ask ourselves, do we have proper policy structures that will guide and help the pension scheme to run effectively? Then, if you have a scheme, which doesn't have these policies, you ask yourself how this scheme is going to function without these policies and procedures in place. Then you can ask in the long run that this scheme is likely to fail. And again, the other internal mechanism we should be taking care of is the committees. Do we have in this pension scheme committees to guide and advise the full board and the board of trustees in different areas? You know that these board committees are made of people with knowledge, competence and skills. They are somehow independent. They can advise without any undue influence. So if we don't have these board committees as internal mechanism, then the controls of this pension scheme will have a problem. On the external mechanism, then this is where we are looking at what are the factors that should be put in place to make sure that we have effective governance for the pension scheme. Then I'm going to talk about the reporting requirement and disclosure. Do we have appropriate mechanism for pension scheme to report on regular basis whatever they do? So, as regulators, did we put in place the reporting requirements that are adequate enough to ensure that these pension schemes are giving us the information on time, so that, because at the end of the day, we need to protect the members' interest. So if we don't have proper reporting, then any decision that is based on wrong information is likely to put the pension scheme in troubles. Then there's the issue of transparency. Looking at the transparency, we need to ask ourselves, is the government able, whatever they do, are they able to disclose without any undue influence? Are they being honest in whatever they are doing? Are they being fair to their members? So this is a very big question that I think the regulators should be asking, whether the governing body is transparent enough to ensure that whatever they are doing in the benefit of the members of the pension scheme, not on their own interests. Then comes the issue of external audit requirements. To my experience, I've seen that if you have a pension scheme which does not have any independent audit function, then it's like this pension scheme is operating in darkness. You can't know exactly what is happening in that particular scheme if you don't have an independent view and of an external auditor looking at how they are operating, expressing an independent opinion on the state of affairs of this pension scheme. So in case most of these private pension schemes, depending on their size, tend to not have the regular audit for their operations. But it is a strong requirement for this pension scheme to have an external audit function that we look at their numbers on an annual basis to give assurance to the members that whatever the governing body is doing and management is doing is in the best interest of the members. Then in terms of transparency, this is where now the onus is. Maybe for all of us who are here in this room, you find that whatever the pension scheme is doing, they tend not to disclose the information to the members. But of the market conduct and the consumer protection aspects and consumer protection requirement, it that a pension scheme should disclose information to the members, and those information including either annual accounts, the prospects about the future. If, for instance, a pension scheme is likely to increase the contribution rates, and it is also likely to implement any other strategic measures, they have to inform the members ahead so that for them they get prepared. So it's not something that to take them like a surprise and they say we are implementing this. We need this level of transparency and disclosure. Then, of course, all these contributions are invested for the interest of the members. Then, if, for instance, a member is requiring that they disclose investment policy they are using, it is a must that they should provide the information around the investment requirements and investment, how they have invested the funds of the members. Otherwise, if they do and they don't disclose information, the members will be in the darkness and they will not know what is happening in the scheme. So as regulator, we need to ensure that the information disclosed by this pension scheme also is comprehensive enough so that the member increase the confidence and the trust to the governing body of this pension scheme. Then they also they are responsible to disclose information about the claims. They are also required to make sure that they produce what we call the individual statements of accounts of each member. Because at the end of the day, if I have an account in a pension scheme, I need to know how this account is accruing. If either my account is growing or maybe declining, this information I should have liberty to look at how my account is progressing. The issue of good governance and viability, this is trying to correlate governance and viability of the pension scheme. This is where we try to examine the success factors of a pension, a good and well managed pension scheme. Then what are the triggering points? One is, first of all, to have well-motivated, skilled, and competent staff to drive the pension scheme to achieve the objective and the goals. Then we need also to have these structures that I have talked about. We need to have good policies. We need to have good procedures. We need to have a mechanism of ensuring transparency. We need to have a way of adequate reporting. Then, of course, we need to make whatever the scheme is doing is bringing value to the members. Otherwise, if the members are not getting any value out of what the scheme is doing, then they will not be motivated to continue to contribute. So whatever this is to have a viable pension scheme, we need to have all these interconnected to ensure the viability of the pension scheme. Then, if we are talking about success, we need also to look at the other coin of the other side of the coin. So the failures. What are the potential cause of failures of a pension scheme? One is having an unstructured governing body. This is where you have a governing body which is not well structured and is not even working as a team. Find that everybody is doing its work on his own without this issue of correlation and trying to understand the goal and the vision and the strategic plans of the pension scheme. So if there is this disjunction and this connection between the members of the governing body, then this also trigger the failure of a pension scheme. Then, if we don't also have a good governance mechanism, this is what we call the controls, the internal controls and external controls. If those controls are not existing in a pension scheme, of course this pension scheme is likely to fail. Whether a DB or a DC, there is likelihood that this pension scheme is likely to fail. If we don't have a strong and adequate management information system, then you are doing the work manually. There is no digitalization. You will find that the system managing the pension is not interconnected with the system handling the benefit. Then you find that everything is doing on a manual basis. There is no interconnectedness. There is no digitalization. Then there is a lot of human error in whatever the scheme is doing. The scheme is likely to collapse. Again, this issue of disclosures is very, very important. If members are no longer trusting the governing body of a pension scheme, they try to suspect something is wrong somewhere. Then they discourage them to continue making some contribution. So, in a nutshell, those are some of the key factors, but we can proceed. Yeah. This presentation, maybe this is what we need to ask ourselves as whether regulators or pension players, that what should be done to put in place effective governance in pension schemes. And we need to again go back and look at what we have in our own jurisdiction. Do we have those systems? Do we have those procedures in place? Are we requiring the pension scheme to disclose information to the members? Are we requiring this pension scheme to provide reporting that is regularly and quarterly? Do we have the mechanism for committing this pension scheme to an annual audit so that we have a clear and a fair view? So those are the key elements that we should be asking ourselves. And again, for this governing body, they need to ask themselves, are we doing the right thing to our members? Or we are doing things on the way we want? But at the end of the day, we need to remind ourselves that what we should do, we are doing in the interest of the members, so that the scheme is sustainable. And for the regulators, I think that the overall mandate of regulators is to make sure that the pension schemes and the service providers are doing the right thing. If they are not doing the right thing, you know that these pension schemes are there for so a long period of time. So if we don't have strong control, strong supervision to make sure that they are well governed, then we find ourselves being questioned that how come that this scheme has collapsed, then you are there as a regulator. So we need to take full responsibility and try to put some mechanism to make sure that these schemes are well managed, because at the end of the day, you can invest in different areas, but if you don't have a proper and well functioning body which is ahead, then you end up by having a collapsing pension scheme, not only pension scheme, but also the pension system will be also in jeopardy. So maybe as I conclude, I can say that the rise and fall of the pension scheme rests on the governance and leadership system in that particular scheme. So a big assignment is to go back and examine whether we have a strong leadership team in our pension scheme so that we can sit comfortably and say our pension scheme are well managed, whether in today or in the future, we'll be having a sound and stable and sustainable pension sector going forward. Thank you very much.
Thank you, Director Dilme, for a great presentation. We are going to have our last panel session of today, and for this, I'm going to welcome Anne from RBA Kenya to moderate this session. And for this last panel session, for the sake of well managing time, I'm going to insist that questions are on Slido so that we receive them ahead of time and then we manage the time that is used to answer them. We are only going to take a maximum of 2 questions from the audience depending on how the time was used by the panelists. Please bear with us. We are trying to squeeze it to finalize today's program. Thank you.
Thank you very much. Is this on? Okay. Good afternoon, everybody. Thank you for staying on to the end. And we are going to keep this quite brief. Thank you, Ingrid. And we want to thank Mr. Dilme for, in a short while, making it very clear what we are talking about when we talk about governance. I will not try to repeat what he has said. So I will ask you, Mr. Dilme, to come here and join this panel. Mr. Dilme, as you have seen there, is the Director, Insurance and Pension Supervision at the NBR, National Bank of Rwanda. So you're actually the equivalent of our CEO at RBA. Welcome. I was going to say in Swahili, karibu sana. Then we have Mr. Wilson Kaindi, Country Director, KPMG Rwanda. Normally, the consultancy firms deal a lot with governance. I remember when we were, thank you for coming. I remember when we were developing our governance rules for the Kenyan pension sector, we actually used KPMG as our consultant, so it's a coincidence. Welcome. And last but not least, Mr. Fred Nyayeka, please join us here. Fred is a pension expert working with Liaison Financial Services, Rwanda. And Fred, if you'll allow me, I'll disclose that we once worked with you when I was working in the private sector, my last employer, ICA Lion. I guess my dear friend there didn't know I worked there before. And Fred, we welcome you. You'll give us the perspective of the private sector. So we have been told about governance, and I just want to make 2 very brief comments before I bring in the panel. We are running schemes in most of our countries. The schemes that we either regulate or that we are running are voluntary. And if we don't get the governance right, you'll find even the sponsors of these schemes, the employers, or even the members choosing to wind them up or to walk away. So you remember one of our panelists here said that the levy was reducing. For some of us who are regulators, if these people walk away, we have no job. So we must get the governance right. We find that governance tends to, in many of our countries, the governance laws and regulations tend to come in after the prudential. Prudential are dealing with the hot issues, like are the funds coming in, are they being properly invested, is there any loss, is there any leakage? But if you don't get the governance right, then the prudential side will tend to be usually a crisis management. And then my last comment is the issue of integrity. in many of our schemes, we are relying on sector players who support the trustees who are the legal owners of the schemes. And if there is a lack of integrity there or the trustees get compromised, then there is a challenge and the schemes could start collapsing around us. We are grappling with this on some of the big schemes in our country, and I hope the other regulators are not having those challenges. All those come from lack of governance. So I will only ask 3 questions. I've limited them to 3 because of the time. And I will start right from the end there. I'll just come this way. And I will ask you to share your views. Mr. Dilme has done a very good presentation. We want to see what your views are on why good governance is very important for a pension scheme to achieve its objectives. I'll start with you, Fred.
Thank you very much, Anne. And once again, good afternoon to everyone. When we talk about governance, one, we have to appreciate that governance has become a big debate globally. And the reason is because of the past corporate failures. Now, in the context of a pension scheme, we're talking about boards of directors for schemes that are established under statutes. We're talking about boards of trustees in occupational schemes and individual schemes. And because they are at the apex of the governance or management of these schemes, we look at what is the main objective. If the objective, but we know the objective of the pension scheme is anchored on the governance structures that are in place. And what are we talking about, the governance structures that are in place? I will borrow from the presenter, Mr. Dilme. He talked about external mechanisms and internal mechanisms. Luckily enough, in the pension context, in most of our countries, in most of the jurisdictions that I know, we already have the first order reforms that anchored the regulators of the sector. So the external mechanism is well taken care of, and in most of these jurisdictions today, we have a requirement for training and certification to take care of the capacity in terms of boards of trustees and boards of directors. This is the same case in Uganda, in Kenya, the same. These were introduced quite some time back. So in terms of capacity on governance side, that has been taken care of by the regulatory authorities in the jurisdictions that we've already have the first order reforms that is anchoring the regulatory authorities. And now, when we come to the internal, that is where the challenge is still because it is still, governance is very broad. And internally, even as we build capacity, there is also need now to more or less make it informed that what are the basic requirements. We are talking about, are there written policies on governance? Some of these policies, which are very, very important, include the risk management policies. We have communications policy. Communication has come out strongly here. What do we communicate to members, their expectations? So it is important that we isolate and identify all the policies that are required and have these documented for the board members, whether they're boards of directors or boards of trustees. And through these, then we end up having a seamless, no challenge, and therefore the schemes are able to achieve their overall objective of providing for retirement. Thank you.
Thank you very much, Fred. Mr. Kaindi, you deal with very many sectors. We want to hear from you. Are we getting it right in our pension sector? Is what we are doing governance? Tell us. Thank you.
Thank you, moderator. And I think we're ready in the evening. Good evening, members. It's a pleasure for me to be part of this wonderful conversation. I don't take it for granted. The moderator has asked a very difficult question to a professional service provider. Yes, and I'm glad you mentioned that KPMG did play the role putting together your policies. Mainly when I speak to people, the first thing in mind, KPMG, they will say audit. Yes, so going to the question, are we doing it right?
In my view, yes, and you're right, I look at different sectors. I'm privileged to be part of a global entity where outside pension, we look quite closely at the banking sector as an example, and maybe insurance. They're all linked to pension, but if we are to carve out pension. So there are things that we've done well. And I know this is a regulator's platform. And from my interaction with the industry, certainly there are things that the regulators have done well in terms of governance, and I'll give a few examples of that. So if you look at the external factors that Director Dilme talked about, I've seen steps being taken in terms of say, accreditation of these external service providers who are very critical at the success of the pension sectors. I'm talking about external auditors, the administrators, the custodians, etc. So the regulators have been able to set out procedures and what they should expect at a minimum of a service provider to ensure that whatever is being put on the tables for the Board of Trustees or any other governing council is of quality. So that is one of the areas that I've seen being done well, and there are very many other areas. And in the benefit of time, I won't go into those details. However, having said that, there are areas that can be done better. I think one of the presentations that I had in the morning, I think it was from the presenter from ICA. She mentioned that usually the pension sector will be looked at last, and she made reference to the topical issue right now, the ESG. And the regulator from Uganda was telling me earlier that this has been around. But yes, it's been around, but the perspective globally has changed. There's a huge emphasis in terms of the climate risk, in terms of the sustainability reporting. And indeed, one of the things that came out from the last COP26 in Glasgow was a birth of a new International Sustainability Standards Board. And from the accounting sector, there's a standard, and the exposure draft has already been put out there. And hopefully, probably by end of this year, then it will be out there. So sometimes as the pension sector, we need to move a bit as fast as the people in the banking as well. In Kenya, I'm aware of the climate disclosure requirements that the central bank already ruled out. So as an improvement area, the pensions need to also try to move quite fast when such requirements do come in place, and please work closely with our professional service providers like ourselves to ensure that you achieve the speed to the market and building the expertise both internally and also within the industry. Thanks.
Thank you very much, Mr. Kaindi. I can see you're looking for the next job. Thank you. Now, Mr. Dilme, you've shared a lot of your views, so I'll not throw the broad question to you. What I have in mind is we have a very important team of players in the sector called trustees. Are you having challenges? Are they risk averse? Are they taking risks? Are they actually making decisions, or are they leaving it to the service providers that they have appointed? Please share your views.
Yeah, thank you very much, Anne, for this question. Maybe to respond to it, it is very tricky because if you look at these trustees, of course they are managing and they are overseeing different pension schemes depending on the size, scale, and
and complexity. So you find that the philosophy around the way they manage their management depends on how they see things. For instance, if you have a larger pension scheme, you may tend to, before you take a decision, you need to think broadly and carefully to any decision you are taking, because sometimes when you take a decision and that decision is not on at the interest of the members, the consequence will be huge. So I can say that in that perspective, some may be taking the point of being averse, others will be like risk takers. It is depending on the circumstance and the situation they are in. For instance, in this time of crisis, the COVID-19 period, if you ask a board of trustees to take a decision around investment, and we are seeing some more shocks around the investment risk and market risk, in this situation, some more board of trustees may decide to guide their investment managers not to be very optimistic. Then they take this kind of like a pessimistic view because of the situation they are in. But it is not something that is static. It changes depending on the situation and the period they are in. So they don't have a static point of view. It can change depending on the period they are in when they are making a decision. Thank you.
Thank you very much. The reason I was asking that question is that we realize the trustee skills are the ones that drive our sector. And the reason why we are having those improvements that Mr. Kaindi was talking about that are not coming through, we have ESG and all those very important decisions that need to be made is because we need to upskill our trustees so that they can make the right decisions. My second question has largely been answered, and I think, let me just read it out and then we'll move to the third question. My second question was about the governance structure that works in your country and what improvements you wish to see. I think the panel has addressed that. We'll go to the third and the last question, and I want again to get your view, starting from Fred. We want to talk about transparency and disclosure. They are very important aspects for members of schemes and other stakeholders in the industry to have confidence in the system. What is the minimum information that we should be disclosing to these people? You can either talk about what we should disclose to members or to the other stakeholders, or both, preferably both. And very briefly, before Ingrid starts motioning to us. Thank you. Fred?
Thank you very much, Anne. When we talk about disclosures and in the context of a market that is already regulated, we look at what as a provider you are able to add on to what is basic in the legislation. Most regulators have gone ahead to prescribe the minimum disclosure requirements, and other than the financial information that you have to disclose, there are also the member information. That is when we talk about members having access to their accounts, which includes both financial and biodata. When we're talking about the scheme itself, do they understand the benefit structure, the processes that are in place? And it is very important that as governors of schemes, that is boards, that members have a clear understanding all the processes and procedures in place besides the statutory prescribed disclosure requirements. Thank you.
Thank you, Fred. Mr. Kaindi, your view on that. Thank you.
Yes, thanks so much. In addition to what he said, I would also take a different view. The starting point is to understand the members of your scheme. And I'll use a live example that I've interfaced in my career. There was one scheme, I think this was a particular university, which had both the teaching and non-teaching staff. So you can imagine you have the professor, the other side, and then you have a lower staff, maybe an administrator, a university staff. So it is important to then understand, in the context of the understanding of the members, what is that information that would they deem critical. In these AGMs, we used to have a bit of drama. One stands up, you people are eating our money. Why is that return low, etc.? So I think it is very important that in addition to the obvious benefits, that the members are sensitized in terms of the process of the scheme itself. If it means breaking it a little bit into smaller groups, what you would call focus groups, based on the different levels to break it down, and so that the information can reach, it can hit the point without moving so fast for some of the staff. And most importantly, it is having that open office where members can access and ask all the information that they may require in terms of the statements. Someone talked about the digitalization, which we'll cover tomorrow. So the balances are very critical. The return is very critical. And what you'd call a helpline. If I had the question, does that scheme have a mechanism of answering any question that the member may wish?
Thank you very much, Mr. Kaindi. For you, Mr. Dilme, again, because you shared your views with us, I want to tweak it a little. Should we legislate that disclosure? How much should we legislate? Or should we leave it to the trustees and the governance structures to determine how much they should disclose? Thank you.
Thank you very much. This is a very good question, Anne. Maybe to me, because you see, the pension scheme is dealing with the members. And here we are talking about, mostly what you are talking about, these some members from this informal sector. You find that some of them are not knowledgeable enough. Then how do we make sure that at least they get the minimum information? So by the time of drafting the corporate governance code for our pension scheme as a regulator, we should at least include the minimum information to be disclosed to the members. So, and okay, now beyond that minimum, the governing body of a pension scheme has that liberty of providing more information, but at least we should be putting some of the minimum of information that should be available to a member of a scheme, so that they have that comfort, because at the end of the day, regulators are there also to protect members, and the way you have to protect them, we need to make sure that at least they have access to the minimum information of what is being done in the pension scheme. Thank you.
Thank you very much, Mr. Dilman. I agree with you. That was actually a question that I was also thinking about. It's important that we have that minimum disclosure in the law, but we expect the sector players, including ourselves here, to reveal as much information as possible so that members can make the right decisions, and even the trustees, who are the legal owners of the schemes, they need that disclosure, adequate information, so that they can make the right decisions. I'll go back to Ingrid to find out if you want to address one or two questions that may have come through, and then I'll come back to you for some closing remarks. Ingrid?
We don't seem to have any questions online. However, maximum 2 questions from the room. Can we take that?
Okay. Thank you very much for the discussion. Actually, it's not a question. It's actually, I want to share something with the panel and also with the audience this afternoon. is, for example, in Mauritius, we have all the disclosure requirements in our rules supporting the private pensions framework. And with regards to that, we've seen that it tends to make the life of the regulator easier also, in a sense, where you have all the members being informed accordingly about their benefits, access to the documents governing the schemes, etc. So in April 2021, we came up with our guidelines for shifting or converting DB schemes to DC schemes. So basically, this is a very, very important process. And for the members as well, because you're changing the nature of the plan itself. So what we made sure that to have in those rules were to have proper communication exercises done to the members prior to them deciding whether to shift or not to shift or convert or not to convert. And the moment they are informed about all the information relating to past accrued benefits and future accrued benefits, and the moment they consent, this gives the regulator a very comfortable approach in going on with examining each application we receive. So from a regulatory perspective, transparency and disclosure is at the forefront. It's very important, and the moment you know the members have done an informed decision, you as a regulator, you feel comfortable to go ahead and go with the shift or the conversion. Thank you.
Thank you very much.
Thank you very much. We've had a set of questions come through online, but we have also already passed the microphone to one person.
Yeah.
So one question in the room, and then we go to the questions online.
Okay. So.
Okay. I think one of my questions should be online, but however, let me just ask it now. I think there have been several advisories against interferences from political leaders into public pension schemes, or both public and sometimes private pension schemes, or in situations where you have both integrated. In certain countries, particularly also in my countries, or in most countries, African countries, you have the president appointing the board chair or chairman of the board of trustees, and then the director general. So in essence, what you would have at the end of the day is that it is highly unlikely that one would expect a non-interference from the political office into how that pension fund is being administered or run. So my question would be, how do we prevent, or what is your advice in preventing such interference in events or situations where the Director General, the board chair, and sometimes the board members or board of trustee members are appointed by the president or other political leaders in governance? My second question would have to be where we have, of course, pension funds, as we have had, one of the biggest institutional investors. And we have pension funds who have subsidiary companies or investment companies. Is it correct, or does corporate governance allow board of trustee members to serve again as board members on the boards of those investment companies, quote unquote? Those are my concerns.
Thank you. Those are very good questions. And I'll throw the political question to Dilme. But just to let you know, I was at a forum in my country the other day, and I made a gaffe when I said that the CEOs of the sponsors should not serve on the boards of trustees. And everybody was up in arms, but I think it's something that we need to legislate. So we get and I think Mr. Kaindi referred to that when he said, you may have a board, you have the chancellor and a very junior officer, and they are both supposed to be trustees. Obviously, there is an imbalance in power. So, Mr. Dilme, how do we reduce this interference, especially political interference in public pension schemes? And then I will also allow the other two panelists to comment on it.
Thank you, and this is a very, very sensitive question, and maybe to answer it, it requires a lot of thinking around that.
Understand?
Yeah. Maybe the starting point for this handling this case and this aspect is on first of all to make sure that this public pension fund has adequate governance system, and those governance system has to be established through their governing laws. And you know, if there is a law, even those political people who are appointing these people, the politicians, they have to refer to the law governing that particular public pension scheme. So if you have a comprehensive law, which is fair enough, discussing how the governing body of a pension scheme, public pension scheme should be put in place, even these committees, even the kind of document, strategic document to be put in place, the kind of risk management practice to be put in place, then this is the starting point. And as a regulator, what we do is first of all to even advise the policymakers that this is the law, it is there, it is saying X, Y, Z. So by the time we are appointing the person A, B, C, it is better to look at this governing instrument of this public pension fund. And you know, there is strong collaboration between the regulator and these policymakers. So whatever we interact with them, in kind of, as you know, even the government trusts the regulator. This is the starting point. If you are a regulator and the policymakers and government maybe has lost some trust over you, then of course as regulator you cannot do the job. But maybe from the perspective, Rwanda perspective, the regulator is trusted enough that any advice that is given to these policymakers based on the governing instruments of that specific public pension scheme, then the policymakers can take this advice going forward. So this is how I can answer this. And you see, in appointing, they don't do it just in a arbitrary way. They have to follow the law, the governing instrument of that particular pension scheme. Thank you.
Yeah, thank you for a very balanced response. Bwana Kaindi, what do you think?
Yeah, political question. I'll also politically answer it. And my answer will be quite similar to what the director has mentioned. I think the fallback when in such a case is to have very strong internal controls, good systems, in terms of communication to the members as well. The regulatory supervisions also have to be thorough so that any issues identified are pointed out with transparency. Also looking at the external auditor front, remaining independent and basically reporting using the guidelines that are set internationally. So let the system around be as independent and effective as much as possible, despite having a leader who probably has a political hand involved. Yes.
Thank you. Thank you. Fred, I'll spare you that question. I think it's been answered quite well. So I want you to answer the second question that was asked about the related parties, where, for example, someone is sitting on the board of trustees and could also be sitting on the board of one of the service providers because you're in the private sector space. What are your views on that?
And maybe before that is answered, we have another question
around
board of trustees, so we can take it together.
Okay.
It says, it's from Edwin Mohammed Kamara. It says, have you ever experienced a situation where board of trustees tend to involve in the day-to-day activities of the pension scheme? So as we answer that, and he asked what are the risks?
Yeah.
So as we answer that initial question, let's carry it with this one.
Yeah. So Fred, all those questions are coming to you. The one about the related parties and also the Board of Trustees going beyond their role and being involved in day-to-day affairs of the scheme.
Okay, thank you very much. And if I got it right, I thought it was sitting in the board of an entity that the scheme has invested in. Yeah. Yes, that is right.
It's invested in, okay,
yes.
Thank you.
So in this case, where a scheme has invested, because they have an interest in an enterprise, where I see it, by extension, there is no conflict of interest, because the underlying factor here is there a conflict of interest in our dealings? And to the extent that there is no conflict of interest in the dealings, then where I see it, I would see no problem in a trustee sitting in a board of an enterprise of the scheme, because by extension, it is a venture of that scheme, which ultimately the overriding objective will still be one. But my colleagues can also add on to that. Now, when we come to governance, we have to distinguish between two things. One is the management in a broader sense, that is, which involves policy formulation. That is now where the trustee is involved. But when we come to the second level, which is administration, then that is now what is delegated to the professionals, the service providers. So to the extent that a trustee can skip the line, jump the line to administration, there is obviously a problem at that stage. What needs to happen is now to build the capacity of the trustee to understand the roles and responsibilities of that particular position that is trusteeship.
And that answer that you just give kind of touches on the latest question that we have. It's from Leonard. It says, would service providers or administrators still have an important role in the governance of a pension scheme if the scheme have professional corporate trustees?
Yes, the answer to that is yes. Just like I've explained, a corporate trustee takes the fiduciary responsibility, which is at policy formulation stage. So that is the governing body. And the governing body then delegates the administration part of it to the professional service providers. So just like in a corporate, if you have a board and the board members want to run the operations of the scheme, of the company, then effectively you are saying you are rendering the CEO redundant. So it's the same thing with the pension scheme. Where the trustees are involved in the day-to-day management or administration of the scheme, then they overstep their mandate.
Thank you very much. And then the very last question from Martin. The moderator will help me to nominate who answers to this. It says, a very good discussion of governance. Thanks to the panelists. Is there a metric that can be used to measure governance? So I will let the moderator nominate who can answer to this.
Yeah, thank you, Ingrid. Before you ask that, Mr. Dilme wanted to make a very quick comment. I don't know whether Mr. Kaindi, you want to make a quick comment also on that? Because it's very important, especially what Fred said about someone sitting on the board of a company that the scheme has invested in. You know, just like law economists, pension experts never agree. So, view, it may be different, but maybe, so Mr. Dilme and then Mr. Kaindi, then we shall, that question about whether there is a metric, I think, can you take that one, Mr. Kaindi also? Thank you.
Sure. Yeah, thank you very much, Anne. Maybe what I can add on the question asked whether a board of trustees can be in the management of the pension scheme. Normally, this is not a best practice. It's not a best corporate governance practice, because we need to have this segregation of responsibilities. The management make decision, But the governing body that Fred was talking about, they monitor and control decision made by management. So if you have a board of trustee at the same time being in the management of the pension scheme, it's like he's doing self-review. Whatever he's doing is also controlling and monitoring. So this is not really a good corporate governance practice. Maybe wherever it is, maybe it should be discouraged because it is not really a good corporate governance practice. There should be some kind of segregation of duties so that at the end of the day, the board of trustees, they control. My presentation, I was saying that there is the way the governing body direct and control the operations of a pension scheme. So if now the board of trustees is in the management, then at the same time controlling and monitoring, so it's like there is a missing link on the oversight part of it. So to me, as a regulator, I would not really encourage that practice of having a board of trustees at the same time in the management of a pension scheme.
Thank you very much, Mr. Kaindi, on the related parties and also the issue of metric.
Okay. Thanks, moderator. And the question was asked whether a board of trustee can sit on the board where the is invested. And my views won't differ from my panelists here. And I've seen this in practice, and the idea is that this board of trustees will represent the interests of that pension in that particular company in which the pensioners are invested in. I think what needs to be clear is that that particular trustee has to be independent. It should not have any financial or non-financial interest in the company on which is being appointed to sit on. So the conflict of interest, as long as it's not there, then it can be a useful way for the trustee to get direct information from the investee for the benefit of the overall pension. The other question around the metrics of good governance. Quickly, what I can mention, of course, the starting point is to set the KPIs. What am I going to measure the governance around? And that will be driven by the internal policies that I've set and I've put in place. And I'll give a quick example. Could be, I say, as trustees, we need to meet on a quarterly basis. A quick check would be, if I was just checking a tick boxing, at least the trustees actually meet within the 4 times they say they would meet, but the trustee did. So that becomes the initial check. Then I go a step forward to check on the quality of the meetings. Do we have good meetings? What is the quality of discussions that are happening? Do we get the minutes on time? Then after that, what about the action points that have been agreed in those meetings? Does someone follow through? So then, that's just an example. So with that, then an independent person, if I was an auditor and I was auditing those particular non-financial aspects, then I'm able to come to a conclusion that there's some good level of governance. And you could think, I've just used meetings as an example, but think about any different aspect of a pension and critique that against the policies that you've set and the quality of the decisions that come out as a result.
Thank you very much. And you'll agree with me that this expert panel has dissected the subject quite well. I want to skip the closing remarks so that we don't stand between you and your dinner. I'm hoping there will be a dance, or at least some of that beautiful Rwandese dancing from some presenters. Thank you very much. Thank you. Shall we step down or you make the announcement?
Thank you very much to our panelists and to a very good moderator. With very quick announcements. So first, thank you for staying and staying with us for the. It's been quite interesting, and I hope the discussed today are thought-provoking, and they're going to call for more action even in the future. So the National Bank, the dinner starts in about, so quickly go and let's come back and relax all together. Secondly, on our way out, the coffee for, if you want to have one coffee, please, it's set outside. Starts at 8:30 on the dot, and this is to also enable us to round up on so those are the few announcements that I have. Let's meet again in the next 1 hour. Thank you. Yes.